this morning. Remember, as Mark said, we've had some weak data coming out of the UK. The pound has reacted to that. There's a kind of mechanical effect that folds back in, therefore, to the equity market in terms of translated earnings. But this is not an exciting start to the day by any stretch of the imagination at an index level. The Stock 600 absolutely flat as a pancake. We are not getting a Friday bounce after a bumpy week, it seems, certainly when it comes to European stocks. The IBEX is down. I don't draw a line between Credit Gupta being in Spain and the IBEX being down. There is no correlation there whatsoever. But we'll watch for her interview a little bit later on with the Bank of Spain governor. The CAC 40 will wait for that. We'll see what happens with the luxury space. The DAX, I think, is going to be an interesting trade as well this morning. Let me figure out what is going to happen next in terms of this stock story by maybe examining, Lizzie, what's happening at a sector level.
Yeah, so if we break it down by sector, so far you've got just over half of sectors in positive territory, and leading the gains this morning is basic resources. So that's up nearly 0.5%. Food, beverages and tobacco not far behind, that's up 4%. And that's obviously a step back after yesterday's reaction to Trump's tariff threats, 200% on wine and champagne. And actually, if you look on individual names, you've got the likes of LVMH now flat to the upside, but Hummel Cointreau up 0.4%, Pernod Ricard up 0.7%, so bouncing back a bit after yesterday. But what are you watching, Mark?
I mean, look, as I said, I am just so tense about kind of retail sales on Monday, and that signals that it is the University of Michigan sentiment. I think today it's the price action ahead of that, because that's the next big data point. It's actually not less than the news flow today. It's because that's the price action. This is a market that is trading still quite poorly. I think there wants to be one more washout, and so therefore, what's the close today? Also an important signal. There's a lot of people waiting to buy the dip. We heard from our earlier guest, we might hear from our next guest, about whether people want to buy the dip, and I think that close today will be very important going into retail sales FOMC, so price action is key.
This is a market that cannot make up its mind. So in terms of the Stock 600, you've got 276 stocks up and 291 down. Just a moment ago when I looked at the screen, it was kind of 280, 280. Basically, you've got as many stocks up as you've got down right now. It feels like it's a market that wants to sit on its hands. It's a wait-and-see economy, as Torsten Slok talks about. It's a wait-and-see market this morning.
OK, well, let's get some more analysis now with Beata Manthi, who is European Equity Strategy Head over at Citi. Really good to have you with us around the table, Beata. Looking at the way the market is at the moment, I mean, we're waiting for the DAX to open, but I was looking at the DAX, and it's pretty much where it started a month ago. Ollie Crook was telling us about the German vote that's happening on Tuesday. Do you think that if the vote is priced to pass, there's any further to go for German equities?
Not only German equities, but European equities overall. So, of course, right now the market is torn by many contradictory forces. It's always about the balance of risks, positives versus negatives. So I think what is happening internally in Europe via the stimulus, what the new coalition is going to do, the vote that is going to be passed, it's definitely a step in the right direction for Europe overall. And potentially, when everything gets passed, it is a game changer, because until recently, or over the past 15 years in the post-GFC wars, investors have been looking at Europe as just another trade, right? Given its cyclicality, in the world of no rates, no inflation, it was an impossibility for Europe to outperform over longer term for very growthy markets like the US. Now, the stimulus, eventually, it's going to be gradual, but it's going to improve the GDP prospects for Germany, for Europe, and therefore it will improve the EPS prospects over the longer term for the European equities. And that's crucial, right? Okay. So Europe is going to be a longer-term asset allocation proposition, not just a trade.
So we're waiting for when and if that vote passes and you get fiscal injection. We're waiting for when and if we get some tariff certainty. What about the Ukraine story? Why isn't there more optimism in this market, reflecting what we're hearing from Putin and Trump?
There's been a lot of volatility in the news flow on that front, right? Eventually, when the ceasefire happens, we think the biggest translation into European equities, especially, is going to be via lower energy prices. So Citi as the house, our commodity strategies are quite bearish on the outlook for oil. We have $60 oil. We have meaningfully lower natural gas prices. And ceasefire would only exacerbate these moves, right? putting the forecast from our commodity strategies into the actual consumption for last year, energy consumption in Europe, we could get around 1% savings of 1% of GDP worth of savings via energy costs only. So that could be potentially huge.
Mark thinks we're going to 130 on euro dollar. So what would are you going to see a commensurate rise in stocks with that? Well, is that reflective of? Does the stocks lead that, or does the currency lead that? What is the lead indicator in that story?
Actually, to Beto's point, I think we're at a paradigm shift in Europe, and I think you used the phrase, it's not just a trade, it's an asset reallocation story.
Yeah.
And that's a story that plays out over several years, because these.
But in terms of order of magnitude, what are we talking about?
Well, I actually want to ask that, but for the currency side, I think that is about, the point is that we're going to have assets reallocated, like. The 95th percentile of everyone's allocations went to the US, in January. People are max invest in the US. The whole world's going to be taking money out of that trade and reallocating to elsewhere. Maybe not just Europe, but that's what I'm curious in your view. So, to Guy's question is, what is the scale of a potential move here? If we're talking about a paradigm shift, if we're talking about Europe, what is the scale of upside we can get in European stocks? And is Germany the best player, or is there a better market in Europe to play it?
I think the best player is broader cyclicality in Europe. And cyclicality, like the order of magnitude, is the cyclicality that still has been left behind. So energy-intensive part of manufacturing base, right? That hasn't done as well. And of course, therefore, Germany is the best candidate for that. But what we've been arguing, our preferred trade for German election was to go long MDAX, so mid-cap index over DAX, right? Because this is potentially the part that, well, it's still subdued and could pick up via the stimulus.
Fold tariffs in for me. So what does, if we've got 200% tariffs potentially coming on alcohol sales. If we get an aggressive tariff story coming out of the Trump administration, back out for me from that positive story that you're talking about, what that will detract from the European equity picture.
Tariffs, we've been saying throughout the year, is the biggest risk for European equities. So we have basket that try to capture what kind of tariff risks are priced in by the market. And the basket that we run that is tariff sensitive actually has not moved up at all since December lows. So despite the market moving so high, the most vulnerable part of the market has not bounced, right? Pricing in some tariff risks. But our assumption for tariffs was a broader base 10%, not 25%, right? So if there is a risk of 25 or more, not to mention 200, right? If that materializes, of course, nothing is pricing that in. So that's definitely a risk.
I know you're focused on European equities, but I'm curious about the context of your views. You're saying there's potential paradigm shift in Europe, structural asset reallocation to Europe. But is that within a view of kind of globally positive on stocks? I mean, I'm curious about, ignoring maybe the US moment, I know it's going to be key to that story, but do you think much of the rest of the world is also going to gain, or do you think this is specifically a Europe-focused bullish story?
So I do both Europe and global, actually. Okay. So I think it's coming from both sides. One side is very positive, surprisingly positive news flow from Europe. Okay. And on the opposite, on the US side, that's something that has already started at the end of last year, is diversifying away from very rich, priced for perfection US market and tech, right? So this is the deep seek effect for now that is playing out in the markets.
What about
through
China?
This correction?
Like, how much do you weigh into that?
Absolutely. So there are lots of steps that we've spoken about, the ceasefire, lower energy prices. Of course, China coming out with some meaningful stimulus for consumption would be another tailwind, right? China has already done very well, but it's done well only through the tech stocks, right, and internet stocks. The rest hasn't moved. So the rest could move.
Could move, okay. Is it as simple as just going out there and buying a basket of ex-US stocks, global stocks? So I just go, right, US here, big basket of US stocks. Mark's shaking his head. No. Not convinced. Is it that simple, or do I need to be much more nuanced?
Well, it depends what your remit is. If that's all you can do, by all means, that's what you should do. But I think we've moved on. That was the case, just selling Europe end of last year and starting buying everything Europe towards the end, right?
the world's more nuanced now. So like there are lots of super cheap stock markets out there, right? And there are lots that are super expensive, not just the US. You take India, for example, a really expensive story. And so it's not just the rest of the world is discounted. Much of the rest of the world is discounted. There are many discounted opportunities, but not the rest of the world. So I don't think you just blanket buy. I think there's actually a chance to pick by sector, by country.
I agree. And coming back to your point on reallocation, we've already started to see a bit of that, right? So the first squeeze on Europe higher was through very bearish positioning. That's no longer bearish. But we've only started to see traditional inflows coming in like 4 weeks ago, and they're only picking up on steam, right? For now, they've been only passive-driven flows that we've been seeing. Actives haven't come in yet, but we are waiting for actives to come in, right, to capitulate and start coming in to Europe, and that would be a very different part of the market being unlocked by these flows, to your point, being more selective and being brave once the dust settles after that correction to start thinking about parts of the market that perhaps haven't moved as much yet.
Nice to see you. Always
Likewise.
Bielsa Manthi.
Thank you.
European global, apparently, as well. Equity strategy at Citi. Thanks very much indeed for coming in. Let's take a quick look at the core six. This is what the centre of gravity in Europe looks like this morning. In terms of what we are watching, you are looking at a fairly mixed picture, which has already been reflecting pretty evenly balanced market this morning. LVMH is a little positive. ASML is actually more positive, up by 1%. But on the flip side, Schneider, which has had a decent run, is a little bit softer. BMW's in focus. I think that's certainly one stock story they're going to be watching. Plus, also, what's happening at Kering? Let's find out with Joe.
So that's where we've got to start, Guy, because Kering absolutely slammed at the open of trading. We're down around 11.5% now for Kering. Now, remember, the new creative director at Gucci, he's an internal appointment, and some people wanted somebody coming from the outside and coming in and giving a fresh voice. He's also been a bit controversial in terms of his role at Balenciaga, so it is a surprise for the market. There was also speculation a few weeks ago that the Miu Miu director, I'm probably completely mispronouncing that, but he was going to come over and save the day for Gucci, and this is not happening. So a real shock for the market today. I've been asking traders in my IBs as usual what's going on there, and they just completely think this has caught the market by surprise today. Then another stock getting hit over in Amsterdam, Universal Music plunging. We're down around 10% on that one, 9.5%, as Bill Ackman's Pershing offloads a big stake in that company. He was an investor when the firm was spun out of Vivendi around 4 years ago. He hasn't made a huge gain out of it, but he is coming out. He recently said that the company should actually relist to the US, but at the moment it's the share sale at a discount, getting a bit of a hit on that stock today. Then in terms of BMW, as Guy mentioned earlier, that one a little bit weaker. It looks to be the margins weighing on that one, according to the Bloomberg intelligence piece. Missing expectations on the year ahead margins for BMW. Weakness in autos once again. Then over in the banking space, news of UniCredit potentially going to be pushing up its stake in Commerzbank to close to 30%. Here's those moves on the screen here. We're seeing Commerzbank gaining around 1%. UniCredit has been the big hunter of the stocks in that space, coming down a little bit at the moment, but an interesting one to keep an eye on with Commerzbank edging slightly higher today. UniCredit going the other way this morning. Then on your analyst rating changes, ThyssenKrupp has had a massive rally on the German spending news that we've had over the past couple of weeks, and Morgan Stanley thinks that rally has gone too fast. They go underweight on the stock, falling 5%. It was one of the worst performers at the open of trading in Europe today. And finally, it's Friday, so we're all thinking about beer, of course, and Carlsberg does get an outperform rating along with the rival Heineken. It's over at RBC. They reckon the premium beers is where those companies are making money at the moment. So they upgrade both of those stocks, and we are seeing Carlsberg rising around 3% over in Copenhagen this morning.
Okay, Joe Easton from our equities team with some of those stocks on the move at the open. As we have had the opening of the European session, we've also got the start of the US pre-market. And I just want to zoom in on some of these movers here. US tech in focus, Nvidia and Apple both in the green. And this is a read across from Taiwan's Honhai earnings this morning, posting a surprise fall after weak Chinese iPhone sales kind of eroded margins here. But the good news is that, which is an Nvidia NVIDIA supplier, forecast a doubling in AI-related revenue this quarter. We've also had the chairman saying that Honhai is likely to expand production in the US with customers there, and so this good news reading into NVIDIA and Apple.
Coming up next, we're going to talk about Spirit sales. 200% tariffs. That's going to hurt, isn't it? We'll talk about it next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The president was totally annoyed that the Europeans did this, and so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley-Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
Totally annoyed. Not just a little bit, totally annoyed. Howard Lutnick, the Commerce Secretary in the United States, speaking to Bloomberg yesterday, talking about the Trump response to the European response to the Trump tariffs, and a focus there on the alcohol industry, which apparently is going to be responded to. Take a look at Remy shares. This was the reaction yesterday you got to those comments that came through. Trump threatens 200% tariffs. European drink stocks go down quite sharply. They bounced a bit this morning, but not by much. And we are still negative on a 2-day basis. There you can see the response coming through. He is totally annoyed. Kentucky bourbon shouldn't be an area of attention. Let's talk to Pauline Bastillon, Director for Trade and Economic Affairs at Spirits Europe. It's the main lobby group for the EU spirits sector. Pauline, good morning. What would 200% tariffs on European spirits and champagne sales to the United States mean for your industry?
Look, we're really deeply concerned by what we're hearing. The prospect of tariffs coming back on both sides, equally. I mean, we were very concerned when we heard about the prospect of 50% tariffs on US whiskey, and we're extremely concerned about the prospect of 200% tariffs on our products. I mean, this has to stop because, we're just span into a wider game. We have no influence over what's happening on steel and aluminium. So, we're just saying to both sides, you have to stop this never-ending tit-for-tat escalation. This is not going to help anybody. We're fully aligned with our US colleagues, on the other side of the Atlantic. The companies that produce bourbon and American whiskey, many of them are actually European companies. You also have American companies producing European spirits in all kinds of regions of Europe, and they support, jobs, rural areas, growth in all these regions. So if we want to continue doing that, we really need these threats to go away and to go away immediately.
Pauline, obviously this is bad news for your industry. I think, no one is surprised by that. But under this current US administration and given the tension in trade at the moment, some bad things are going to happen. Some industries are going to get affected. So what if it doesn't get resolved? What if they don't listen to your pleas? What if these, there are high tariffs imposed and sustained, let's just say, even for a few months, I'm not saying for a longer term, what will be the most immediate impact in your industry?
Look, this would be utterly unacceptable for us. So now Commissioner Šefčovič is going to meet with his counterparts. They're going to have a phone call. We're fully relying on them to sort this out, to take us out of this unrelated dispute. We've been caught in too many unrelated disputes in the past. This one could be really deadly, could be a really deadly blow. We cannot afford it. Our US colleagues cannot afford it. Nobody wants it in our sector. No one wants it in our industry. We've never asked for it.
Yeah.
So, for us, it's very clear. We are just asking to be taken out of these disputes. We don't even want to contemplate the prospect of these tariffs coming.
Pauline, I get that you are frustrated that you're caught in the crosshairs here, but I'm wondering what your members are telling you is going to be their strategic response to this. Are they going to absorb the cost and hope that the tariffs go away, or are they going to raise prices and lose market share?
I mean, how can you absorb cost related to 50% tariffs or even worse, 200% tariffs? This is not possible. So, of course, consumers would feel the pain, ultimately. And that's why, we don't want to go there. We don't even want to contemplate that prospect. We're hoping that both sides will cool down, sit around the negotiating table, find an agreement, because, frankly, that's the only solution. We've all invested too much into this relationship, too much on both sides of the Atlantic to just, let it finish like that. It cannot end in this way. This is just, a prospect that we're, when we consider all the jobs, all the real jobs, the companies, the effect, that this would have on rural communities and so on retailers, on bars, restaurants, who have already suffered enough with COVID. Surely common sense must prevail at some point. So our members will do everything they can, but, at the end of the day, they just want to trade.
Yeah. Pauline Bassidon, we got it loud and clear. Director for Trade and Economic Affairs at Spirits Europe, we thank you. Now, let's turn from tariffs on drinks to tariffs on automakers. And this industry also bringing us results from BMW. The car-making profits expected to lag well below long-term targets this year. This is partly because of the escalating trade tensions threatening US deliveries, but it's also because Chinese sales have continued to slump. And we can get analysis now with Bloomberg Global Autos editor Craig Trudell, who joins us around the table. Craig, I want to start with BMW then. What's hitting them most? Is it the China demand story? Is it the tariff story? Or is that going to happen later down the line?
I think BMW is kind of a rare case within the industry at this point. Most of the forecasts that we've seen, the ranges that we've seen from car makers has been, we're going to give analysts and investors a sense of where earnings are going without contemplating tariffs. And I suppose in their defense, you don't have any clue what's going to happen next, given the sort of news flow lately. But for BMW, they made an attempt here to sort of factor in tariffs into their guidance. That is a big part of what's keeping them contained for this year. They do actually expect to see better sales this year than they saw last year. I do think that they're concerned about the sort of state of affairs in China and the broader industry pressures that are being felt. Because to be clear, it is not just them that are shrinking in China. It's really, the international car makers. Virtually everybody is getting hit there.
Let's talk about Tesla and what's going on. We saw the Trump kind of sales pitch, which was, I think, probably enjoyed by a lot of people. Tesla's under pressure on multiple fronts at the moment, though. The stock price has been absolutely hammered. Is there any light at the end of the tunnel? Is there anything Elon Musk can do? Is he in any way focused on this and trying to solve the problem? How much worse can it get for this company?
I think his comment to Larry Kudlow on Fox Business the other day that he was running his other businesses along with doing his job in Washington with great difficulty. I thought that spoke volumes. I think just overnight we got comments that Tesla's submitted to the U.S. Trade Representative, kind of in an opportunity for companies to speak about the potential impacts of all of the administration's trade actions. Tesla sort of raising its hand and saying, you know what, we're going to have issues here as well. We're going to see that, I think we've already seen that this year in terms of where Tesla's sales have been trending over here in Europe. And I do think that as we see, these strategic attempts to try and hit American companies, you think of Harley-Davidson motorcycles, Tesla electric vehicles, it is kind of synonymous with American products.
Where do Teslas that get sold in Europe get made?
So you have, of course, in Germany, you have, Tesla's made Model Ys, their most important vehicle. The Model 3 comes over from China. So that is, perhaps a limited option for the EU to take a whack at Tesla.
Okay, Craig, great stuff. Thank you very much indeed, Craig Trudell. We're going to talk Skoda next. We've got a great interview lined up. That's coming here on Bloomberg. See you in a moment.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome back. Friday morning. Equities are a little bit bid in Europe this morning. Bond markets on offer. It's going to be interesting to see what happens with the bond market by the end of the day. You've got University of Michigan data coming through. What do you make of what you're seeing thus far? Is this just everybody taking Friday off, or is there something in this?
Well, Europe's being a little bit more optimistic than the Asia session was. The Asia session was super positive around China, but it wasn't feeding through broader. Even Hong Kong was lower beta to the China stocks gain, which you don't normally see because the Hong Kong tech sector was suffering. So I thought that was interesting that Asia was very cynical about the Chinese gains. They were worried about going to the Friday session. You're seeing Europe a tiny bit more positive. And I think if you get maybe another 0.3, 0.4%, you start getting some short-term technical break in the US stock futures. The 10-day trend lines will kind of break. I don't think we actually get there. I think we go back down.
On the 5-day, we're negative on... Europe is negative on the week.
Yeah.
But it's not as negative as the States, which I think is significant.
Yes.
One of the sectors that's negative this morning is autos. We've already talked BMW, we've talked Tesla. Let's go to Berlin now. Bloomberg's Oliver Crook is with another cars guest.
Yeah, that's right, Lizzie. Thanks very much. Yes, Skoda is part of the Volkswagen family, and it's also a rare bright spot in a sort of struggling industry here in the auto sector in Europe. It's at full production capacity. They've set a record on deliveries last year, up 7%, and they're now actually the third biggest brand in the EU. Plus, its margins are beating both Mercedes-Benz and BMW, the luxury end of the sort of spectrum here in Europe. It is also critical for the Czech Republic. It's responsible for about 5% of Czech GDP, accounts for about 10% of the country's exports, and also Czech car production, as partially a consequence of Skoda, is about to surpass France's, and Skoda alone makes more vehicles every year than the nation of Italy. So we're very pleased to be joined by the CEO, Klaus Zellmer. He's also served previously at Porsche and Volkswagen. I think we need to begin today on the question of tariffs. Obviously, you're a brand that is very focused on your sales here in Europe, so you're less affected by this. But I'd like to understand the second-order consequences of what we're seeing out of the United States on Skoda.
Yeah, thanks for having me, Oliver. Of course, there are indirect effects. Since we do not sell in the United States or North America, and we're basically putting our future on India and the ASEAN region, we're not directly affected by the current tariff discussion. Indirectly, yes, because all our suppliers, they're globally based in many areas of this world, many regions. And of course, the cost pressure that is increasing then also affects our margins. And there's another effect. If China can't sell anything in America, they will look for other avenues to pursue their growth ambitions with, and of course that's Europe. So our pressure in Europe, fighting for customers, especially with battery electric vehicle transformation, is increasing.
I mean, also, one of the issues that, or I should say, one of the advantages that Skoda has is really has on the cost advantage, right? Which is you have had lower labor costs, you have, input costs that are very reasonable. And at a time when the rest of the industry is really struggling, I'm thinking of Volkswagen that's been cutting costs and cutting some of the bloat out of the system. I see that, and then I wonder, should there be more production from Skoda? Your assembly lines are currently full. Is that something you're looking forward into the future as sort of how much it will contribute to Volkswagen's core output?
Yeah, I mean, we're very proud, and this has been the case for years and years and years, that we are running a very lean system, very highly efficient on cost at Skoda. This is one of our traditions. We're 130 years old, so we must have done something right to be that long in this game. And I call it the factor cost. The factor cost is, of course, wages, is electricity, is everything you need to invest into then producing cars. And they're more favorable in the Czech Republic than, for example, in Germany. Our capacity is fully utilized at the moment, so we can't offer any advantages here. But where we can offer advantages, we also have our research and development engineers and departments. And this is where we, of course, take over more responsibility from Volkswagen, especially, for example, for combustion engines, where we have a powerhouse in our engineering department. And going forward, it could also be the whole platform that in future then hosts hybrid systems, as an example.
And you've also put out a car now that you're aiming for, and you're having basically cost parity for an EV and a combustion engine car. The margin parity is not there yet, but given your sort of structural cost advantages, do you think you could be the first within the VW family to reach margin parity, and how far away is that?
We're not there yet. I'm being very honest here. And you said cost parity. Unfortunately, it's price parity.
Sorry, price parity is what I meant. Yeah.
But it doesn't matter. It's fine. So we're making lower margins on the battery electric vehicles. However, we have an obligation to fight climate change. And with our battery electric vehicle lineup, with the L-Rock that is as expensive for consumers now as its sibling, the Car-Rock, this is the first step we're going to pursue with exactly that strategy with all our battery electric vehicles, but it is a fight, and it's not easy.
And I'd like to also get your idea, because obviously you're doing very well in Europe, but you're very indexed towards Europe. You're very reliant on Europe. In terms of thinking about expanding the Skoda brand, where you'd like to, you're pulling out of China, where it's a very small market for you. Where are you hoping to grow, and sort of what sort of measures are you going to be taking in terms of potentially, factories and putting plants places? What is your plan there?
Yeah. Our footprint, and you're absolutely right, we need to balance out Europe with something else. Something else for us is the ASEAN, so especially India region. India as a market has got the biggest growth potential going forward of any of the, in that category of size of markets in the world. We have already 2 factories there, one factory where we produce Škodas and VWs, and we have 1 CKD factory, so kits of cars being assembled that come over from other places of this world. And currently, yes, we're putting a lot of focus on India, because this is where we want to create that second leg, the second leg to have a solid stand, not just one leg on Europe.
And so the idea would be to then export from India. Is this the idea, to build out the base there? So if I were to ask you where the next Škoda plant is going to be, where is that?
There's no plan to build another one outside India, except that we have just started one in Vietnam.
Okay.
With a partner. This is a CKD factory. And you're absolutely right. One is India as a market, domestically, high growth potential. This is what we want to exploit. The second one is then export potential from India into the so-called ASEAN markets. And, by the way, also Middle East.
And then another sort of theme that we've been talking a lot about is there's been, as the sort of auto industry has been struggling, there's been a huge amount of money, huge amount of interest going into the defense sector. The Czech Republic is benefiting in part by, from that. I'd like to get an idea from you what you imagine the consequence of that will be on your industry, because now potentially you're going to be competing much more for headcount and the sort of very low labor costs that you enjoy in the Czech Republic. Are you going to feel upward pressure on that, and how are you managing that?
We certainly are going to feel, because in the Czech Republic there's basically no unemployment. So, the workforce is fully utilized. So if new players come in that are looking for workforce, the wage is the price. So those prices might go up. You're absolutely right. Now, we have a workforce that is very loyal to the brand. And actually we're paying above average. So we're not scared, but we are aware that something like that might come.
I'd like to talk to you also about the emission regulations that are sort of being debated right now in Europe. And I understand your expectation is that they're going to extend that over a 3-year period rather than the one. How important is that to Škoda? And even with that, do you think that the EU is pursuing the correct approach here?
Oh, totally. It is the right direction. Now, the CO2 penalties would kick in by the end of this year if you don't meet a certain average CO2 output of your cars. We have done our homework as manufacturers. We have a portfolio of cars in the place, and I'm not just talking Škoda, I'm talking about the automotive industry. And this is a threat for the whole industry. Because in the second half of the year, in order to meet that deadline, and it is a deadline, everybody's going to try to get through that gate. And that's going to cause a lot of disturbances in the market because consumer sentiment, for various reasons, for cost reasons, charging infrastructure, electricity prices, is not there to get to the share of battery electric vehicles we need to get to in order to be CO2 compliant. And that's why the 3-year window that is being discussed currently, maybe 4, maybe 5, will really help us.
And really one of the most sort of important goals right now for the European Commission, if we believe what they say, is basically making Europe more competitive, particularly against a United States that is massively deregulating, that is really boosting its own economy. From your perspective for the auto industry, what do you think the EU could do that would be most helpful to boosting the automotive industry within Europe?
Yeah, we need deregulation, we need less bureaucracy, we need a system that we can rely on. To give you an example, incentives in order to boost battery electric vehicles says if they ever create something pan-European, which is my request, we have to have that sustainably embedded in our ecosystem. If you turn it off, and this happened in Germany as an example, in the former administration, it basically shocked the market so much that we're actually the weakest battery electric vehicle transformation country here in Germany, in Europe at this point of time in terms of speed of transformation. So you're shocking the system, you mustn't do that.
All right, well, Klaus Delmer, thank you so much for your time today. Greatly appreciate it. That was the Chief Executive Officer of Škoda there, talking about everything from the Chinese competition to U.S. tariffs, and of course, those key CO2 regulations kicking in here from the EU guy.
Ollie, great stuff. Thank you very much indeed. There's been much debate around the table this morning as well about the jacket. I'm a brown jacket, huge fan. Very cool. Not everybody entirely agrees with me around the table. Lizzie in particular.
Outing me like that.
Sorry.
It could have been Mark. Moving on, though. Coming up, we're going to stay
You're assuming I noticed.
As the country's parliament heads to a crucial vote on spending next week, we're going to dig into that story with Monica Schnitzer, who is chair, of course, of the German Council of Economic Experts. This is
drive productivity and improve efficiency, Prudential has made significant investments in data analytics and artificial intelligence. Janella Frias plays a key role in integrating these tools into the company's processes.
We always need people. We're in the people business. But more and more, if we really want to provide the right customer experience, fast access to products, it's about technology. Technology has always been an enabler. Now it's a strategic differentiator.
Give me a sense of AI in Prudential. What are you experimenting with?
A few areas. One is around customer experience. In our individual life business, our underwriting process has gone from about 20 days to minutes. In our group business, we have partnered with a number of different fintechs to really improve customer experience, to bring on board capabilities. Things like claims management, where we can process a disability claim faster and help people get to work faster.
How much productivity uplift are you getting and will you get?
We're probably getting 10% at this point, but I think over time that is where the value is, and it will then allow us to take our capacity in the form of people and redirect it to more value-add activities.
In a nutshell, it means turning the menial into meaningful. It can be both a huge saver of time, but it can also provide real insight.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Well, generally speaking, European countries need more of everything and of a better performance. That's a general answer. And now, looking at what is happening in Ukraine, there are some probably more urgent matters like electronic warfare. This is a topic that is mentioned, I would say, regularly. Air defense as well. It shows that you need to protect your airspace, and it's very visible in Ukraine. And of course, ammunition.
CEO of the French defence company Thales talking to Bloomberg, talking about what happens next and what Europe has got to deliver. One of the biggest factors in this debate is what is happening in Germany. The German Conservative leader, Friedrich Merz, the incoming chancellor, we think, says he is, quote, very optimistic that the country's debt spending package will be approved after a parliamentary debate today. The vote is Tuesday. Merz said the SPD presented an ambitious fiscal package last week focused on ramping up defence spending dramatically and creating an infrastructure fund that would skirt Germany's debt brake. Freudian slip. Let's talk to Monika Schnitzer, chair of the German Council of Economic Experts. Monika, how confident are you that this package that is proposed by Friedrich Merz is going to see the light of day, is going to become a reality?
Put it like this, it's really necessary that this package will pass the parliamentary vote, and therefore, let's also say I'm confident that the parties will work on it to convince, in particular, the Green Party to vote for it, but there could be some stronger efforts. Let's call it a charm offensive. I think that would be really needed because for the last months they have treated the Green Party very badly, and also there are some elements in this proposal that are not convincing, and hence there is more discussion needed.
What is, we've just been discussing this around the table and trying to understand what is happening here. What happens if it doesn't go through on Tuesday? What happens next?
Yeah, then we are really in trouble. I mean, first of all, it would be so important to pass this law, this new law, because it really would send a signal to Trump and to Putin that Germany is stepping up on its defense spending and has the means to do so. So if it doesn't pass, then in the next parliament, so the newly elected parliament, it would be rather hard to get a 2/3 majority that would be needed for constitutional change. Because the right-wing populists, they definitely don't support it because they are for Putin, if you may. And the left-wing party is also not happy about spending money on defense. So that would be really difficult.
Mark, has the market got that?
No. Monica's panicking me here. Monica, you don't sound like you're sharing Merz's very optimistic kind of expectations for next week. And I'm curious, I mean, what probability would you put that 6 months from now we haven't changed or dramatically changed the kind of fiscal approach in Germany? Is that like, I mean, I think the market is assuming that the chances that, we're not going to ultimately get success here is probably only a less than 10% tail risk. It sounds like from you think there's a material risk that we fail next week and there's not really a backup plan. So I'm just kind of curious, what kind of probabilities would you ascribe to success versus failure here?
I don't want to move the market with my probabilities. So I'm still an optimist, and I think Merz will understand that he really needs to approach the Green Party. He has done so already by offering them to include climate policies into the infrastructure package that's supposed to come along. The really crucial thing at this point is to make sure that the new investment is going to be additional to what investment we have been doing so far. That's a crucial thing, this additionality. That so far they have not committed to. And the real worry that the Green Party has, and that is very understandable, is that this new package will be now used to leave room for all kinds of nice little presents to clients, people, so to people that now like to get a little tax break here, a little subsidy there. And in order to prevent that this is going to happen, the Greens are demanding, and not just the Greens, everybody actually is demanding that they commit to an additionality clause to say that what we now make available as new money, as new debt, that this is really going to be spent on additional investment, additional defense spending.
Monica, you know, that clarity around it must be, you know, explicit fiscal expansion. I understand that. And I know you don't want to move markets by ascribing very clear probabilities, but I guess at least help us provide a framework of how to approach the next week. So if we pass on Tuesday and it's all wonderful, that's all clear. If we fail on Tuesday, what's the timeline, the next catalyst of that? What should traders be looking for as the next thing to move the needle in this? How does it progress from there?
So let me say, I am confident that they will, over the weekend, talk to each other and that this will pass. But if it didn't, and this is actually what they will need to realize over this weekend when they discuss these things, if it didn't, then it would take a substantial amount of time to actually get a new go on this whole issue, because then the new parliament would have to be started, and then new negotiations would have to be started again with the Green Party, but they would not be enough now to have a 2/3 majority, so they would also need to speak to the Left Party, and there would be a lot more convincing to be done, so the task would definitely not be easier.
Okay, so Monica, Lizzie here, let's say it passes then. And I get that you want this to be new money, additional spending. How is the best way to use that money to actually get growth in Germany?
So if it's investment, then this is the best way of actually boosting growth, because as economists, we talk about multipliers. So the money you spend, how much growth will that produce? And the multiplier, this mechanism to actually generate growth is based with investment. Defense, the multiplier is smaller because, people can't use the defense equipment to actually live on it, and then this is not going to boost further consumption. So in any case, it's really important to use the money for the infrastructure to really boost investment, to use the money for defense wisely, so to really accomplish what we want to accomplish with it, which is defense to national security. So here the priority should be on national security. The other thing one has to have in mind is, even if the package now passes, the most important mechanism to boost growth is that it provides confidence, because the actual spending will only occur slowly. You need to agree on what to spend, you need to start, you need to plan, you need to order stuff, and that takes time. So in this year, not much of the money will actually be then flowing into orders and will actually be spent. But the real boost will come from confidence, because what we saw in the last year report, what we reported on that is the growth was very much held back by companies lacking confidence, by seeing so much insecurity, and this is what was holding them back, and it was what was holding consumers back.
Okay. Monica Schnitzer, Chair of the German Council of Economic Experts, as we look ahead to that crucial vote on Tuesday. Now, sticking with defence spending, the ECB is balancing that fiscal spend story with the US tariff threat. And we've got Kriti Gupta on the ground at the Bank of Spain, a member, of course, of the Big Four and the Governing Council. And Kriti, I'm wondering, as you approach your conversation later with the Bank of Spain Governor, how the ECB should be thinking about that balance, because, of course, that is at the heart of the April debate, the April decision. Do they cut again?
This is the catch-22 that you are seeing in markets and, of course, behind closed doors of the ECB. Because on the one hand, the fiscal spend, in theory, coming out of not just Germany, but the likes of Spain, Italy, France as well, is indeed inflationary. And that should be a good thing. You're seeing that reflected in the markets as well, specifically in the German yields. The problem here is just how quickly that spend can actually come to fruition. Even if you do actually get this vote passed from the German government, whether or not at the end of the day that has ripple effects into the economy as quickly as perhaps the ECB and the governors of, or in the, actually the presidents of these countries actually want. On the other hand of this is, of course, the U.S. tariff story. We've already seen countermeasures in play. Now, we are waiting till that very last minute to see if those negotiation tactics can indeed play out. But at the end of the day, on the one hand, you have real pain in growth. On the other hand, you have a real uptick in inflation. And that's why there is kind of some cold water being thrown on this idea of going back to ultimately neutral and maybe even going back to this idea of continuous cuts instead of potentially pausing in April, as you mentioned, Lizzie. There's another piece of this as well, which is where does the defense spend actually come from? Because at the end of the day, you need European banks to be able to remove some of the red tape around being able to provide lending to some of these countries and companies that are looking to create more in the defense space. And right now, there's so much red tape there that a lot of that spend ultimately is being leaked back to the United States. That's what the ECB, from a regulatory and a monetary perspective, have to tackle.
Critty, looking forward to the interview, looking forward to watching it, looking forward to you being back in the chair on Monday and talking us through what you've learned. Critty Gupta at the Bank of Spain. So we're nearly done. What a week it has been. I think we all deserve a weekend. I think that probably is what is coming next. Jack Draper's playing, I think, in the quarterfinals at Indian Wells, but the weekend is all about but one sport. And that is, I think so England have got to beat Wales with a bonus point, and then I think the Scots have got to beat the French for England to win the Six Nations. Ireland?
I'm sorry, Guy. France are going to win it. I mean,
they probably are. I will admit. But Ireland, the Grand Slam was on.
I know. Look, do you know this would have been the first time ever since the Six Nations started that the same nation has won the Six Nations 3 years in a row? It's actually been such variety. Obviously, we haven't had Six Nations for just over 20 years, I think, since Italy came in. But I came here to celebrate the Grand Slam, and then last Saturday got ruined. I've got a day booked in a pub to watch rugby tomorrow, and then I fly out tomorrow night, meant to be mid-celebrations, but instead I'll be drowning my sorrows.
What about St. Patrick's?
Well, that's why I'm flying back in time.
It's Monday.
So I get back. I'm actually missing the parade in Singapore. They do a mini parade in Singapore, but it's on the Sunday, so I'm arriving back too late for that. But I will be there to celebrate it on Monday, definitely.
Have you been doing this splitting the G thing? It's that TikTok challenge with the Guinness,
I only heard about it this week. Like, apparently...
That's just like the sort of natural thing for Mark to do anyway. He's been doing it for years, probably.
He goes past the G.
No. But, I mean, what a great marketing campaign. I only heard about it this week. It hadn't quite hit Asia yet, but I'll bring it back next week.
I'm sure you'll introduce that cultural phenomenon. As I say, tennis is going to be good. I think there's Formula 1 this weekend as well. A lot going on. We all deserve a rest. Sit in front of the telly.
I'm not sure it's going to be restful, and then we go straight back into retail sales and FOMC next week. Busy one again. It's fun in these markets. I love it.
It is. It's interesting. We're in the volatility business, and there's certainly plenty of that. That is it for the opening trade. Have a great weekend, folks. The brief is coming up next. Mark, thank you very much indeed. Mark back in Singapore safely next week. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
There is
Is this real momentum from Wall Street? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. The less bad option, Senate Democratic leader Chuck Schumer walks back his government shutdown threat. Bouncing back, stock futures rebound after the S&P entered correction territory as those shutdown risks fade. And Washington quietly tightens Russian sanctions as it continues to seek a ceasefire deal. President Putin says, let's talk. Well, it's official. We got a correction. We are now down 10 1/3% from an all-time high, which I would remind you was only 16 trading days ago. That is the fastest correction, the 7th fastest correction since 1929. I don't want to tell you what the other examples are of those quick corrections because they will make you upset to know that we're basically at COVID and financial crisis levels. But we tried to rebound this morning, up about 0.7% for the S&P. NASDAQ 100 futures tries to make it 1 whole percentage point higher. We are on track for the worst week in 2 years when SVB collapsed. Bonds did what they were supposed to do yesterday. They rallied. We are giving ever so slightly some of that back this morning, higher by a basis point on your 2-year yield, your 10-year yield. That is higher by, let's call it 3 basis points. We'll round up to 429 is where we stand on that. Gold trading at a record high, $2,993 an ounce for your gold price this morning. Some individual stocks we're also keeping an eye on this morning. Kering having a rough go of it in the European trade, falling this morning, down more than 13.4%. It caught investors off guard. It had a surprise announcement of an appointment of Gucci's new artistic director. The issue is that investors had expected a high-profile external hire to lead Gucci in a new direction. Instead, they promoted from within. UniCredit, that's also on the move this morning, up 1.5%. They obtained regulatory permission from the ECB to own up to 29.9% of Commerce Bank. That does confirm an earlier Bloomberg report. It's extending its decision on whether to seek an acquisition of Commerce Bank, quote, well beyond the end of 2025. Finally, rounding things out with the pre-market mover for you, DocuSign up 10.8%. Its fourth quarter results beat expectations and gave a billing outlook that is seen as largely positive. Well, we've got a great show coming up for you. In just a few moments, we're going to catch up with Monica Defend of Amundi. Later in the hour, we will be speaking with Jack Caffrey of JP Morgan. Now, Amundi's Monica Defend is looking outside the U.S. as the S&P 500 slips into a correction, writing, quote, we believe the awaited correction in areas of excessive valuations in the U.S. equity market may continue, leading to a continuation of the recent rotation in favor of Europe and China. I'm pleased to say that Monica joins us now. She is the head of the Amundi Investment Institute. Monica, good morning to you. Thanks so much for joining on a very volatile week. So how much more pain could there be to come in this U.S. equity market?
Maybe it might continue until April. The reason being the decision on tariffs will be disclosed by then. So we hope that at least some kind of certainty will be there starting from April the 2nd. And then it will be the first 100 days term of presidency. And probably this is the time where Trump has to stop blaming the Biden administration on the job done on the U.S. economy. So probably April will be an important signpost to decide whether to reposition the portfolios.
And to be fair, Howard Lutnick was on Bloomberg Surveillance yesterday saying the entire first half of the year might be something that is the Biden economy. Monica, April 2nd, we get that reciprocal tariff deadline that you've been talking to. Just as it stands, are markets appropriately priced for that event risk?
Well, you know, there is just so much uncertainty, and this is detrimental to the markets, and this is what the markets are pricing in. They really don't know where the story on tariffs is going to end, and we are all running under scenario analysis. I'm just back from the ECB Watchers Conference, and this was one of the key takeaways. Please have scenario analysis in the kind of assessment we are doing to macro and markets.
Well, let's do some scenario analysis, but specifically on Europe, because that quote I read from you at the beginning, Monica, said that not just the U.S. sell-off is going to continue, but the rotation into Europe. Can that rotation continue if we get a President Trump who threatens things like 200% tariffs on some European goods?
Well, we do think that the rotation will continue as the S&P 500, the U.S. market, still remain overvalued. And in Europe, there are some nice domestic stories. If you think what Germany might deliver next week, there might be really an idiosyncratic story here in Europe that can lift equities higher on the back of good fundamentals still. Having said that, it is true that tariffs are going to threaten certain sectors in the market.
So what would you stay away from, Monica? What is not a buy as the rotation continues? Where are the value traps?
Well, for the time being, we stay into Europe, into Asia. I think that China is underestimated by now in the stories. What they are doing there might be deploying further value in the days to come. India. So probably I would stay in Asia. Gold, the level we've seen are definitely high, but gold is a good hedge under these market circumstances.
When it comes to hedges, George Salavelos of Deutsche Bank pointing out an interesting fact, as he has been over the past couple of weeks, that usually when U.S. risk is selling off, the dollar is something as a haven. That hasn't been working out. And Monica, you point to this as well, that the dollar has been sinking in favor of euro strength. Is a structural change happening in this market? What reverberations comes out of a dollar that doesn't hold off as the rest of risk sells off?
Well, we did some analysis on this front, and we need to distinguish whether the fear is on inflation or if it is on growth. And notably, when the uncertainty and fears are related to growth, this is when the U.S. dollar tends to lose it's a safe haven future. And this is exactly what is happening on the back of a more of the idea that we had this depreciation trend in mind of the U.S. dollar based on the asynchrony of the monetary policy stance between the Fed and the ECB.
What does this do to U.S. equities, Monica? Because presumably, if you're holding an unhedged position, if you're an international investor, not in the U.S., let's say you're in Asia, let's say you're in Europe, and you want to hold U.S. equities and you have an unhedged position, it's that much more painful. Is there a flow story happening too, that you are discouraged and you are punished as an international investor to hold the U.S., and that might be part of what we're seeing?
Well, honestly, I would say that valuation needs to be backed up by good fundamentals, and this is what investors should look at, and this is what, in any case, is relevant in the U.S. market nowadays, and this is why what we do believe is happening is not a capitulation, but just a rotation from something that is overvalued in something that is better valued in the market.
So, Monica, to be clear, are there any growth fears being embedded in the U.S. sell-off, or is it just a rotation based on valuations?
Let's see the first quarter GDP numbers that might prove to be weak, but today we don't see a recession kicking in the United States, nor at economic or at corporate earnings sector level, and this prevents us to call for a capitulation, but still believe in the rotation story.
Monica, that's the kind of good news we need on a Friday. Thank you so much for joining us this morning. Monica Defend of the Amundi Investment Institute. Let's get you some other stories now that are trending on the terminal. NVIDIA supplier Hon Hai posted a surprise drop in earnings. That was after weak Chinese iPhone sales eroded margins. But the company does expect AI-related revenue to double this quarter, driven by demand for NVIDIA chips and AI servers. Analysts are now expecting that demand to help revive Hon Hai's top line. Elsewhere in Asia, Chinese stocks rallying the most in 2 months. Officials are planning to hold a press conference on measures to boost consumption. This includes subsidizing a consumer trade-in program and strengthening the social safety net. Now, the details on the plan do remain scarce. Some analysts have recommended buying consumer stocks. Now, an American Airlines plane made an emergency landing at Denver International Airport after reporting engine vibrations. The FAA said that while taxiing to the gate, the engine then caught fire and passengers were evacuated using the aircraft slides. 72 passengers and 6 crew members were safely evacuated, with 10 people suffering minor injuries. I'll tell you, we do not need any more stories like that. Coming up on the show, Democrats in discord as government shutdown risks fade. We'll give you the latest on that in a brief coming up.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
For Donald Trump, a shutdown would be a gift. Right now, Donald Trump owns the chaos in the government. He owns the chaos in the stock market. He owns the damage happening to our economy. It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
Senate Minority Leader Chuck Schumer confirming there that he would back the Republican spending bill and avert a government shutdown. Not all Democrats agree with the decision, though, to allow the government's agenda to move forward.
I think that what we need right now is a united Senate Democratic caucus that can stand up for this country and not vote for cloture and not vote for this bill. And I cannot urge enough how bad of an idea it is to empower and enable Donald Trump and Elon Musk in this moment. It is dangerous and it is reckless.
Whoa. For more, we are joined by Bloomberg senior editor Bill Ferry. So, Bill, is the government shutdown avoided for now?
Most likely. I mean, we still have to see the Senate take that vote. Chuck Schumer saying that he'll let Democratic senators vote their conscience, but I think he's clearly trying to lead them where he wants them to go by saying that he's going to vote in support of it, that he doesn't want to see the government shut down. But that imagery you put forward there with Chuck Schumer and Andrea Ocasio-Cortez really highlights the divide in the Democratic Party over how to go forward. Democrats really struggling, I think, to come up with a message to counter Donald Trump, and some seeing this fight over the continuing resolution to fund the government through September as being one way of doing it. We'll get the final vote probably on Friday, but it looks like it's going to pass for the Republicans.
When it comes to market implications, Bill, the one thing that this market has been wanting, along with the bad stuff from Trump, is the good, i.e. tax cuts and that sort of agenda. Does this portend well for the Republicans and their ability to get some of these legislations through and their ability to get tax cuts also through Congress later this year?
Well, I think the interesting thing we've seen so far is the divide among Republicans over how you go forward with tax cuts, what the priority is. You have, particularly in the Senate, you have a group that really wants to see the 2017 Trump tax cuts made permanent. Those expire at the end of this year. That is a priority for some. Others want to go into the things that Donald Trump campaigned on last year, including no tax on tips, no tax on Social Security payments. By and large, people on both sides of that debate kind of agree that they can't do it all at once. So there's going to be a big fight coming forward over that. I don't think the Republican unity we're seeing on this continuing resolution is necessarily something we're going to see when it comes to tax cut policy.
Speaking of fights being taken up, a judge ruled yesterday, Bill, that the U.S. government needs to reinstate the 30,000 probationary workers that DOJ let go. What sort of fight are we gearing up for here in terms of allowing these DOJ job cuts to go through?
Well, this is part of the real turmoil that I think a lot of Donald Trump supporters aren't unhappy to see when it comes to the federal government workforce. It's already been very disruptive for them. You've had people sent home. You had people who thought they were fired, then get rehired, and then perhaps even get fired again. So I think it shows that there's just going to be a lot of turmoil. If you are one of these employees, you're going to either be living with a lot of uncertainty if you try to stick with your job, or you're going to give up at some point and start looking for other options.
Yeah, a lot of back and forth. Bill, thank you so much for today and all this week. That is Bloomberg's Bill Ferries. Now, quick check on markets this morning because we are attempting to bounce back. If we are unable to, and if the losses of this week hold, it would be the worst week in 2 years since SVB's collapse. S&P 500 futures up about 0.8%. Your U.S. dollar, little change. Meanwhile, 10-year yields move higher by 3 basis points after rallying yesterday with risk doing worse. Okay, coming up, BMW looks at $1 billion worth of a hit from the trade war. We're going to have more on Oliver Crook's interview with the CEO. That's coming up next.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow,
you're going to have a much more inflated debt to GDP and federal deficit. And that's not good for the economy. Growth is really critical. And I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Wednesday, the Fed decides.
People just want clarity. Business leaders want clarity. Investors want clarity.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
What do they need to see to have confidence in the forward trajectory?
Could our big surprise be a growth slowdown?
What's worse than an economic slowdown? An economic slowdown the Federal Reserve can't respond to.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at some of the front pages across the world this morning. First up, the Washington Post has this on their front page, that Russian President Vladimir Putin is setting tough conditions for the U.S. ceasefire proposal. Conditions include demands that the U.S. halt military supplies and that Kyiv not use the pause to strengthen its defenses, rearm, or mobilize. The U.S. has also tightened sanctions on Russia by restricting payments for energy. Next up, Reuters leading with China, Russia, and Iran calling for an end to sanctions. This comes after Tehran spurred President Trump's call for negotiations. The three countries emphasized the need for political and diplomatic engagement and dialogue based on mutual respect. And on the Bloomberg, BMW's car-making profits will lag well below its long-term targets this year. BMW is facing challenges, including declining sales in China and escalating trade tensions threatening U.S. deliveries. Joining us now for more on this story is Bloomberg's Oliver Crook, who spoke with the CEO earlier today. Oliver, what were your takeaways from that conversation?
So listen, Danny, this is been a very challenging year for the auto sector in 2024. There's no way around that. We've seen that really across the board, but really that's the case for BMW, which basically spent a huge amount of money last year developing their Neue Klasse. These are the new range of EVs that they're going to start production at the end of this year. And we've seen the evidence of that in their margins. So just to say what they did in terms of margins last year, came in at 6.3%. That is pretty low compared to anything that you expect from the luxury sector in the auto market, what you expect from BMW. The year before that, it was closer to 10%, and now they're guiding forward to this year that the margins are going to be stuck basically between 5 and 7%. That is down in part, Danny, to this slowdown in China. That really accelerated in the back half of the year. But listen, that's not all it. It's not just looking back, it's looking forward. There is this question of tariffs. So I spoke to the CEO a little bit earlier, and I wanted to know what the impact would be of the tariffs that have already been announced. Have a listen to what he had to say.
We don't think that all these tariffs will last for very long. Some of them might last a little bit longer, but we accounted for that with 1 billion euros in our guidance. So from that point of view, we're quite safe. But at the same time, we of course fight for free trade because. If you overdo it with tariffs, it sends a negative spiral to all market participants. So there is no winners in that game.
So, Danny, what's interesting here is that basically these are just the tariffs between Mexico and the United States that he's referring to. The BMW makes their 3 Series in Mexico. They're not USMCA compliant, so they need to pay tariffs. The cost for them is 1 billion euros. That has nothing to do with these possible reciprocal tariffs that are coming in April. And I have to say, I'm not sure that I share the CEO's optimism that the tariffs will not be there for a very long time, just given what we've been hearing from the Trump administration over the last few days.
Oliver, I thought that was really fascinating, too, his optimism there. And we have had more escalation of a threat of 200% tariffs on various European alcohol. We get the deadline, April 2nd. How at risk does Europe seem of getting caught in a more escalated trade war, just given what we've heard over the past 24 hours?
What I think is interesting is that, you know, the European approach has been very different, and this is something that was laid out by Howard Lutnick in the interview that we had with him yesterday. It's been very different from, say, what the Japanese, the South Koreans, and the UK have been doing, who basically have not really struck back on the United States. They're taking their time. They're going to negotiate with just basically the tariff coming one way. The Europeans have pushed back. Part of the reason they can do that is the trading relationship between the EU and the United States is $1 trillion, right? This is a huge trading relationship, about a 250 euro surplus from Europe, and that's really what Trump wants to adjust. They see themselves as in a position to potentially be able to negotiate further. But listen, looking into this and looking at these companies in Europe are going to be very, very affected by these tariffs if they come into fruition. And the fact of the matter is, the Europeans just do not have as much power to push back against the United States as they do because of that trade imbalance. So listen, we're going to continue these negotiations, but at the end of the day, I don't really see right now how you get around those trade negotiations, how you get around those tariffs, particularly for the auto sector. And again, when we think about where all of this pain is going to be localized within Europe, it really hits Germany the most. And this is a Germany that right now is still in political upheaval, don't know if they're going to get their debt break reform through. And this is sort of all of the sort of long worry list of problems for the German economy as well as the broader European economy as well.
Oliver, just quickly, where do we stand on that, on Germany's spending plans? Does it look more likely to come to fruition?
Listen, I think it's still sort of, we still are having this debate between the Greens and the CDU about whether or not they're going to back this proposal. We will really find out on Tuesday whether or not this goes through. If, however, Danny, this is one point that is important to make, the CDU and Friedrich Merz, the sort of chancellor-to-be, fails to get this over the line. He's done a lot of gambling in the last couple of months. If he fails to do this, I think that his chancellorship could be in question. We'll have to see where it progresses over the weekend. We may have some big news on Monday.
Oliver, thank you so much. That is Bloomberg's Oliver Crook in Berlin. Coming up on your brief, we're going to be catching up with JP Morgan's Jack Caffrey on what he calls an atypical sort of growth scare in markets. U.S. equity markets attempt to rebound after falling into a correction yesterday. This is Bloomberg.
drive productivity and improve efficiency, Prudential has made significant investments in data analytics and artificial intelligence. Janella Frias plays a key role in integrating these tools into the company's processes.
We always need people. We're in the people business. But more and more, if we really want to provide the right customer experience, fast access to products, it's about technology. Technology has always been an enabler. Now it's a strategic differentiator.
Give me a sense of AI in Prudential. What are you experimenting with?
A few areas. One is around customer experience. In our individual life business, our underwriting process has gone from about 20 days to minutes. In our group business, we have partnered with a number of different fintechs to really improve customer experience, to bring on board capabilities, things like claims management, where we can process a disability claim faster and help people get to work faster.
How much productivity uplift are you getting and will you get?
We're probably getting 10% at this point, but I think over time that is where the value is, and it will then allow us to take our capacity in the form of people and redirect it to more value-add activities.
In a nutshell, it means turning the menial into meaningful. It can be both a huge saver of time, but it can also provide real insight.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Bouncing back, stock futures rebound after the S&P 500 enters a correction as the risk of a government shutdown fades. Warnings from the autos, BMW and Tesla sound the alarm on the impact of the escalating global trade war. And Washington quietly tightens Russian sanctions as it continues to seek a ceasefire deal. President Putin says, let's talk. So we attempt to rebound this morning. Will it stick? We're up nearly 1% for both Russell 2000 and NASDAQ 100 futures. By the way, this correction happened in only 16 trading days. 16 trading days ago, we were at an all-time record. Things have changed very quickly, but at least your bond market is working. When S&P 500 was selling off yesterday, bonds were rallying. The opposite happens today. Your 2-year yield, that is up a basis point. Your 10-year yield up 2.5 at 429. Gold is also at another all-time record, just below $3,000 an ounce. By the way, we're going to get University of Michigan Consumer Sentiment Survey out later today, so that is another data point for you to look out for in the middle of a Fed blackout period. So yes, we are down 10.33% from the high. JP Morgan's Jack Caffrey weighing in on that recent stock rout, writing, quote, what it seems we are experiencing is not a growth scare, but a growth scare rather, but not the typical sort of growth scare that has been making equity-oriented people so twitchy. Instead, what might be moving to the fore of traders' mind is the ability to grow and the profitability of that growth. Joining us now is Jack Caffrey, equity portfolio manager at JP Morgan Asset Management. Jack, I just wanted to make sure I got my words right, because I know you think this is an atypical growth scare.
It is
not a normal one. Just describe what that is.
Well, if we think back like our sort of standard academic recession, the Fed raises rates too much, the economy slows, and then you wind up having to work off inventories. This is not what we're experiencing right now. This is a rollback perhaps to some of the rolling recessions that we would have seen in the late 1980s, early 1990s. Effectively, one created more by fiscal uncertainty rather than monetary uncertainty. If you have a contract and your contract is canceled, thanks to a review of government spending, how do you find new customers? How do you grow in that world? What happens to consumer confidence when you have tens or hundreds of thousands of workers worrying about the safety of their job? And so this is a case of, you might ask, when government spending is, call it 18% of GDP, government funds a lot of healthcare. Healthcare is 16, 18% of GDP. You're effectively walking through, how do I grow in this environment if traditional growth engines are stepping to the side? Then you would expect the corporate sector to step up, and effectively that, I think, is implied when you talk about taking government out of the GDP statistics. Well, let's see what corporate sectors are doing, what happens with either consumption or investment spending. If you look within the equity market, some of the most oversold parts of equities are autos and consumer services. So modest ticket and big ticket spending, confirmed by some of what airline CEOs were talking about of a dramatic decline in traffic, either business or leisure. And so investment is, how do I spend? Where do I put my plant? Can I get power? Can I get the workforce that I need to try to support the growth aims that we wind up working through? How quickly can we rewrite zoning laws? So it becomes much easier for a CEO to perhaps sit on their hands, evidenced in like the NFIB surveys or some recent CEO confidence surveys. What's their outlook? I don't know. Not a great answer for how do you actually plan a growth trajectory.
It certainly isn't, but something that has really been underpinning this market is future growth prospects. And I'm thinking specifically for tech here, this idea that tech had huge future growth prospects. Do we need to rewrite that too, or are you just talking about more sort of the consumer, real economy focused companies?
Well, like the consumer real economy is 70% of the economy. So we can't really ignore them because if they go down 2%, that really offsets an investment account of, call it 10, 12% of the overall economy. Math is unfortunately problematic in that regard. Not that I was great at it, but okay. I think your flip side, though, is some of that growth that we expect out of technology companies winds up being tied back to capital spending. When technology fails, it tends to be that the supporting ecosystem around that technology isn't ready. Right now, we're dealing with what do we do about power? How do we fuel power? There's a push to put data centers in a large southern state, which historically has had a great friendly regulatory environment. And they're talking about having a bill where in the event of a power crisis, read middle of summer or middle of winter, we're going to unplug the data centers. That doesn't really bode well for corporate confidence to let me spend a couple $100 million or $1 billion in the middle of that state.
So what would you be willing to pay up for in this world where growth looks a little bit more
I do think,
and things normalize?
Broadly, the market loves certainty. And unfortunately, right now, we have a high degree of uncertainty, which can change by the hour, by the tweet. And I think that's a challenge. Tell us what the rules are. Corporates do a great job of adapting to that environment. And what we operate with now is we don't really know what we're working towards.
So just to put a finer bow on this, are you basically saying that the government is trying to engineer this rotation away from public to private sector, but that can't happen until there's certainty?
I think the corporate sector needs a better sense of what the world looks like before they can move forward with their investment decisions, their hiring decisions, their growth plans. Where should I locate my production? I mean, 40% of S&P revenues are generated internationally. So you do have to wonder what the reaction is outside of the United States in terms of some of these policy decisions. We import 30% of our lumber. So what happens to housing prices when you put a 25 or 50% tariff on lumber? Where's the workforce to actually engineer a construction, an underbuilding of residential investment over, call it the last almost 15 years now? The more you have to spend, the more certainty you actually want to try to get to that.
Right.
Now, where this remains atypical is the bond market seems to be very confident that all those checks are going to clear when expected, whether they're interest payments or paychecks. So I don't think this turns from correction possibly into something deeper or more painful. But again, I'm relying on my fixed income colleagues and their, I don't want to say paranoia, but their discomfort with, I want to get paid, to saying that they really aren't worried about not getting paid.
I mean, and this high yield corporate credit has held up pretty remarkably well. You are starting to see spreads widen, though. High yield spreads are about the widest since August. Do you expect that to maintain?
Yeah, but widening to August is sort of like saying...
But I want to ask about using that as a signal, because this bond market has gotten more healthy, maybe as a factor of more of it moving into private credit, higher quality in general. Can you really use that as a signal that you once did, that everything is calm and cool, if just by its very nature, structurally, it isn't as risky as it once was?
It's still somewhere between the risk of a treasury and the risk of an equity. So it's a signal. We can look at gold, we can look at crypto, we can look at oil. Economic surprises turned down 6 weeks ago. The 10-year yield turned down 6 weeks ago. Corporate spreads began ticking higher, call it 2 weeks ago. Effectively, okay, I need to actually get a little bit more compensation, but am I seeing corporate spreads widening, or am I seeing my benchmark yield actually falling? So you can't look at any one of them and say, that's the answer. It's effectively assembling, what hopefully becomes a beautiful mosaic of data points saying, which way do I want to lean? Over time, I want to lean into equities because I think that gives me the best protection of purchasing power over the intermediate to long term. Can we have stumbles along the way? Certainly. Are we stumbling right now? Yeah. I mean, it's 5:30 in the morning, so it's still dark here in Manhattan. We just set our clock back, and I still haven't quite gotten used to that. But I do think, markets are pricing out risk in a fairly efficient practice. The fact that we have so much automated trading means you're going to get shorter, sharper corrections. And the pain has been not to say fully, but largely concentrated in those companies that had the highest expectations.
Yeah. Well, Jack, thank you for fighting the darkness, fighting the daylight saving, for the beautiful mosaic that is your thoughts this morning. Jack Caffrey of JP Morgan Asset Management, thank you so much for joining. You're watching Bloomberg Brief.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
For Donald Trump, a shutdown would be a gift. Right now, Donald Trump owns the chaos in the government. He owns the chaos in the stock market. He owns the damage happening to our economy. It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
Senate Minority Leader Chuck Schumer confirming there that he would back the Republican spending bill. That decision allows the government to move forward with its agenda, even though there is an opening of a rift within the Democratic Minority Leader's party.
I think that what we need right now is a united Senate Democratic caucus that can stand up for this country and not vote for cloture and not vote for this bill. And I cannot urge enough how bad of an idea it is to empower and enable Donald Trump and Elon Musk in this moment. It is dangerous and it is reckless.
Whoa. For more, we're joined by Bloomberg government reporter Jonathan Tamari. So, Jonathan, have we avoided a shutdown?
Almost certainly. We will know for sure probably around 1:15 this afternoon, maybe a little after. The Senate's going to have a vote, a procedural vote to get the process started to vote on this budget bill. But Senator Schumer saying he's going to vote for it. The House has already passed for it. I don't think Senator Schumer is going to vote for this unless the votes are there within his Democratic caucus to help this bill get over the finish line. We're pretty much there. We'll know for 100% early this afternoon.
Jonathan, In getting this through, is there any read-through for debates that are currently ongoing and are going to pick up more steam, specifically tax cut extensions? Does this bode well for the Republicans in their ability for cohesion and to get it through Congress?
It does, because if this bill had not passed, the Republicans would be stuck trying to figure their way out of a shutdown, trying to negotiate with Democrats on their way out of a shutdown. There was possibility that there would be another short-term spending bill, which would mean another several weeks spent focused on that instead of the tax cuts. Once this bill passes, the Republicans have taken care of most of their major must-do things for the immediate timeline here, and that gives them time to focus on the tax cuts, focus on the border bill they want to pass. With one key exception we have to keep an eye on: the debt limit will come up again sometime soon, could be a matter of months here. So that is another looming thing out there, but that's not as immediate as this shutdown threat at the end of today.
So one deadline passes. We have more deadlines coming up, specifically the one of April 2nd. Jonathan, I would just love to get your read on whether it seems like we're headed for something that looks more like escalation following Donald Trump's postings yesterday about applying a 200% tariff on various European goods like alcohol. Does it seem like April 2nd that this is a retaliatory deadline tariff deadline that we need to be taking seriously?
Well, I think we need to take it seriously, but also realize that that could change at any minute. We need to take it seriously because President Trump has, in fact, imposed many of the tariffs that he has threatened. At the same time, we've seen him make threats in the morning of one day, and by the end of the day, change his opinion, change his position. So it's something you need to take seriously, but it's also not locked in with this presidency. As we've seen, things can change within a matter of hours, let alone a matter of weeks. So he's willing to do it. He's also willing to back down. He's very transactional. He's responsive to often the last person who spoke to him. And if the markets continue to fall, I think that's also something that will eventually build pressure on the president. So watch for it. But I don't think anybody, as your previous guest was saying, I don't think we know for sure what the president is going to do from hour to hour, let alone week to week.
Yeah, this week certainly proving that. Jonathan, thank you so much for getting up early for us. That is Jonathan Tamari in Washington, D.C. Now, elsewhere, President Putin says that he supports the idea of a U.S. brokered Ukraine truce deal, but wants to discuss the details with President Trump. Doubts still linger in Ukraine.
We need to discuss it with our American colleagues and partners. Maybe call President Trump and discuss it together. Overall, we support the idea to end the conflict by peaceful means.
Putin is essentially preparing to reject it at this moment. Of course, Putin is afraid to tell President Trump directly that he wants to continue this war, that he wants to kill Ukrainians.
Joining us for more is Bloomberg Russia editor Greg Sullivan. Greg, what does it seem are Russia's terms in order to agree to something that looks like this ceasefire?
Right. So clearly, Putin was making comments that were signals to President Trump, trying to keep President Trump engaged. A lot that we have seen so far has been a lot of pressure from the White House on the Ukrainian side, very one-sided in that, and Putin wants to keep him engaged. But all the while, he's still been making demands about what he wants in order to get to the ceasefire table. One such demand that we've learned is that he does not want weapons to be provided to Ukraine during the course of a ceasefire. And then for a more longer-term solution, which we heard him say last night that he doesn't want a temporary truce, but only if it leads to a longer-term solution, he's made some very serious demands that Ukraine is likely not to accept, such as no NATO membership for Ukraine, no NATO troops on the ground in Ukraine as part of a peacekeeping force. So significant demands from him.
Are those demands that the Ukrainian side would agree to, Greg?
It's very hard to see them accepting those demands. President Zelensky has spoken a lot about security guarantees, about the need to protect Ukraine and have a deterrent force to prevent future Russian aggression, to keep these hostilities from resuming down the course. Yet Ukraine is in a tough spot. Well, Zelensky has a very tough relationship with President Trump. We saw that in the White House meeting. The U.S. has been heaping pressure onto the Ukrainian side with the suspension of military aid and intelligence sharing, even though that was now lifted after they agreed to the outline of a 30-day ceasefire. There's no doubt that the pressure has been very intense on the Ukrainian side. And there's also questions about their ability to keep fighting for how long in the absence of U.S. support. So it's a tough line for Zelensky to walk, but these are certainly not demands that he will be happy to accede to.
Greg, thank you so much for the update. That is Bloomberg's Greg Sullivan. And don't miss our upcoming interview with NATO Secretary General Mark Rutte this morning. That's at 7:30 a.m. Eastern Time. Now, a global trade conflict is still at the top of mind for corporations, even as earnings continue to trickle in. Bloomberg's Oliver Crook spoke with the CEO of BMW earlier. Take a listen.
We don't think that all these tariffs will last for very long. Some of them might last a little bit longer, but we accounted for that with 1 billion euros in our guidance. So from that point of view, we're quite safe. But at the same time, we of course fight for free trade because if you overdo it with tariffs, it sends a negative spiral to all market participants. So there is no winners in that game.
Let's bring in Bloomberg's Craig Trudell for more on this. Craig, the BMW CEO saying there that he doesn't think that tariffs will last that long. Just how ready is the European auto industry for April 2nd when we get retaliatory tariffs coming in? Reciprocal tariffs, rather.
Yeah, I mean, I think I sympathize with these CEOs having to try and offer up some sense of what the cost will be here, because I would not be surprised if, on a day-to-day basis, we've seen, billion euro swings in terms of, the estimated impact that these policies will have on these companies. From one day to the next, just going back to the conversation earlier about, the fact that President Trump, can start a morning with one position and sort of end the day with another. I think there's real serious concern among the European car makers about, in particular, the possibility of April 2nd, the 25% tariff on European goods, because while BMW is somewhat insulated with a great big plant in South Carolina, they do have a fair amount of their vehicles that they sell in the U.S. that are imported from Germany. And you have other brands among the European car makers that aren't entirely reliant on imports. You think about a brand like Porsche that would be heavily impacted by this. And so there's real concern about bracing for that date around the corner.
Craig, this was also an interesting one, that Tesla issued an unsigned letter to the U.S. trade representative saying that it is exposed to retaliatory tariffs. How should we interpret this for a company whose CEO is so close to the White House?
I think it's very telling that it was unsigned, especially given the fact that, Elon Musk has, not shied away from, I guess to use the word retaliation, doing so against his own employees. I think he's had to take a position, of course, of being, no matter what, be supportive of the president, given the role he's playing in the administration. But I think to the comment that we just heard the CEO of BMW make, this idea that there's no winner in a trade war, I think Tesla speaks to that in the sense that you're going to see other countries sort of get their back up, that trade wars sort of stoke nationalism. We will see that have an effect on Tesla, and I think that is likely playing at least some role in the slow start to the year that the company is having over here in Europe. To see just this week also in Canada, the province of British Columbia, taking action against Tesla products. You're going to see, as a result of the Trump administration taking a more sort of hardball trade approach, that other countries are going to take that out on American products. And you may not even necessarily have to see tariffs, retaliatory tariffs put in place. You'll see that nationalism reflected in the way that people shy away from American products whether the Trump administration, intends for that to happen or not.
Yeah, you've already started to see some of that come through in European Tesla sales. Craig, thank you so much. Bloomberg's Craig Trudell there. Coming up, we're going to wrap up the week with some economic data. We'll set you up in your day ahead next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Friday. The University of Michigan Consumer Sentiment Survey, that will come in at 10 a.m. Eastern. Today is also the deadline for U.S. lawmakers to strike a spending deal that avoids a government shutdown. Then Congress is in recess for all of next week. Of course, there's more potential for some various posting that makes markets volatile, though it is a Fed blackout period. Let's just get a check on this equity market as we head to the break. NASDAQ futures at the high of the session up 1%. It's after the S&P 500 in just 16 days fell into a correction. That's one of the fastest movements into a correction over the past couple of decades. Your S&P 500 future session up about 0.7%, as gold also hits another all-time high. All right, that is it for Bloomberg Surveillance on this Friday morning. Surveillance, that is up ahead. This is Bloomberg.
what legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice then to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Tariffs are bad for growth and bad for inflation.
We're starting to see some elements that could portend to a higher inflation environment over the coming months. One of the key factors, of course, is going to be this rise in tariffs.
The prospect of tariff wars that could last is very concerning.
What will be a problem certainly would be if tariffs are on the maximalist side of things.
It's not that the market can't react to a tariff if we understand what the details of the tariff are. It's that there's so much uncertainty.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, looking forward to the weekend. Equities down 10% from all-time highs and heading towards a 4th consecutive week of losses as investors worry about policies coming from the White House and President Trump showing very little interest in changing course.
Any chances that you will ban on the tariffs on the aluminum and the ones that are planned for April 2nd?
No. You are not going to change your mind.
No, look, we've been ripped off for years, and we're not going to be ripped off anymore. No, I'm not going to bend at all. Aluminum or steel or cars, we're not going to bend. We've been ripped off as a country for many, many years.
As the president promises more tariffs, equity futures are finding some relief this morning as the nation's capital gears up to avoid a government shutdown.
It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
So, Lisa, some good news. That move potentially opening the door to tax cuts later this year.
Yeah, opening the door to at least the government functioning, remaining open past the end of the day today. A real question here, though, of what this means in terms of where the fight will get directed from the Democrats to the Republicans, or whether they just have no leverage at all. I mean, they're basically talking about setting up for maybe a fight to Social Security cuts and Medicare cuts and Medicaid cuts and things of that nature later on this year. We'll see. They have to get their party together because they're facing a lot of dissent as well.
That's the politics. As for the economy, I've got no idea where the economy is going to be a month from now, 2 months from now, 3 months from now. This was the first week. I think this was a really important week. Never mind all the speculation about what might happen, what might not happen. Delta Airlines coming out and saying the damage is done. the damage is being done. That stock, that name is down for 6 consecutive days. And over that period, it's down more than 20%.
And it's the pace of declines, the fact that we saw it really pick up mid-February. And as Ed Bastian, the CEO of Delta, said, it's been a parade of horribles. And we heard the same kind of tone from JetBlue and American Airlines and United. And Sheila Kahyaoglu came on earlier this week, and she said that they've been seeing it in the raw data. They expected this. So now the question is the data moving too quickly for us to assess it until it's too late? And the market is sniffing that out.
More data a little bit later. You mentioned consumer sentiment. Very, very partisan, driven by your political party and your political beliefs, but ultimately it's something the Fed's going to be watching going into next week.
And potentially even more than some of the hard data because of the quickly moving aspect of this economy. If sentiment falls off a cliff, even though it's 500 people who are politically motivated, does that lead to the market reassessing the potential for some sort of downturn going forward? I do think, putting aside UMISH and all the hair around it and all of our snarkiness, there is a question about whether sentiment surveys have renewed importance at a time where that sentiment is driving consumer behavior that we're actually seeing and hearing about from CEOs.
Bond yields higher this morning by 2 or 3 basis points. Equity futures up by 0.75%. Joining us this hour, coming up on the program, Chris Ferrone of Strategas with stocks down 10% from record highs. Jessica Taylor of the Cook Political Report as Democrats blink. And Ed Yardeni of Yardeni Research cutting his S&P 500 year-end target. We begin this hour with stocks looking to recover after sliding into correction territory. Chris Ferrone of Strategas, a bad company, writing equities are attempting to stabilize in the 55.50 zone. The sentiment conditions are coming together for a rally, but it's usually a day of very strong breadth that screams game on. Chris joins us now for more. Chris, good morning.
Nice to be here.
What a week. What a week. Let's start with that. Are we screaming game on yet?
I don't think quite yet. I think we're in the ballpark of kind of the conditions that we like to see to mark at least some tactical low. And, you know, this last week, again, is a reminder of what I believe is the undefeated rule of Wall Street. It's that attitudes are shaped by price action, not the other way around. And I think in particular, as we entered the year, and we talked about it on this show, the hurdle for 25 would be the game of expectations. The bar was high, and all year we thought the challenge would be chipping away at that bar of expectations. I think we're much closer in that regard today. We've seen just this week a lot of the surveys flip upside down where you have more bears than bulls in a lot of the investor surveys. You've seen this big swelling in inverse ETF volumes, so people buying the short Qs or the short S&P funds. You've seen the VIX curve invert to a pretty meaningful degree. So spot VIX, you know, how you view vol in the future should never be above where you view vol down the road, yet it is right now. So you have these conditions that I think are starting to come together, whether it's 55.50 or 54.50, I don't know, but I suspect we're in the ballpark of some type of a good trading low.
Things are a lot worse than that 10% seems to imply, because beneath the surface, I was going through some of the tech names this morning. Meta down 20% from a record last month, Nvidia down 22% from the highs of this year, Apple down 19% from the highs of December, Amazon down 20% since the start of February. What gives for big tech?
Yeah, not fun, right? Well, I think let's remember a couple things. It's not like DeepSeek happened 6 weeks ago and suddenly tech began to express weakness. Tech, relative to the S&P, peaked on July 10th of 2024. You know what else peaked on July 10th of last year? Dollar yen. So we've talked about this ad nauseum in our work. I think it would be silly to underestimate the impact or the degree to which yen carry for so many years dictated how money moved around the world. And I think in particular, the very large stocks in our index are beginning to see kind of the weight of that. Now, I don't want to forget kind of another undefeated rule of Wall Street. It's that corrections end on bad news. They don't end on good news. If they ended on good news, this game would be easy, right? Markets top on great news and they bottom on bad news. So, you know, as we kind of work through this growth scare, underline the word scare, but I still think it's in the context of a bull market. And one main reason I still feel that way is, despite these kind of very big declines in some of the equities, you really haven't seen an equal response from credit conditions. We did a study this week. We looked at how big is the move in double B spreads off the lows relative to the decline in stocks. So double B spreads right now are up about 30 basis points off their lows, pretty modest. For a 10% decline in equities, you actually historically would expect double B spreads to be about 100 basis points wider. So you've actually seen some relative resilience there in credit versus equity.
Oh, is that signal broken? Is that signal broken because we have a now buffer of private credit that has really shifted some of the credit incoming information from public markets?
So I think no, but let's assume yes for a moment. Let's assume I'm wrong and you're right, and the explosion of private credit over the last number of years is really where the threat of the warning may be. So therefore, I think we ought to look at, what these flag holders in the public markets of private credit are telling us. It's Apollo, it's Blue Aloe, it's Blackstone, it's Ares, and you've had good corrections in those stocks, but in uptrends. I think if we're sitting here in 3-4 months from now and these stocks which are oversold have tried to rally and rally tepidly and don't rally the leaders and roll back over, then I think we can kind of begin to move more towards your view, Lisa. But
it's not my view. I'm just presenting a hypothetical, just throwing it out there.
I just think it's interesting, though. Are we really going to get the R word without credit in mass, public credit really deteriorating?
Well, okay, the R word, right? I love that we can't even say recession. Woo! I mean, there's this question of just putting aside recession, there's a question about whether there's been a structural shift in the overall market flows that disadvantages the United States after advantaging the United States for so many years. You mentioned the peak in dollar-yen, and that has sort of preceded some of these big moves downward in equities. George Saravelos of Deutsche Bank put out a report this morning titled Pain, talking about how European investors in U.S. equities are down some 30% simply because the dollar has not rallied in tandem with the weakness in equities. Is there a structural shift underway?
We think so, and again, I think that structural shift is dated back to when the most important price in the world began to change, which was dollar-yen. It was just congruent with this whole bull market in tech for 12 or 13 years weekend. Now, I think one of the reasons I'm at least longer term, a little bit more sanguine about a lot of this is simply because this weakness in U.S. equities over the last month or two has really not been accompanied with weakness in global stocks. I mean, Europe has corrected here modestly, but it's held up much, much better. The Chinese market has, frankly, held up fantastic throughout all of this. So you're not seeing like the global bear market come together or the global recession come together. Copper is breaking out here. Sure. I think maybe one of the most important charts in the world for your viewers, our Chinese two-year yields are now going up. For the first time in 2 or 3 years, you've arrested the kind of financial crisis message from China, which was just bond yields in free fall. That has changed.
It feels like developments elsewhere, and we were talking about this earlier this week, particularly in places like Europe and again in China, are reducing the so-called risk mitigation characteristics of treasuries. It's interesting that you mentioned what equities have done and what high yield hasn't done. I would look at equities this week. We're down again, and bond yields on a 10-year maturity are basically flat. There are days where it provides me comfort. There are days where it really doesn't provide me any comfort at all. What is the 10-year bond yield telling you at the moment about what it trades on and what it doesn't trade on?
Yeah, it's probably been the hardest call for 2 years, and I think we've all wrestled with it one way or another. And the reality is, for 2 years, we've basically been in a range. There's been no right call. We're sitting literally on the 2-year average of 10-year yields. It's 421 is the 2-year average, and we're basically there this morning. I generally have leaned more bullish bonds. We wrote, I think in yesterday's work, as rates went up on a soft CPI, which is always a surprise, right? We thought the best you would do is maybe 440, 445 on 10s. I ultimately think you will still get a 3 handle on 10-year yields. But there's a pull on the other side here, and the pull on the other side is German 10-year yields look like they want to go to 350, and Chinese yields are going up, and we certainly know Japanese yields. So I think we're kind of in this very unsatisfying moment for global bonds. Again, I lean generally more constructive, particularly on the short end for yields lower. But I just want to make sure I don't get too cute with that call.
We'll just sit on that call just for a little bit longer. Developments in Germany. How big are those developments? How could that change the way treasuries trade? Because typically we think about treasuries driving the global bond market. We don't think about other bond markets doing that to treasuries.
It's funny, I was on your set in early January during Davos, and Christine Lagarde was speaking about how she was peak pessimistic on Europe. And I remember saying to you guys, I want to be a buyer of pessimistic central bankers.
I remember.
Right? And you think about that, why have European equities or Chinese equities, or particularly the cyclicals in those parts of the world, held up better, even as rates have gone up sharply in Germany and sharply in China? I think it's because you have much more accommodative monetary policy, both in Europe and in China. And that's the one difference today with this growth scare that we're going through. This is not the first growth scare of the last 2 or 3 years. It's not the first time cyclicals have corrected, but it's the first time it's happened where you don't really have a Fed that's particularly eager to kind of get back on the easing train. So that, I think, explains a lot of the resiliency ex-US and still a lot of stress here. Like, who gives first? Is it the administration or is it the central bank? I lean towards the central bank, and I think the two-year yield will ultimately get us there, but that's the big debate of the day.
As soon as next week, or too early?
I think that's too early, and you know, John, when you talk about corrections, right, we're down 10. There's a price and a time component to every correction, and when I say that, you know, I think we're probably 80, 90% of the way there on price. I do wonder if the time component is almost still in front of us, where we need to just grind this out, you know, rally, retest. That would not surprise me, kind of given this framework here.
Equity futures this morning, they are positive by 0.75%. Special thanks to Chris Verone of Strategas, a bad company with a more constructive view, Lisa, about where we are right now.
Yeah, the idea that we're still in an upward trend, even though there are these structural shifts going on. His point about who breaks first. I thought this was really interesting from Bank of America's Michael Hartnett. He said, since equity bear threatens recession, fresh declines in stock prices will provoke flip in trade and monetary policy. This is sort of the bet of some of the upward trend that a lot of people seem to have.
It's the policy response to it. That's why we're seeing so many constructive views on Europe and European equities. As I say, equities are positive this morning by 0.75%. Some developments in Washington we'll get to in just a moment. We'll catch up with Anne-Marie down in Washington, D.C. Let's give you an update on stories elsewhere with your Bloomberg Brief. Let's kick it off in Washington. U.S. Senate Minority Leader Chuck Schumer dropping his threat to block a Republican spending bill. The move opens the way to avoid a U.S. government shutdown on Saturday. Schumer's decision sparking division within his own party. Elsewhere, Russian President Vladimir Putin says he wants to discuss a proposed ceasefire in Ukraine with President Trump. Putin says the truce should lead to a long-term resolution of the war. Trump has started discussing outlines of a final agreement with Ukraine. And finally, shares of Kering are falling in Paris, trading after the company appointed a Balenciaga designer to oversee a makeover of its struggling Gucci brand. Investors had been expecting a high-profile external hire. This kind of stuff is brutal. Can you imagine being hard and the stock drops 11%?
I mean, do they really want to see a sweatshirt that has a sequin on it that costs $2,000?
No, I don't want that from Gucci.
Or high-heeled
either.
Crocs.
So you're a big Balenciaga fan, by the sounds of it. Yeah. Or maybe not. We'll bring you an update on that story. A little bit later, we'll get more of Bramo's views.
Let's start.
Up next on the program, Democrats blink.
It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
Anne-Marie in the nation's capital this morning. More from AMH in just a moment. She'll be catching up with Jessica Taylor of the Cook Political Report. From New York City this morning, good morning.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
This right here is a number that Bank of America, Goldman have been looking for quite a while. 3K on gold. Up 0.5% this morning. That is an all-time high. Lisa, we've never been here before.
And what we've seen is an 84% rally since October of 2022, given the fact that people have been piling into gold for both the safety trade as well as a structural trade, maybe just trying to diversify a little bit away from the dollar.
Geopolitics by gold.
Yeah, exactly.
Inflation by gold.
It's pretty much
the list goes on and on, right?
The all-weather trade. And so here you go.
All-time highs on gold through 3K for the first time ever. Equity futures elsewhere positive by 0.7%. Still poised for a fourth consecutive week of losses, the longest streak going back to August. Some good news this morning. Under surveillance this morning, Democrats blink.
For Donald Trump, a shutdown would be a gift. Right now, Donald Trump owns the chaos in the government. He owns the chaos in the stock market. He owns the damage happening to our economy. It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
So here's the latest this morning. The Senate Minority Leader Chuck Schumer backing down on his threat to force a government shutdown, saying he now plans to vote for the GOP spending bill to fund the government for 6 months. Anne-Marie joins us now from Washington. Anne-Marie, we're calling it a blink. Maybe it is that. But for the Republicans now, they have to focus on one thing. It's what the market wants. It's tax cuts up next.
Yep, this pretty much gives them the green light to focus on enacting Trump's agenda now that they've avoided this potential shutdown. I would agree with you, Jonathan. For Minority Leader Chuck Schumer, this is a blink. Remember, he was at the podium just on Wednesday evening saying Republicans don't have the votes, and the next night saying, well, I guess Republicans do have the votes because I'm going to allow them to vote on this and keep the government open. I like to bring in Jessica Taylor now of the Cook Political Report. She focuses so heavily on what is going on the Capitol, on Senate, and the House. So Senate Majority Leader has this moment where he says he's going to come out and say, we're going to block this. We are going to make sure we have this fight. And then within 24 hours, absolutely crumbles that strategy. Hakeem Jeffries over in the House and their leadership doesn't mention Schumer by name, but they say in this letter that this is an extreme partisan legislation that will unleash havoc on everyday Americans. How divided are the Democrats right now? Why can't they agree on a single message?
Yeah, I mean, I think it's just that they haven't had a win in so long. I think they're still just depleted from November. And so there was an appetite certainly among the Democratic base for Schumer to stand there and fight this. But I mean, the reality is this wasn't going to be a normal shutdown where, okay, there's brinksmanship, maybe we shut down for a couple of days, a week, everything opens back up, federal government workers get back pay. What Schumer outlined last night on the Senate floor and then in a New York Times op-ed is that with Elon Musk and Trump trying to cut the size of government and just slash wholesale departments and jobs and different things, that this shutdown could have given them, and Russell Vaught at OPM and different things, ways that they could strategically just not open departments that shut down, that they could not give federal workers back pay, that this could give Republicans and DOJ that are trying to cut these departments even more leverage and abilities to do it. So I think that was sort of the actual reality on the ground that set in. But the political reality is that you have a Democratic base that is wanting their leaders to stand up and fight. Remember, these are the people that Democrats need to be giving them money to do a strategy. I mean, it's very plausible when we look at midterm history and how closely divided the House is that the House is very much in play. Now, the Senate is a very different animal because the Democrats need to flip 4 seats. The map as it is right now, it's very difficult to get those 4 seats. So, what we're talking about is on a simple majority, this bill was going to pass simply because they have the Republican votes. But with cloture, with the filibuster still in play, this was sort of Democrats' last line of leverage. And I think there is some frustration between the House and the Senate there, too, because, there were close votes in the House, but ultimately there was only the one Republican that voted against this, one Democrat, Jared Golden, and more from a Trump district that voted for it. So, I mean, I think there's frustration among the Senate, too, that, okay, maybe the House should have tried to exact some more concessions and things there instead of kind of, we're now at the 11th hour of these things shut down. The House isn't in right now. All of these things all come to the very end, to the, to brinksmanship, and there's just not a lot of time to negotiate when it comes down to it.
This opens the door now for the Republicans to really focus on reconciliation. What's your timeline for that? Because we're hearing a lot of voices say because of the consternation in the markets on consumer sentiment when it comes to tariffs, they want to bring back some of the good policies that potentially the entire Trump agenda could bring in, which is tax cuts.
Yeah, I mean, I think those are things that poll very well in different things. When we look at what's happening with tariffs and stuff too, we saw a poll out yesterday from Quinnipiac University that yes, voters and Americans are okay with things on China, but majorities are against the tariffs on our allies in Canada and Mexico and different things. And I think you saw what Trump was talking about yesterday with tariffs on wine and champagne and different things. But a lot of red states are going to be affected by this. We're even seeing, Rand Paul from Kentucky was talking about yesterday, if the European Union and Canada and things, they are slapping tariffs on whiskey and bourbon and different things, and that's the reality that I think gets lost in these tariff discussions, and why, it's not, Trump likes these, but it's not a core Republican principle. When the Republican Party was founded on these free trade, has traditionally been a free trade thing, because yes, we can say, we want to protect our things, but we have to export these things too, and we want them to buy things. So when you have Canada that's boycotting buying any American goods and different things, that's going to hurt in red state places as well.
It feels like Trump is in full-on negotiating mode. But back to the tax cuts. Do you have a base case on when we can see them get through? And how are Democrats going to message around this? Because as you've said, this was their one point of leverage this year, and they pretty much just blew it.
Yeah, I mean, I think they want to just get them done as soon as possible. I mean, you want them done the first 100 days and different things if possible. But where does it leave Capitol Hill in this fight? I think once they return from recess in a few days, we'll see. But that is a way for Republicans to kind of turn this messaging around. But again, Democrats have kind of ceded the ground on this, and so I think that's just where the Democratic base is, and they lost confidence in some of their leaders.
Given how slim the Republican majority is in the House, do you think it's going to be very difficult to enact Trump's agenda? Or because he's basically almost acting like the speaker some days, calling in different individuals, he's going to be able to make those deals and make sure that his legislation gets through?
I mean, they still have the majority, and you have even some, again, conservative Democrats that might even want to cross the aisle to do this.
Because if not, it'll be a tax hike.
Exactly. But I mean, Democrats are going to message this as talking about like who is actually this tax cut going to benefit, the wealthy or the middle class and different things. So, I mean, it's a messaging war, and who's winning that right now. And, again, when it comes to tariffs, I think are Democrats sort of content to wait to sort of see the polls sort of catch up where the economic reality is? But right now, I mean, Trump and the White House are the ones calling all the shots. And again, I think that's why there was such frustration that Congress had a way to step up. I mean, they're the Article 1 branch. The White House is Article 2, but it hasn't felt like that recently.
Jessica, thank you so much for joining us this morning. Jonathan, that was Jessica Taylor of the Cook Political Report. What stood out for me in that conversation is this Quinnipiac poll. Americans like the idea of tariffs on China, but not so much when it comes to Canada and Mexico.
Anne-Marie, appreciate the update. More from Anne-Marie a little bit later this morning, 7:30 Eastern Time, catching up with the NATO Secretary General Mark Rutte. Look out for that a little bit later on this morning. As for the policy volatility down in Washington, D.C., it's hitting sentiment, that's hitting the multiple. This was the first week we really started to see it hit earnings. What you heard from the airlines is really important. What you're hearing from BMW is important as well.
That they're getting hit from all sides and they're seeing sales plummet, and how this is really going to feature into their expectations going forward.
Equity futures are bouncing this morning by 0.7%. Up next on the program, Oliver Chen of TD Cowen on the impact of tariffs on retailers. From New York City, you're watching Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but you can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I think we're ready. Ready? Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
So these are the scores this morning. Equity futures on the S&P 500 up by 0.7%. On the Nasdaq 100 up by 0.9. On the week so far, though, on the S&P, we're down by more than 4 full percentage points. On course for the biggest weekly loss going back to 2023, back in March of 23. At the moment, on course for 4 consecutive weeks of losses, the longest such streak going back to August of last year. And beneath the surface, just look at the damage. I went through these names a little bit earlier on this morning. Meta down 20% from the highs from only a month ago. Nvidia down 22% from the highs of this year. Lisa, Amazon down 20% since the start of February. This has been really quick, brutal stuff for some of these major tech names.
It's been a correction in the S&P 500. It's a bear market for sure since the peak in December for the Magnificent Seven stocks, and it's being driven by something other than DeepSeek, other than election fears. You have a confluence, a parade of terribles, to quote Ed Bastian, that are leading to a real softness in equities. And it's raised this question, if this is still part of an uptrend, like Chris Verone was saying, what will it take to broaden this out at a time when there are a lot of different sort of nodes that are getting a little weak?
It's been a tough week for equities, but check out the bond market. No real movement. The 10-year maturity, the 10-year yield at the moment is totally unchanged on the week so far. The 10-year, 429.29, yields up by 2 basis points on the session and flat on the week, on a week where equities have dropped 4%.
You could draw a lot of conclusions. A lot of people just say it's a mess, don't even try. There is one detail that keeps sticking out to me. We got CPI and PPI, and it's the reverse of what we've seen in the past, where it came in hotter than expected, but the components of it that go into the key inflation metric that the Fed looks at came in weaker than the rest of the indicators. This is the opposite, where basically it looks like it's weakening, but if you look at the underlying components, it really was driven by a couple of indicators like airline tickets that don't go into core PCE. So this doesn't give the Fed carte blanche to cut rates, and that maybe, if you want a narrative, seems to be what people are pinpointing.
Something has been weakening, and that's the US dollar over the last month or so, and you're seeing that against gold. Gold this morning, all-time highs and through 3K for the first time ever. What a move. We're up another 0.4% on the session.
This is important. Watch this space. If you have ongoing dollar weakness with softness in U.S. equities, it is a trend that could make some of the international portfolio managers reconsider how much of a hedge it is to buy U.S. assets in dollars, given the fact that usually the dollar rallies on any kind of weakness.
Should we finish on crude? I think it's important
Please.
to. Let's get that board back up. WTI, as of yesterday at the close, down for 8 consecutive weeks. We might avoid that today, but if we make it 8, that's the longest streak going back to 2015. Now, this is where the inflation story gets complicated for me. Can you build a case for persistent inflation, higher inflation, with crude down as much as it is over the last few months?
This is part of the design of the White House. They want to bring crude prices down. Saudi Arabia seems to be participating on the margins. There are a couple of other OPEC plus producers doing the same. You also have potentially weakening demand, but it raises this question. How secular can inflation be if you don't have a participation from going to the pump and filling up your car for a lot more money? And that, I think, is what a lot of people are trying to grapple with. Is there enough of this tariff-related inflation to get some sort of reinflation. Like, I don't know that there's a conclusion to that.
Crude getting a bounce this morning. We're up 0.9% on Brent crude. On our radar this morning, Senate Democratic leader Chuck Schumer saying he'll vote for a GOP spending bill to keep the government open. Schumer calling the bill, quote, very bad, but saying a shutdown would be much worse for the country.
The Democrats are struggling here. I would say Americans in general are not as interested in political shenanigans and who blinks and who doesn't than a functioning government, especially at a time where there is potential weakness. That's the reason why there are a number of moderate Democrats that want to push this through and then save the fight for something more significant later on. At the same time, you have to imagine the Democrats aren't coming together with any kind of cohesive message to counteract what they see as some of the problems with President Trump, and they haven't explained what they agree with as well as what they don't. And there are some policies that are actually pretty popular.
I think for the markets right now, don't care about the politics, they care about the policy. Correct. And we said this yesterday, the more we were talking about government shutdown, the less we were talking about tax cuts. Now you've parked that. Can you get optimistic that we can get this bill through Congress pretty quickly before year end?
If we do, and this I think is really a key consideration, especially for the bond market, what happens to 10-year yields? Because this will expand the deficit. The offsets that they're talking about with some of these job cuts, especially the ones that are being sort of questioned in the court system, are, not really compensating for some of the tax cuts that they plan later on.
The Treasury trade's got a little bit more difficult over the last week, that's for sure. Yields this morning up by 2 basis points, around about 430 on 10s. Elsewhere, a San Francisco federal judge ordering the Trump administration to rehire thousands of government workers who were terminated back in February, saying the Office of Personnel Management's order to fire probationary employees was illegal.
This is fascinating to me on two fronts. First of all, what actually gets through with DOJ? How do you do this, where you call someone up and say you just got laid off, but come back to the office because now the court system says you are back in the office, but the president is appealing this ruling, so you might be back out. I mean, how do you operate a business that way? On a broader level, it steps up a real fight, and Donald Trump's administration has appealed some of these state, local rulings to say, why should one judge in one region set policy for the entire government of the federal United States of America? And that is potentially going to go to the Supreme Court. Watch this space. That is going to be an interesting play.
Keep returning to the same point we've made over the past several weeks or so. If you're a federal worker right now, you must be so anxious about your job and what's going to happen. And maybe you can make the case, and we've said this before, that that's just the same anxiety that anyone in the private sector faces every other week. That might be true. But it does have economic consequences. Economic consequences we might not have thought about for a long time regarding federal employees. What are they going to do with regards to spending? Are they going to get that flight? Will they book that vacation? Will they buy that big ticket item? Will that show up in the data sometime soon?
It's not just federal employees. It's also all of the contractors, major corporations that get funding from the government. And you could say, well, it should be more in the private sector, but the speed at which it's being done is going to have ripple effects that cannot be offset in the near term as quickly. That is the reason why people are talking about potential thousands of layoffs in the near term, even without some sort of deep downturn in the economy.
We mentioned BMW a little bit early this morning. Let's get up to speed on what's happening over there. The company delivering a disappointing profit outlook for the year ahead, citing weak China sales and the potential impact of tariffs. The automaker expecting to take a $1 billion hit from escalating trade tensions between the United States and Europe.
What's amazing is they're in the middle and they're getting hit by all sides. They're getting hit by the EU tariffs on China, by BYD and the competition in China, and then US tariffs on European goods. And they're in the middle of it all and getting buffeted. How do they get a competitive edge? What's their edge right now? How do they make an argument to whom? Are they making it to the EU? Are they making it to the United States? Are they making it to China? They're in a tough spot, and it highlights how people are very optimistic about Europe, but they still are kind of between the U.S. and China, and they're not in a great spot there.
It's a perfect storm for them and for the retailers too. Let's talk about the retailers. A growing list of retailers raising concerns. Target, Best Buy, Dollar General, Macy's, all warning they may have to hike prices due to the impact of tariffs. Oliver Chen of TD Cowen writing, increases in the prices of raw materials, rent, freight, labor tariffs, or manufacturers' inability to produce goods on time or to specifications may negatively impact results. Oliver joins us now for more. Oliver, welcome to the program, sir. It's good to catch up with you. It's been a tough run for some of these retailers. Clearly, they're not sure of what kind of guidance to put out at the moment. Could you tell us from your perspective the kind of companies that you think will be in a difficult spot in the year to come?
Yeah, John and Lisa, pleasure to be here. So discretionary companies will continue to be challenged. The consumer right now is in a tough spot. The consumer is being highly considered, skipping trips. And as you've seen and mentioned, consumer confidence has been very volatile. So as we look at mall-based retailers, department stores, Target, that's been tougher. And guidance has been weak to flat to slightly negative. On the other hand, in terms of thinking about the positive and the good opportunities that we see, we like the defensive characteristics of Walmart, Costco, and BJ's, in part because these retailers have a lot of scale and are focused on value. That will continue to be a key theme as consumers are really feeling the pinch, especially with dairy and eggs. It's something to watch.
As the leadership committees get together, Oliver, and talk about offsets, what's available to them on their dashboard? Can they put pressure on the exporters to drop prices? Do they have to take it on margin? Can they pass it on to the consumer? Do they have to lay off employees? What are the options available?
John, it's going to be very tough to pass this to consumers because the consumer is highly elastic in terms of looking for alternatives and under pressure right now. What some retailers are doing are stocking up on more inventory today to the extent that they can. Certainly negotiating with suppliers has been an ongoing effort, and Walmart's been a very good player here in terms of scale. And then thirdly, the retailers are looking at where they can source with more diversification. The good part about this is retail's been through so many supply chain shocks. So there's experience with volatility, and also retailers have been on a journey to diversify sourcing. In terms of stocks, Costco is best positioned. About 20% of its goods are imported. And then Target, on the other hand, is more exposed, given more discretionary at 50%. And Walmart's well positioned at 30% too. But the bottom line is, bigger is better in terms of scale. Again, Walmart and Costco. And also those retailers which are fixated on offering consumers value, those are going to be retailers that consumers will flock to because this will impact the whole industry.
Bigger is better in general. We've been talking about that. And yet the story over the past couple of weeks about Walmart got our attention, where on one hand, they said to Chinese producers, okay, just lower your prices and we can just pass along the tariff costs to you. And China turned around and said, no, don't think so. So at what point will these companies get caught in the crosshairs of the trade tensions between the U.S. and China, as well as the U.S. and Europe and anything else?
Yeah, Lisa, I think it's unavoidable. I think everybody is caught here. And the issue is it's going to be very hard to pass these increases to consumers. So both Walmart will likely have to take a margin cut and negotiate with people along the supply chain. And consumers will also have to feel the pinch too. So it's very dynamic in terms of what retailers are trying to do, but everyone's trying to be best prepared as possible. That being said, Walmart has a long history of negotiating very tightly with their suppliers, and it's also done a very good job with rollbacks, meaning taking prices lower and having them stay lower. So this company really understands the cost structure, and the whole mission of SAM for many, many years and decades is this everyday low price model. So the company knows what they're doing with sourcing, and it's not surprising that they're trying to negotiate in a very aggressive manner.
Meanwhile, amid all the uncertainty this week, I think for all of us, we really paid attention to the airlines, and Delta in particular coming out and saying that they saw a huge fall off in consumer demand starting in mid-February. When you read the tea leaves and hear the commentary from executives at the retailers that you cover, has there been a similar trend, just a downward shift that's pretty notable?
Yeah, Lisa, what's happened at department stores such as Macy's, January has been tough with weather, plus headlines, plus consumer confidence, plus media. As you know, we're talking constantly about change, and the consumer is feeling on edge, and that doesn't lead to a good feel-good factor, which really translates negatively to spending, and especially spending that you don't really need to do. We do need to buy food and eggs, but you don't really need a new dress or a coat, and the consumer is choosing to delay when they can. So this is having a near-term impact, and it's worse than before. It's something we're watching because confidence has been volatile. The consumer does have money. It's been a lot about are they choosing to spend and where are they choosing to save And certain places, they are choosing to trade up and splurge. So it's not, when it is about winners and losers in this market of retail as well. Bottom line, department stores have had a tough time. Mall-based retailers have had a tougher time. Those retailers would need plus want, meaning food plus consumer discretionary, meaning a TV and other luxury items, as well as great priced chicken, such as Costco. Those are working best.
Let's talk about some of those losers. Let's finish on that. Kering, down today by about 10.5% as they tap Balenciaga to go over to Gucci. Oliver, how is that going to work, and why is the stock getting hammered just as much as it is?
John, I know you know a lot about Gucci, and Lisa brought up some great comments earlier. We hosted them yesterday, and I think people were expecting a bigger name, perhaps from the outside of the organization, but Demna comes from Balenciaga, and he has a very good background, actually, in cutting suits and tailoring from Margiela as well as Louis Vuitton and Antwerp. So we're looking forward to that. The other thing is they know a lot about Demna from Balenciaga. It's a good thing because any of these creative changes can add risk. And the bottom line, Gucci needs more sparkle. It needs more drama. And Balenciaga's done a good job with theater in terms of bringing a lot of interesting attention and cultural relevance to that brand. The Gucci strategy is going to continue to be very elevated and organized and thinking about balancing quiet and loud luxury. They need a designer with more pizzazz, more sparkle. This is one opportunity. But the market was expecting a bigger name and perhaps an outsider.
Oliver Chen of TD. Oliver, appreciate it. The view on Kering there. Kering at the moment negative by 10.3% in early trading. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. How's this for some sparkle? Gold rose to a record high, topping $3,000 an ounce. It comes as President Trump's tariff agenda and his latest escalation fans concerns about U.S. economic growth. The precious metal extending its gains from last year, supported by central bank buying, as well as inflows into ETFs. The UAE's National Security Advisor is planning to visit Washington to press for easier access to American technology and discuss investing in the U.S. Bloomberg has learned that the meeting could take place as soon as next week. The UAE wants the ability to buy cutting-edge chips from the likes of NVIDIA. And an American Airlines Boeing plane caught fire at the Denver International Airport. The plane made an emergency landing due to engine vibrations, then caught fire while taxiing to the gate. 172 passengers and 6 crew members were safely evacuated, while 10 people suffered minor injuries. That's your Bloomberg Brief. John?
Hey, Yahara, appreciate it. Thank you. More from Yahara a little bit later in the program. It's the people who go to their phones almost immediately when these things happen. I'd be sprinting. I'd be long gone. Yeah, but you get your phone out and you start recording it.
But thank you for it, because now we can talk about it and analyze it. I mean, the fact, though, that they do that highlights just how many there have been and how there's a protocol for it. Film it, put it on the social media, and everybody gets scared.
And not a good week for the airlines, that's for sure. Up next on the program, President Trump is not ready to bend.
Any chances that you will ban on the tariffs on the aluminum and the ones that are planned for April 2nd?
No, we've been ripped off for years, and we're not going to be ripped off anymore. No, I'm not going to bend at all.
Ed Yardeni is of Yardeni Research. He's changed his price target on the S&P 500. He joins us next.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
We are bouncing back this morning by 0.8% on the S&P 500, by 1 full percentage point on the Nasdaq 100. On the S&P, on the week so far, before today's move, we're down by more than 4 full percentage points. And the President Trump, is not ready to bend.
Any chances that you will ban on the tariffs on aluminum and the ones that are planned for April 2nd?
No.
You are not going to change your
No,
mind?
I'm not. Look, we've been ripped off for years, and we're not going to be ripped off anymore. No, I'm not going to bend at all. Aluminum or steel or cars, we're not going to bend. We've been ripped off as a country for many, many years.
So here's the latest this morning. President Trump standing firm behind his tariff agenda, reiterating plans to keep steel and aluminum tariffs in place and move forward with fresh tariffs on April 2nd. Ed Yardeni of Yardeni Research citing Trump as he cuts his year-end S&P target to 6,400 from 7K, writing, quote, "We can't ignore the potential stagflationary impact of the policies that Trump 2.0 is currently implementing." Ed joins us now for more. Ed, welcome to the program, sir. An important distinction here. Your revision is off the back of a change to the multiple and not to earnings. Can we start there? Just explain the difference between the two.
Well, look, it's PE times E when we try to think about where the market's going. And I'm still hanging on to the idea that the economy is resilient. Over the past 3 years, we've had a tightening of monetary policy. And despite the tightening of monetary policy, the economy has continued to grow. So I'm hoping that that experience demonstrates that the economy will be able to withstand this mix of stagflationary policies. On the one hand, we've got a policy that's increasing the tariffs, which could potentially slow the economy down. And then, of course, we've got the Doge boys cutting back payrolls pretty aggressively in the federal government. Yet, despite all that, initial unemployment claims remain remarkably low. There's lots of articles about how the consumer is going to retrench. But I think we're actually going to find that once we get March and April data, in the spring there will be growth, as Chauncey Gardner once said. Remember Chauncey? The idea is that the consumer will prove resilient. There was a lot of weakness in the consumer in January and February because both months were actually colder than average. And so I'm expecting that the economy will actually hang in there.
So how much, Ed, is this revision downward to your S&P call by year end a bond market call and not really a stock market call, with the expectation that bond yields will remain higher in the face of inflationary pressures?
Yeah. Well, we've been expecting that the bond yield would stay high. We think that bond yields are kind of normal. They're back to basically 4.5% plus minus 25 basis points is kind of where we think bond yields should be. And as we've all noted, notwithstanding the some of the weak numbers that we've had of late, the bond yield has actually gone up. No, it's basically a call on the fact that valuation multiples have been high historically, and they've been high historically justifiably if the economy continues to grow and giving us plenty of opportunities for earnings to kind of fill in for valuation multiples. But clearly, there's at least a recession scare. Lots of people are talking about a recession. As a matter of fact, last week, we raised the odds of a recession from 25% to 35%. So we're not saying that there's no way the economy is going to slow in the face of what's going on, but we're still betting on the resilience of the economy and earnings, but we think valuation multiples have already come in and will stay lower than we thought.
Just a couple of weeks ago, Ed, you were sticking with the 7,000 target on the S&P for the year end. And you did make this revision just now of moving it down to 6,400, which is still a 16% upside from where we closed yesterday.
Yeah.
What triggered that? What made you think, okay, we need to take action because what's going on gives us a sense that maybe this isn't going to pass so quickly?
Well, that's a good point. I think we are going to get some tariffs, obviously, but I think there are going to be negotiations. Maybe in some areas, as you just showed, the president's going to be stubborn on aluminum and steel. But I think there's room for negotiations on tariffs in lots of other areas. So that's what I'm expecting. The April 2nd is going to be kind of important because that's when we're going to have the reciprocal tariffs across the board. And I think that obviously will potentially could trigger more downside in the market in the short term. But I think it'll also trigger a lot of negotiations to reciprocally bring those tariffs down.
Hey, Ed, it's a thoughtful call, and we appreciate your time breaking it down this morning. Ed Yardeni there, of Yardeni Research on the latest for U.S. equities. A lot of people come on the program. I've heard this a lot out there as well from people talking about the Trump agenda. He said all this on the campaign. Why are people so surprised? The surprise is actually coming from elsewhere. It's how others have responded to the tariffs, how others have responded to the policy shift in the White House. And by others, I'm talking about the Europeans. This headline just crossing, some reporting coming out of Germany that German parties have reached an agreement with the Greens on the debt package. That's pushing bond yields up in Germany today. That's pushing bond yields up in France today. Levels we haven't seen in more than a decade.
Yeah, since 2011, you're seeing French 30-year bond yields rise to 4.17%. Talk about pressuring yields higher around the world. And the fact that Germany actually looks like they are going to get this through highlights how quickly and how unusual it is for the example of fiscal austerity be coming out with a fiscal package that could amount to almost 1 trillion euros.
The German 10-year up by 8 basis points and getting closer and closer to 3%. The 10-year Bund, 2.93. Coming up next on the program, Barbara Doran of BD8 Capital Partners, Maya McGuinness of the Committee for a Responsible Federal Budget, and the NATO Secretary General, Mark Rutte. Look out for that and more in the next hour.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zay Poland he did come to me and Susan O'Malley, and they said, Abe Polson says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the open and bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Hard to bet against the U.S. consumer right now, even though uncertainty is higher.
While there's a lot of well-deserved attention on tariffs, let's not lose sight of the consumer whose spending has slowed.
The tariff policy on again, off again is impacting the sentiment of consumers.
We've just seen confidence continue to deteriorate.
What consumers are doing is essentially hoarding ahead of any potential price increases.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 unlocking some gains, up by 0.8% on the S&P. On the Nasdaq 100, we look a little something like this. Equity futures pushing higher by 1 full percentage point. On the week, though, still down on the week and heading towards a fourth consecutive weekly loss on the S&P 500, a stretch we have not seen since August. The good news, and this is good news, we're set to avoid a government shutdown in Washington, D.C. The bad news, over the next few weeks, we'll still be talking about the same thing, and that's tariffs down in Washington and what it means for the economy, for the labor market, and for consumer sentiment as well. Later on this morning at 10 a.m. Eastern Time, look out for this. Mitch, consumer sentiment. How important is that data point going into the FOMC next week?
Stuart Kaiser of Citigroup said that it was oddly important at a time where a lot of people used to discount it as incredibly political and noisy and not very reliable given the small sample size. Nonetheless, any kind of real-time data showing how quickly sentiment is shifting and how much consumers are shifting their behavior is really important at a time where the airlines have come out and told us things are changing very quickly and demand has been falling pretty dramatically.
Delta Airlines down for 6 consecutive sessions, a run that has built losses to more than 20%. That is a massive amount of market cap that's come off Delta Airlines because they're saying the quiet bit out loud. It's not that we think this is going to happen. It's not speculating or guessing. In the middle of February, consumers and business activity started to stall. That's been weighing on that stock all week.
And the reason why it has been having a wider implication is because we're hearing the same message from Southwest, from JetBlue, from United, from American. This is not necessarily just a Delta issue. This is government workers. It's hard to take a step back. But one thing that Sheila Kahyaoglu said was, we're still coming off a pretty hefty pace of gains and travel. So how much is this a normalization versus something else? But Oliver Chen talking about the consumer sector and the retail space and how it, too, is seeing a similar kind of trend.
That stock is bouncing this morning by 1 full percentage point. That's the story stateside. We need to talk about Europe. Germany slowly coming together for an agreement to pass a spending plan. And in Germany right now, bond yields are higher by 7 basis points. We're getting closer and closer to the line in the sand that is 3% on a German 10-year yield. Lisa, we're at 292 this morning.
Yeah, it's the highest level going back to late 2023. How much higher can it get if they do end up borrowing at least almost $1 trillion more euros just for infrastructure and a baseline defense spending package, but really opening up the deficit spending potentially as a blank check to support some sort of outgrowth of their military. Real questions here about how much structurally has shifted and how much they can change some of the trajectory of growth on the heels of military spending, as well as infrastructure spending that could take a decade. It's a very difficult calculus right now.
I was listening to the ECB President Christine Lagarde conducting an interview over in Europe earlier on today, and she was asked about the tariffs. Won't that hurt Europe too? Doesn't that mean the economy falls into recession? And she pushed back and she said, I think this will energize Europe, and you're seeing that. It's the policy response to this that is pushing equities up, bonds down, and yields higher across the continent.
And she says that for growth around the world and for prices around the world, but particularly in the United States, will there be that pain felt? So increasingly, it's the opposite of what people expected last year, that trade wars would hurt Europe, would hurt the rest of the world. Now, they're turning the tables back to the United States.
Do you want some pushback?
Yes, please.
Comes from Bank of America.
Yes.
Not bullish on European equities. Markets have shifted towards a slowdown. That has further to go. EU equities still priced for global PMIs to rise. They don't think they will. That's the pushback. It's still out there.
And the pushback is also coming from BMW. The fact that you're seeing that the main industry in Germany is getting buffeted by crosswinds from both the United States as well as China with respect to tariffs on both sides. Europe still faces a long road ahead of it, and a lot of the bulls in the United States for risk assets are confident that there will be a policy response either from the Federal Reserve or from President Trump, and that is giving them confidence to not really buy the Europe train yet just yet.
Just to recap that European story for you, this is according to a report coming from the German newspaper Handelsblatt that the Chancellor-in-Waiting Friedrich Merz has reached an agreement with the Greens Party on a fiscal reform package for the investments into infrastructure and defense spending that we've been talking about now for a number of weeks. Here stateside, equities are recovering on the S&P 500, higher by something like 0.75%. Coming up on the program, we'll catch up with Barbara Duran of BDA Capital Partners after stocks fall into a correction. Maya McGuinness of the Committee for a Responsible Federal Budget, and the NATO Secretary General Mark Rutte on the push for peace in Ukraine. He joins us at 7:30 Eastern Time. We begin this hour with stocks higher. The S&P looking to recover after sliding into the first 10% correction in almost 2 years. Barbara Duran of BDA Capital Partners urging patience. A pullback is normal and not unexpected. Market is trying to discount the worst case given uncertainties, but finding stability is elusive until policy stabilizes. Barbara joins us now for more. Barbara, good morning and welcome to the program.
Good morning. Delighted to be here.
Are you expecting that policy stability anytime soon?
Well, the question is, what is soon? I mean, I think is sometime in the next month or two, yes. I mean, things that right now it's beginning to feel like the boy who cried wolf. Although there is real substance, and President Trump is determined, to have some sort of parity on the tariffs. But I think we are going to begin to have clarity. I think there's a lot of concern in the administration in terms of they're getting pushback from their constituents, and all the uncertainty is starting to show up in the numbers. We'd mentioned earlier about consumer confidence surveys. Two of the most important a few weeks ago showed suddenly short-term inflation expectations have zoomed up. You're seeing a holdback in company managements. Things are on hold. How can you decide on capital commitments or hiring until you really know what the impact of tariffs are going to be? You saw Bank of America and Citi this week in credit card debit spending. It's down in February versus, robust December and January. So what I think you're seeing people on pause, both consumers and managements, that I think is temporary. Balance sheets are strong, both corporations and the retail and the individual investor. But, if it continues a lot longer, and I think there's, a lot of the advisors around President Trump are very concerned with that. And so I think, right now, also, it's so out of the blue, seemingly some of these things like yesterday, 200%, on champagne from France.
Why not?
I'm glad I had some champagne, recently. It's probably it for a while.
I hope you stocked up.
But anyway, and I think those kinds of things are going to calm down, because I think our allies, especially, it's, how do they respond? And I think they're figuring out how they respond.
How do you respond as an investor? Let's talk about the damage done to stocks. So on a headline index on the S&P 500, 10% correction. Beneath the index, we've done loads of damage to some of the biggest tech names on the planet, 20% moves. How are you thinking about allocating capital into this downturn?
Well, I own, almost all these large mega cap. And, what you mentioned about canceling patience, we saw this a lot last year. The market's been up 24+% S&P 500 the last 2 years. And what you saw last year was a continual rotation. And where does the money come out of? It comes out of the high performers. And that's the momentum big cap names. And so I think that's what you've seen here. I mean, they were all been killed. You saw NVIDIA, down from like 150 just a few weeks ago to 106, earlier this week or late last week. And now it's bounced up. And so you've had a lot of corrections in these names. Amazon, Meta, these have sustainable, visible growth for some time. So money will rotate, and there's been cherry picking down here. So I think, what you'll probably see in here, the market's trying to find a bottom. There will be a bounce. Some people will sell into it, but I think otherwise you wait, things will recover. We're going to have more visibility, I think, in the next few months. The Republicans in Congress are working feverishly, on tax cuts and deregulation so that we can get the trade tariffs out of the way, because that is really taking all the oxygen out of the air.
So where do you wait? And I say this as I see a number of portfolio constructions like stagflationary protection basket from Goldman Sachs, or all-weather fund, all-weather stocks from Evercore ISI. How do you identify the places that are more immune to some of these shocks at a time where the high beta stocks are going to continue to be a proxy almost for some of the sentiment?
Right. Well, so much, it depends on the type of investor you are. For my clients, I'm a long-term investor. It is stock picking in names that we're going to have this volatility. Stocks are volatile. And those kinds of things, you saw a big rotation immediately into the staples, into utilities. That's where people go to hide. You have cash. We're still getting high yields on even money markets, depending where you are, 4.5%. So if you are the type of investor or a management, you rotate into these names and wait. But, they're already expensive. So unless you reacted, like that, I think you just have to be patient in your portfolio and cherry pick,
What I'm trying to figure out at this point is how much the bullish thesis on U.S. equities and the U.S. economy is predicated on the idea that someone has to blink first, either the Fed or President Trump. And there has to be some sort of policy response one way or another. And whichever it is, it will be supportive for equity markets down the line. But that ultimately is the white hope right now behind a lot of the ongoing optimism in equities.
Yeah, no, I think that's exactly right. And I think the Fed, right now is probably focused a little bit more on growth than inflation. You saw the PPI, CPI numbers. Things were better than expected in some regards, but underlying price pressures in the PPI, which of course we're all looking to see where is it starting. Part of that might be explained by inventory build. People are rushing to bring in inventory before whatever tariffs go into effect, and they don't know. So I think that the Fed is right now no probability that they will cut any in the next month or two or next meeting or two. Because I think they're watching growth. And I think if growth does really, it's more than just this sort of stutter step. I think the Fed will start to think about cutting, even with, inflation. Because inflation, I don't see it popping up. There's going to be pressures. It's not going to be like post-COVID, So I think it may be stalled out here, but that's okay. It's really switching more to growth worries, which we didn't have a month ago.
We've seen certain central bankers tackle some of these policy issues head on. The Bank of Canada, Lisa was talking about that earlier this week. The ECB President Christine Lagarde is talking about it openly. Do you expect the same approach from Chairman Powell on Wednesday, March 19th?
No, I think Chairman Powell has bent over backwards to be apolitical, not even to touch when he gets questions from reporters about any kind of policy. He says we are waiting and watching because they know this does have an impact. And so they're not going to opine. They want to make sure they keep their reputation for independence. And whatever, the administration does, they will react and incorporate it into their predictions. But no, I don't see him coming out and, beating the drum on anything in terms of policy.
I'm not trying to sell it because we're covering, but it's going to be a high-pressure meeting next Wednesday. High-pressure news conference for Chairman Powell.
Especially because he has alluded to policy shifts, and he has talked about the different pressures on the Federal Reserve. And on one hand, you could say it's politically tenuous for him to talk about it. On the other hand, you could say he's waiting for what? What's the key moment that he's waiting for? Well, he'll get a sense of what policies are that have already been enacted and that already have been laid out.
That two-day meeting starts on Tuesday, concludes on Wednesday next week. Barbara, good to see you. Thanks for dropping by.
Thank you.
Thank you. Thank you very much. Barbara Durand there of BDA Capital Partners. Just to update you on the latest out of Germany, Friedrich Merz, the Chancellor in waiting over in Germany, said to have reached an agreement with the Greens on a fiscal package, a very important development over in Europe. Yields are higher by 6 basis points on a German 10-year, 2.91. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. Ukraine attacked Moscow with drones for the second time in a week, with at least one hitting a central area near government buildings. Russian air defenses intercepted 4 drones, and emergency services worked at sites where debris fell, while Ukraine hasn't commented on the attack. Meanwhile, Bank of America's Michael Hartnett says that the slump in U.S. stocks is a technical correction rather than the beginning of a new bear market. Hartnett says a further downturn would prompt policy intervention and recommends buying the S&P 500 at 5,300 points, a level that he says, including other factors, would indicate the sell-off is over. And a San Francisco federal judge has ordered the Trump administration to rehire thousands of the government's newest employees who were terminated back in February. The court found the Office of Personnel Management's order to fire probationary employees was illegal. The administration says it will appeal the ruling. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Democrats blink.
It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
So in just a few minutes, we'll catch up with Anne-Marie down in Washington, D.C., and we'll speak to Maya McGuinness of the Committee for a Responsible Budget from New York City. This is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's head straight to Germany. Bonds are down, yields are up by 5 or 6 basis points, getting closer and closer to 3% on a German 10-year yield, 291. This is the latest from the team reporting out of the continent. The German Conservative leader, Friedrich Merz, the so-called Chancellor in waiting, reaching a tentative agreement with the Green Party on a debt-funded spending package for both infrastructure and for defense. Of course, the deal needs to be approved by party lawmakers, and from what we understand, the Democratic-led bloc, the Social Democrats and the Greens have called a meeting with their lawmakers for 1 p.m. local time, which I believe at the moment is 8 a.m. Eastern time, so about 45 minutes from now.
And we'll get a better sense of how quickly they can get this through and any of the details. I just wonder how much this is a Germany story versus something that will trickle out to the rest of the Euro region, given the fact that there are debt limits that are constructed for other countries, can they get out from under it the same way that maybe Germany has?
I would say it's a global bond market story. That's for sure. Let's turn to equities. Equity futures just off session highs by 0.7% on the S&P 500. A positive development in Washington, D.C. And the surveillance this morning, Democrats blink.
For Donald Trump, a shutdown would be a gift. Right now, Donald Trump owns the chaos in the government. He owns the chaos in the stock market. He owns the damage happening to our economy. It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
So here's the latest this morning. The Senate Democratic leader, Chuck Schumer, opting for the path of least resistance, avoiding a disruptive government shutdown. Republicans now set to push forward with other aspects of Trump's agenda, including tax cuts. Anne-Marie joins us now from Washington for more. Anne-Marie, from the market perspective, a rare piece of good news.
It is a little piece of good news, of course, Jonathan, when it comes to making sure that the government continues to function. Even if this were to go through, it would have been a short shutdown. But you have to see how quickly the Democrats folded. Just 48 hours ago, Chuck Schumer, the Senate minority leader, was talking about how the Republicans don't have the votes. Well, they do have the votes. And now it's a green light for Republicans to work out enacting Trump's full agenda. And for that conversation and what the extension of TCJA might mean for our deficit, I'm very excited to bring in Maya McGinnis. She's, of course, with the Committee for a Responsible Budget. Maya, thank you so much for joining us. Let's talk about the future now. How much spending are you seeing potentially added to the deficit when it comes to the extension of TCJA and also some of the other tax proposals the president talked about on the campaign trail?
Well, the potential price tag of this whole deal just keeps growing and growing. So the current plan, the tax bill as they're talking about it right now, would cut taxes by about $4.5 trillion. But it looks like there are a number of new tax policies, new tax cuts that they would like to add, many of those from the president's promises while he was on the campaign. It would also have about $300 billion in new spending. All of that is offset by $1.5 or $2 trillion, leaving a gap of $2.8 trillion. Does it make sense for us to borrow more right now when we're at near record debt levels and we're about to add $22 trillion to the deficits over the next decade? Obviously not. They really need to find more spending offsets. I would put in context, the $2 trillion they're saving is out of a full $86 trillion in spending over the same time period. But there's lots of discussion about how this is too much. I'm very concerned that'll get watered down in the Senate and the tax bill will get built up. So as much as this is looking like it will be a tax policy bill, it's going to be a deficit busting bill at a time when clearly that's not the direction fiscal policy should be moving.
Well, there also might be a way to almost trick the accounting. The Wall Street Journal editorial board is out with a piece today, and they say using the current policy baseline to extend current tax law is in the best interest of the country to avoid a giant tax increase, and Republicans can rightly defend it. Failing to do so will make Republicans prisoners of phony Washington accounting. Do you think they're going to go from current policy or current law? And tell us, Maya, for our audience that doesn't really know the ins and outs, what's the difference?
Yeah, isn't budget accounting fun? Yes, they probably are going to make the change, and it's an absolute gimmick that everybody who's doing it and every paper that's editorializing in favor of it knows is a gimmick that just makes tax cuts easier. So when they passed the tax cuts in 2017, some of those taxes were permanent, like the corporate rate reduction. Some of them expired. The reason they expired was to make the price tag look cheaper so it could remain within the limits of reconciliation. Now that they're extending it, they're saying, oh, we shouldn't have to acknowledge those costs because the policies are already there. But they didn't acknowledge the costs in the beginning. They're not acknowledging them now. So it's a way to kind of magically wipe away $4 or $5 trillion. But you know who that's not going to trick? It's not going to trick bond markets. They are still going to have to absorb the additional $4 or $5 trillion in treasuries over the coming decade. The argument that the Journal and others have made is, well, spending is treated that way where you assume it's permanent, even if it's a temporary policy. But the difference is if you do that on the spending side of the budget, you have to acknowledge those prices up front. The CBO assumes them in their projections. When you look at the debt numbers going forward, it assumes a permanency on the spending side. If the taxes, they say they're temporary, they take them at their word. Should they equalize them? Sure. But what you can't do is pretend that expense never happens which is what the Senate is about to try to do, and they're going to try to drag the House along with them. And it's another gimmick because guess what? Lawmakers are unwilling to acknowledge they like tax cuts, but they're not willing to have the spending cuts that would bring them down so that they wouldn't actually blow a hole in the national debt. And that, again, it's not good. That's what they're about to do. Yeah.
It's a good point. You could do this on a legal pad, but the bond market will actually view this as more spending, and potentially we could see a bond market reaction. Do you think the bond market will be the ultimate check, maybe on this spending package, on this tax extension bill?
You know, it's a great question because the bond market is a place where we will see concern, but it also depends. The markets also love tax cuts. So they're going to be of two minds. Markets are concerned about borrowing and really want tax cuts. And a lot of times when it comes to the economy, I think people sort of hope and believe for what they're wishing for. I think the best warning signal is this Congressional Budget Office. Anybody who wonders where we are in fiscal policy should just look at the charts they put out. We put out charts as well. It is undeniably unsustainable when your debt is growing faster than your economy. Your single fastest growing part of your budget is interest payments. Even if the debt is going to grow from policies that you like, in this case, tax cuts, it doesn't mean that that debt is going to be a good thing for the economy. And when you hear people making claims of, don't worry, we'll grow our way out of this, those claims are assuming growth rates that are 3 times higher than the other highest estimates out there. Massively inflated growth rates to allow lawmakers to say this won't add to the debt. It will, and markets should not be reassured by that claim because we're going to see these net debt numbers continue to grow.
Maya, when it comes to spending cuts, how much could be offset between what is going on with this administration when it comes to DOGE and that effect?
Okay, so DOGE is a completely different effort when it comes to actually making a big difference in the fiscal situation so far. I look at DOGE as a great idea of going through line by line, really understanding what's going on in the government, figuring out where the waste is, figuring out where you could do things more efficiently. I think there's a huge error that DOGE seems to be taking action first and evaluating second, and we should clearly switch those things. There should be the deep evaluation they're doing before we make any changes. But so far, the numbers that they're coming up with are in the billions of dollars. We're talking about needs for savings of trillions of dollars. So I think we should think about DOGE as really improving the systems. Let's look at where there's systems like healthcare delivery or defense procurement. There's so much waste. See what savings can be generated. I'm really interested to see how they can use technology to improve those systems. But again, I think the efforts to dismantle government before the fix is there and to make mistakes by going so quickly, that actually increases inefficiencies. Either way, we're not talking about numbers that are close to the magnitude of what we need to be talking about. And what we need to be talking about is what no politician will talk about, which is we need to fix Social Security. We need to fix Medicare. We need to raise taxes before we cut taxes. We need a big debt deal instead of continuing to do things that make the situation worse.
Maya, thanks so much for your time this morning. Of course, it's Maya McGinnis, Committee for Responsible Federal Budget. Jonathan, key point there is if they want to keep spending, the bond market might push back.
Anne-Marie, appreciate it. More from Anne-Marie coming up in just a moment. She's going to be catching up with the NATO Secretary General Mark Rutte on the push for peace in Ukraine and as Germany and German lawmakers come together to try and push forward a spending package on defense. That conversation up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equity futures missed session highs up by 0.75% on the S&P 500. The damage done so far, you are familiar with it. We're down by more than 4 percentage points on a week so far and heading towards a fourth consecutive week of losses. At the moment on the Nasdaq 100 up by 1 full percentage point and the Russell of small caps up by 0.9. Elsewhere, let's talk about policy and politics. G7 foreign ministers meeting in Canada. Top of their agenda, ongoing support for Ukraine. On the ground, Bloomberg's David Gura. David, welcome to the program. How contentious will this get-together be?
You know, it's interesting. We hear that there's kind of two different summits taking place, and the one that's taking place inside the meeting rooms is actually kind of peaceable. All of these high-level delegates are talking with one another and ticking through a lot of these issues on the official agenda, but this is a summit of two dueling agendas. There's the official one, as you say, which is so focused on Ukraine and the path forward there, and then there's the other one, which is the unofficial one, and that is how trade is reshaping the global economy, all of the tariffs that have been put in place, and how more broadly than that, kind of the geopolitical foundations have shifted here over these last few weeks. Yesterday, I spoke with the EU's chief diplomat, Kaja Kallas, and she talked about a very signal moment that took place yesterday morning. There was a conversation about Ukraine, and then word leaked out about that conversation that had been taking place in Saudi Arabia over the weekend, and how Steve Witkoff was on his way to Moscow. Everyone looked at their phones, they broke for a few minutes, and then there was kind of the expectation that the Secretary of State, Marco Rubio, would come back and brief the group there on what had happened. She said that did happen. They have some indication of sort of how that meeting unfolded, but it is something that looms large over every conversation they're having here. All the while, these diplomats are looking at one another, sort of wondering what's happened to this ally that they've trusted for so long, what the path forward is for them when it comes to the economy, when it comes to geopolitics. And as Kaja Kallas told me, she's hearing good things from the Secretary of State, but of course, having looked at the past, looked at President Trump's first term, and now at this one, there's this open question of sort of whether what he's saying will be mirrored by what the president, his boss, has to say, and that's certainly the unknown that a lot of these diplomats are dealing with, John.
David Gura, appreciate the update. Thank you, sir. This is the appetizer. The main course is later this summer, June. Canada's the host country for the G7 this year, leaders meeting in June. Just imagine what that's going to be like with President Donald Trump and some of the ideas that he's pushing regarding Canada.
Yeah, 51st state, maybe it'll be held in America by then. I mean, look, I'm being tongue-in-cheek here, but it really raises this question of how you have some sort of mending of the fences at a time where we have seen such fissures and such animosity, such personal animosity develop between these two neighbors.
Yeah, we were talking to the Commerce Secretary, Howard Lutnick, yesterday about turning down the temperature. I'm not sure that he did a good job of turning down the temperature in that conversation.
They should be grateful. They should say thank you.
They've only got 60 planes
yeah,
or something like that.
They can't defend.
It's going to be an interesting meeting in June, let's put it that way. Let's extend the conversation and head down to the nation's capital, where Anne-Marie is standing by with a special guest. Hey, Anne-Marie.
Hey, John. Well, the man that was turning down the temperature yesterday in the Oval Office was the new Secretary General of NATO, Mark Rutte. And we're so excited he's joining us today. His first interview following that meeting with President Trump. So this is your first trip to Washington as a Secretary General, sitting down in the Oval Office. How was your conversation with the president? We saw the 40 minutes or so that was out to the public, but then you guys had lunch. What did you take away from that meeting?
It was a very positive meeting. We became friends when he was Trump 45, and I was still Prime Minister Minister in the Netherlands. So we worked very well together, and it was a very friendly lunch, and also an absolute clear commitment to the alliance, to NATO, to what the alliance stands for. So it was very optimistic and very positive.
So you took away that Trump is 100% committed to the alliance, even though individuals in his orbit, like Elon Musk, are calling for the U.S. to leave.
He was absolutely clear. There was no room for doubt there. And he did, by the way, state the same when he was meeting with Macron, the French president, and with Starmer, the British prime minister, 2 weeks before. So I tell some of my European colleagues, when they say, well, is the US still connected and committed to NATO? I tell them, you might want to turn on your television and listen to the president when he says this. Because he was on the record, and again yesterday, stating this. So I have no doubt, and there is no reason to doubt that.
Did you see Elon Musk yesterday? Were there any individuals at this table that you had to convince for the reasons why the U.S. should be a part of the alliance?
Well, Elon was not there, but in the conversation, there was nobody there doubting the need for alliance. But, of course, everybody very much pushing for more spending, and particularly on the European side, because we are lagging behind, but luckily we are now ramping up, and we're spending much more on the European side of NATO. Look, what is happening now in Germany, this is staggering, potentially €500 billion euros/dollars extra on defense spending. That's historic.
So the Germans have reached this morning reporting out of Germany on this debt package. As you say, there's going to be a lot more money coming out of Germany for defense.
It looks positive, I think. They had to deal with the Greens, but it seems that they're getting there.
Yeah, it seems like they're getting there, and there will be an agreement in place. There is a debate, though, when it comes to Europe, or whether or not Trump is helpful because of things like this. The Germans are finally starting to spend on things like defense, not having to outsource it to the United States. Or is Trump unhelpful because he really is shaking up the global order, not just when it comes to militarily, but also things like tariffs. Yesterday, 200% on European wine, champagne, and cheeses. How do you view his impact on the continent?
I think when it comes to defense spending, he is extremely helpful. And I told him yesterday, Trump 45, again, his first term. We had pledged in 2014 to go to the famous 2%. Nothing happened. He came in 16, 17. And then immediately you see the defense spending coming up. Now the aggregate amount is about 700 billion, going into 1 trillion extra. That was Trump 45. Now the second Trump presidency, he is only in his 50th days now, I think, or 51st day. We have seen 800 billion from the Europeans. We have seen this half-term package from the Germans, but also the Brits, the Swedes, the Czechs, the Belgians, so many others ramping up. And this is because they sense that with Trump in the White House, this is necessary, but also, of course, because we all realize in Europe and here in the US that Russia and China pose a threat, and that we have to rearm ourselves because they are doing this at an incredible pace.
But on trade, he definitely is ratcheting up the tension when it comes to trade policy, tariffs with the European Union. Does that send the wrong message to NATO adversaries?
Well, I would leave that to the EU and the US, but when I look at from an alliance point of perspective, I would argue that Europeans are buying 4 times more when it comes to defense industrial products here in the US than the US is spending in Europe. And I don't mind that difference, so that it is a 4-to-1. So you guys are getting much more, a better deal here than the Europeans. And that will only become more, because if we keep the equation the same and spending more, you will have the overall amount being involved really getting up. And already it's a couple of 100 billions over the last couple of years. The F-35s, the Patriot systems, and all the other great products from the defense industrial base here in the US being bought by the Europeans. And that's good news.
I know you're preparing for the Hague summit this summer. Do you think you're going to increase defense spending to what the Trump administration is calling for, 5% of GDP for all NATO members?
Well, what we are doing is we have a process in place where we exactly determine what are the gaps, and these gaps are big. So we have to do a lot more than we're doing now, so it will be considerably more than 2%. We first now, the next couple of weeks, will decide on exactly what the gaps are in terms of long-range missiles, in terms of our armies, which are depleted, in terms of our defense against ballistic missiles, our command and control systems, all that. That is the priority now, and then you will come to a new number, and that will be much more than 2%. I believe it will be more than 3%, but I cannot now totally envisage where it will end up. But when you look at the hundreds of billions pouring in now, basically it is already happening, and that's the good news.
Do you think that's an optimistic goal, or will that be a red line for this administration, say 5%?
I think what we need to do collectively is to make sure that we can defend ourselves. At this moment, we cannot defend ourselves going forward. Yes, now, but not in 4 or 5 years, because the Russians, for example, in ammunition are producing in 3 months what the whole of the alliance, including the US and up to and including Turkey, is producing in a year. So we have to ramp up defense industrial production, and we have to ramp up on the European side and the Canadian side the defense spending. And we will decide on that over the next couple of months. And it has to be content-based, but it will be much, much more. And again, when you look at the numbers coming in now, the Trump effect of this new Trump presidency is clearly there.
When it comes to defense of Europe, did you and the president talk about potentially amending where troops are, American troops, on the continent? Because there were reports that he was thinking maybe pulling out from Germany and putting more troops on the eastern flank, maybe to Hungary.
Well, we didn't go into that detail, but what we know, when Pete Hegseth, the Secretary of Defense, was visiting NATO, he was on the record saying, hey guys, you have to understand that as a United States, we also have to pivot towards the Indo-Pacific. So that means that we have to take care of more than one theater. Yes, the European theater, also the Middle East, also the Indo-Pacific. This, of course, history made you the leader as United States. That means that you have to attend these various issues. And that also will mean probably over time, the Europeans spending more, that you guys will have to look at, okay, where can we best deploy our troops? But that will be a gradual process, taking time and not abrupt.
There was definitely, with this administration coming in, more troops being put on the U.S. southern border. Under the Biden administration, though, there was a surge of about 20,000 troops to Europe. Is this administration going to pull back that Biden surge of 20,000 troops because they have other priorities, like the southern border, like the Red Sea in the Middle East, like the Asia Pacific?
Well, we didn't discuss those numbers in that detail. So,
but would that concern you?
No, what I think is important is that the U.S. is committed to NATO, committed to the whole of the alliance, and is also committed to, if over time the Europeans are doing much and much more, and for the U.S. also to attend to other issues, like in the Pacific, and by the way, as an alliance, as a collective of 32 countries, we can also be helpful in a sense of projecting more American power at the world stage, because the U.S. not being on its own, but embedded in an organization with 31 other allies, giving that whole... Do you
think that was missing in the past 4 years, American power on the world stage?
I think it was there, but I think we could have done much more. And when it comes to the European side of NATO, we were still lacking behind in terms of our defense spending. And again, I think...
there's a hot war in Europe right now, and that's what I want to talk to you about, what's going on in Russia and Ukraine. While you were in the Oval Office, Steve Witkoff, the president's longtime friend, his special advisor, second meeting he had with President Putin in Moscow. Coming out of that meeting, Dmitry Peskov is saying he's cautiously optimistic. When do you think we could see a 30-day ceasefire?
Well, I cannot predict that, but what I can say is that I'm
But you're in more rooms than I am.
Yeah, I know, but let me say this. First of all, the Trump administration, the president himself, broke the deadlock on this war, because he started to engage with the Russians. I think that's positive. With the Ukrainians, that's positive. And there was a deal last Tuesday in Saudi Arabia between the US and Ukraine on pushing for this ceasefire. So this is all good. Obviously, the U.S. administration is now dialoguing with the Russians to see where they are on this. And that will be a step-by-step approach. But this is literally developing over the next couple of hours and days. So very hard to predict when it will happen. But I think this idea of having a 30-day ceasefire is a very wise plan, because it gives you the room to go into more detail on what next.
You've heard from the Ukrainians. They want security guarantees. Did you get a sense from your meetings yesterday that the U.S. is willing to do that?
Well, the U.S. is saying this. First, we need a peace deal / a ceasefire. And the president is very clear on this, that obviously there will be many issues to be discussed and debated when a ceasefire / a peace deal is there. But to discuss how to keep a peace deal, if there is not yet a peace deal, is also a bit strange. Of course, you have to think in parallel.
He's already taken off Ukraine joining NATO off the table. So Ukraine is left asking this question, how are we going to know we're going to have proper security?
Yeah, but he was also very clear, Pete Hegseth in Brussels, but also the president himself, that when there is a deal on Ukraine, it has to be lasting. It has to be durable. Putin should not have to try this again. So the question is then the how. How do you do this? Post a peace deal. Then I would side with the president. You first need to have a peace deal before you can get into these details. Obviously, behind the screens, there will be discussions on the what if there is a peace deal, how then to maintain that. But there are many ways to do that. And we know, of course, that the
Will
French...
NATO be involved? Zelensky's calling for a monitoring mechanism coming from the alliance itself.
I mean, there are many ways to do this, but I think for NATO to be as NATO involved will be difficult, but NATO will maybe always advise and look into what is the best way to do this. But in the end, what we are seeing now is the French and the Brits and the Brits and the Americans discussing how could you organize that. But again, I would caution a little bit that before you get in too much detail in terms of how to maintain the peace, you first need to have that deal. And it is a step-by-step approach, and one after the other. And there, I think, Trump is right.
Do you think we get a deal this year? Do you think the fighting stops this year?
I'm optimistic, yes. And I know
so Peskov is cautiously optimistic. I believe the National Security Advisor, Mike Waltz, is optimistic, and so are you.
I would also be cautiously optimistic about this year, but I hope it is sooner, because the amount of people dying there, the destruction of whole cities happening as we speak, it is really very, very painful, and it is having an impact on so many families and so many people in Ukraine, but also on the Russian side. We know that there were days that the Russians were losing up to 1,500 people dying or seriously wounded a day, but also on the Ukrainian side, so many people dead and so many people seriously wounded.
Before you were Secretary General of NATO, you ran a European country. Would you be willing to do business again with Russia after this? Because we are hearing reports of things like maybe gas deals come back into play.
Well, I mean, I'm not there, because first of all, you have to maintain the pressure on the Russians to make sure that they do whatever is necessary. That's why we have the sanctions, and let's not be naive about the Russians. But longer term, Russia is there. I mean, Russia will not go away. And I've had many dealings with President Putin till 2014. In my first 4 years as Prime Minister, we had many negotiations. And I think it is normal, if the war would have stopped, for Europe to somehow, step by step, and also for the US, step by step, to restore normal relations with the Russians. But we are absolutely not there yet. We have to maintain the pressure on them to make sure that they are willing to engage seriously in talks with the American administration, and of course also with the Ukrainians.
I think the markets and business leaders might be a step ahead of the leaders in this one. We have to end on Greenland, because you were in the middle of this Oval Office meeting, and the president's talking about how he wants to go after Greenland. He wants the critical minerals there. Are you concerned at any point you'll be mediating between two NATO members?
No, I know that they are in close dialogue, Denmark and the US. So I will leave it at that discussion between the two of them. But there is a bigger issue at stake here, and that is the High North, the Arctic. And this includes the US through Alaska. It includes Canada. It includes Iceland, Norway, Sweden, Finland, and Denmark because of Greenland. And I think the president is totally right in saying, and others are arguing also, the Russians rearming there, the Chinese using these sea roads, knowing that we have a lack of icebreakers. There is a reason for these 7 countries, and NATO could be somehow involved here also in terms of advising and bringing the group together, that we have to take care of our defense in the High North. So this general issue he put on the agenda, I think that's positive.
And it's something NATO will talk about this summer, potentially?
Potentially, and I think the 7 countries are coordinating, and if there is a role for NATO, we will always be present.
And we hope to see you there at the summit. Thank you so much,
Thank you so much.
Rutte. Thank you so much for joining in. His first interview of the day after his Oval Office meeting with President Trump, and made it very clear to me, Jonathan, and our audience, President Trump is committed to the alliance.
Anne-Marie, appreciate it. Fantastic conversation. I think it's worth framing. When Mark Rutte was the Dutch Prime Minister, we used to speak to him on a number of occasions, and he would come on the programme, he'd come on Bloomberg Surveillance, and he would say, President Trump was right. He was right to push NATO members to spend more, making that point in this conversation. Defence target needs to be above 3%.
And finally, they are responding, and he said, absolutely, President Trump did help that to happen by applying pressure. And now we have Germany potentially committing some 400 billion euros to build out the defense system.
I love the way Anne-Marie finished that conversation. It was the second to last question, the penultimate one. I think it's so important. If we can secure peace, that's one thing. Can we normalize trade relations with Russia? Because that's a huge ask.
There have been a number of companies that have been kind of flirting with this in off-the-record conversations. There's been a discussion about that with President Trump, talking about how it would be okay. And what Mark Rutte had to say, I think, was important. He was saying, look, we're not there yet. We're not even close to there yet. But longer term, it's there. What are you going to do? Ignore it and its resources? It's going to be a delicate dance, though, and we are a long way out before that happens.
A conversation with the NATO Secretary General, Mark Rutte, there down in Washington, D.C. with Anne-Marie. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. World Liberty Financial, one of the Trump family's crypto ventures, is said to be in discussions with Binance about doing business. Sources say conversations have included the development of a stablecoin with World Liberty. According to its founding documents, the Trumps received 3/4 of the venture's net revenue. Meanwhile, Forever 21 is preparing a bankruptcy filing. Bloomberg has learned the fast fashion retailer could close all of its stores in the coming days. Sources say efforts to find a buyer have failed so far, but talks with one potential bidder are ongoing. And MGM Resorts has a plan to generate hundreds of millions of dollars in added profit through some new initiatives. The company is planning to raise ATM and parking fees, but they're also doing things like recycling sofas and even using robot vacuums. It's also begun replacing front desk staff with self-serve kiosks. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, U.S. growth in question.
We fully wear the fourth quarter, and we may well wear much of the third quarter. First and second quarter are Biden's sort of left behind difficulty, and then you see Donald Trump dig us out, build us up, and by the fourth quarter, you're going to see growth rates.
So that's the difference between Biden data and Trump data. I think we're all up to speed now. Up next on the program, Eric McLaughlin of the Conference Board from New York. This is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
Yeah.
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit. And that's not good for the economy. Growth is really critical. And I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Equities here on the S&P 500 positive by 0.9%, a bounce back in today's session by 1.2 on the Nasdaq. Under surveillance this morning, U.S. growth in question.
We fully wear the fourth quarter, and we may well wear much of the third quarter. For sure, the fourth quarter is Donald Trump's quarter, and the third quarter, his policies start to really embed in America. First and second quarter are Biden's sort of left behind difficulty, and then you see Donald Trump dig us out, build us up, and by the fourth quarter, you're going to see growth rates.
So here's the latest. Commerce Secretary Howard Lutnick doubling down, saying recent soft economic data is not President Trump's, even after tariff worries spark concerns over economic growth. Erin McLaughlin of the Conference Board writing, "We're not forecasting a recession, but are predicting a slowing economy." Erin joins us now for more. Erin, good morning. Good to see you. Let's talk about what your members are telling you. What are they telling you right now, and how have things changed versus where they were just a few months ago?
Our members are very, very concerned about tariffs primarily and about how to plan for tariffs. They're seeing the volatility, the change almost on a daily basis, and understanding how they're going to source their materials and how they are going to plan for the future is causing a lot of consternation.
Which raises the question of how much and how quickly confidence has dropped off. And it's not just in consumers, it's also in corporations. How quickly has it been?
It's been pretty quick. So the Conference Board is very, very well known for our Consumer Confidence Index. Our last reading, which came out a couple weeks ago, only took in just part of that 10% tariff on China. But we saw our third consecutive monthly drop and our biggest drop since 2021. Also, we have write-in responses for consumers and businesses in the survey, and tariffs was mentioned more times than since 2019, which was right after, we saw those initial tariffs with President Trump's previous administration.
One of the big challenges has been that in the past, consumer confidence in particular hasn't translated into a lack of consumer spending.
Yes.
Watch what they do, not what they say.
Right.
Is there a sense that this is different?
There is a sense that this is different because I think that tariffs and inflationary pressure has already been in existence now for quite a while, and that's sort of unprecedented. But we also know that tariffs are going to raise prices, and that middle and lower income consumers have to bear more of the weight of the tariffs. So what we're hearing from some of our members is that they're concerned that the buying will be about, what I need versus what I want. And although consumer spending drives our economy, how consumers spend, is very, very important to the business community.
Is it being influenced by political preferences? Because we see a lot of that in you, Mitch. They talk about it explicitly. Do you see the same thing?
We do see it more broad-based. We haven't, we see that a little bit, but it really, really is a broad-based concern.
Get you, Mitch, again, later on this morning, 10 a.m. Eastern time, and I imagine we're going to see that story all over again.
At the same time, how much do people still have to pay attention? Because just like you think about Target and some of the campaigns and conservatives buy at Target too, well, liberals buy as well. So at a certain point, you have to guess if there is a significant drop-off that could have a ramification economically, even if it is politically driven.
Erin, appreciate your time.
Thank you.
It's difficult to track this economy right now. Erin McLaughlin there of the Conference Board. Coming up next on the program, a range of guests including Ulrike Hoffman-Bouchardi of UBS, Bloomberg's Craig Trudell, Torsten Slock of Apollo, and Ed Al-Husseini of Columbia Threadneedle. The third hour of Bloomberg Surveillance up next.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But An algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Tariffs are bad for growth and bad for inflation.
We're starting to see some elements that could portend to a higher inflation environment over the coming months. One of the key factors, of course, is going to be this rise in tariffs.
The prospect of tariff wars that could last is very concerning.
What will be a problem certainly would be if tariffs are on the maximalist side of things.
It's not that the market can't react to a tariff if we understand what the details of the tariff are. It's that there's so much uncertainty.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
We've said this a few times. February 19th feels like a lifetime ago. February 19th, all-time highs on the S&P 500. We're lower by 10 percentage points since then. And yesterday, entering correction territory for the first time in a couple of years. Equity futures this morning bouncing back, up by 0.8% on the S&P, on the Nasdaq 100 up by 1.1. Later on this morning, just a sprinkle of economic data, one important one, 10 a.m. Eastern Time. Mitch, consumer sentiment.
At a time when you've got a quickly moving economy as represented by the airlines earlier this week, just to sort of emphasize the amount of carnage that has happened, $5.3 trillion has been wiped off the S&P 500 market capitalization since February 19th on a bet of just increased volatility and risk-reward proposition. If it is met with true weakening in the underlying economy, does it have more to go, or are people kind of pricing that in?
The damage done has been phenomenal, not at the index level, beneath the index for some of the biggest names on the planet. We talked about tech throughout this morning. Meta down 20% from the highs of last month. Nvidia down 22% from its highs. Amazon down 20%. All these major tech names have been hitting low after low after low, with a bit of a bounce recently. But even Apple, you're starting to see the analysts come out and say, I'm nervous now about iPhone sales growth in the next year or so, nervous about weakness in China, nervous about a lack of AI, and that's where the focus is right now.
Yeah, NASDAQ saying to the S&P, hold my beer. I'm in actually some sort of true bear market rather than you just simply having a correction. Key question here, this is not due to some of the headline risk, and I think that's important to note. That could be part of it, but it also has to do with DeepSeek, it also has to do with valuations, it also has to do with competition from China more broadly. There are a lot of aspects to this that make it hard to understand exactly where the weakness is coming from in the broader market, given how much of a run-up we had seen in these names.
And better opportunities elsewhere.
Yeah.
Europe. In focus this morning, the German Chancellor in waiting, Friedrich Merz, coming out a little bit later on this morning, expecting some headlines from German politicians throughout today as we report that German lawmakers are coming together to make an agreement with the Greens to push forward this big debt spending plan on both infrastructure and defense.
That's the important part in many people's eyes. Not only do you have defense spending, which a lot of people were expecting, but you have a 500 billion euro aspect of this that goes to infrastructure investment, which potentially could be stimulative. And oh yeah, by the way, is also sending valuations down of German bonds, yields up. How much is this going to be the pressure that really drives some of the yield market around the world?
The additional value in Europe being built up around the potential for peace in Ukraine, ceasefire first and then hopefully a long-term peace agreement. We caught up with the NATO Secretary General Mark Rutte about 30 minutes ago down in Washington with Anne-Marie, who said he was cautiously optimistic we could see that later this year. Now, the next question you've got to ask is that once you've lifted that massive cloud that's been hanging over Europe now for several years, do they normalize relations with Germany and the Russians, Europe and the Russians? Is that the next step?
It feels like that's really far away. Even Mark Rutte is saying that that's a bit of a stretch. So how much of a relief valve is that if there is peace between Ukraine and Russia? I will just say, there are these aspects that we don't think about, like Ukrainian drivers going to Poland and having to do with a lot of the shipping in Europe and actually accounting for lowering prices in the past. There are things that could open up that could help the economy with peace, even beyond just normalization of relations.
Just to check out the German debt market, German bonds lower this morning. Yields are higher by 7 basis points, 293 on German 10s. Coming up this hour, lots to talk about. We'll catch up with Ulrika Hoffman-Burchard, making the bullish case for US stocks, Torsten Slok on the US entering a wait-and-see economy, and Ed Hosseini of Columbia Threadneedle looking ahead to the Fed decision next week, Wednesday, March 19th. We begin this hour with equities rebounding after falling into correction territory just yesterday. Ulrika Hoffman-Burchard of UBS writing she sees downside risk to equity markets in the short term. However, we anticipate that there will be light at the end of the tunnel as progress is made towards budget reconciliation, and we maintain a bullish outlook on the US equity market. Ulrika joins us now for more. Good morning. It's good to see you.
Thank you for having me.
Let's talk about that constructive view. We want to see that light at the end of the tunnel. When's it going to come?
Yeah, so you just referenced February 19th. At that point, we saw a big disconnect between the policy uncertainty on the one hand and the low implied volatility on the other. And we asked our clients to protect their equity exposure. But now, with volatility almost double since February 19th, and the market, as you said, in correction territory, I think it's time for some selective buying in the US. And we don't think there's the all clear yet. There's certainly still some work to go through on the economic side. But we do see, or now it's at least, we think, time to focus on the light at the end of the tunnel.
How selective? Do you do that at the index level, market cap weighted, equal weight? Is it selective, sectors versus sectors, names versus names? How selective?
Pretty selective. We think that there are some profound structural trends that are not going away in this policy uncertainty. AI and electrification are two of those, trillion-dollar investing opportunities, and a lot of the stocks in these sectors have been beaten down pretty severely. So technology, as you referenced, but also utilities and industrials. And that's good hunting ground for bargains at this point in time.
Are you talking about big tech, or are you talking about some of the other opportunities that people were getting excited about? In other words, is this an index-level call that's going to be driven by the winners of old, or is this going to be something different?
It's certainly more the larger cap names that have been beaten down, but I think you still need to be selective because there is going to be some more work on the economic side to work through. There is, some still dark patch to work through. We've seen that CapEx numbers are coming in quite light. If you look at the Philly Fed index, we see M&A activity now at the lows, 2-year lows. And we also have seen in a study that companies that mention tariffs are more likely to revise their EPS downwards. So again, we have to wait until we have more clarity on the budget reconciliation, more clarity on tariffs in April, fiscal policy. But I think once we know, and once companies have that clarity, they'll be spending again.
This is the difficult aspect, and this is what we're hearing from a lot of analysts who come on and they say we're cautiously optimistic, we're starting to buy, because eventually there will be some response from either Washington, D.C. or the Federal Reserve. Somebody will pull the trigger and make some sort of buffer for some of the volatility and uncertainty. Which do you think is going to be the most important driver? Which blinks first?
Yeah, I would count more on the Trump put than the Fed put at this stage, because the Fed really doesn't have that much more room to move. If you think about inflation, it's been trending above the Fed target rate now for almost 4 years. Inflationary expectations are picking up in light of tariffs. So that's going to limit on what the Fed can do. And then on the unemployment side, given the shrinkage in the labor force, we probably won't see a pickup in unemployment that soon. So we believe the Fed is only going to cut 2 more times this year, and therefore I wouldn't rely as much on the Fed put this time around.
How predicated is your bullish view on the idea that we will have a Trump put?
I think the easiest thing for the administration to do right now is to repeal the uncertainty tax. And that is just a function of the passage of time. The budget reconciliation is underway. And again, once we have clarity on those fronts, companies will be able to plan and invest and in CapEx, in hiring. And I think that's going to be a big game changer right now from what we're hearing from companies which are in some sort of paralysis as they don't know what the import costs are going to be and what the export conditions are going to be.
A lot of that's driven by trade. April 2nd is going to be so important for that matter. Is that the point at which we pass peak uncertainty regarding policy? You come out with the reciprocal tariffs, they're big, whatever the number is, and then you move on. Or do we have this story that just lingers for the next several years where it's 25 one minute, 15 the next, and 10 the other? It's difficult to plan around.
Especially because on April 2nd, they're going to come out with a list of proposals that they want to get through. It's going to face a lot of challenges. It's going to take time to get these through. So it raises a question about whether the uncertainty tax is sort of a permanent existence in an environment where that is a feature, as Anne-Marie has mentioned many times, not a bug.
So let's get to one thing that's been supported by that uncertainty tax, and that's gold. Gold, 3K this morning, first time ever. Now, I understand why equities at all-time highs, you didn't like them, and you like them more when they're 10% lower. You still like gold at record highs. Just walk me through why you think your clients should still have that allocation.
Well, it's always good to have a tail risk hedge in your portfolio. That's why we are still bullish on gold. There is a lot of uncertainty still, geopolitically, technologically. So we like it as a diversifier for our portfolio.
Is it a play against the
inflation
dollar?
hedge, of course, also. Yes, of
course.
course.
Is there an FX component to it? Is that what you're seeing clients do?
We think it's a combination of various factors where it's an FX component, it's a hedge component, but we also think it's an inflationary hedge, especially with tariffs looming. So a lot of good fundamental reasons still to be bullish.
There's a bigger question about whether there's a structural change underway. And the gold is sort of an example of that, where there's a move away from dollar assets more broadly. And it doesn't have to be a massive move. It's not like, debase the dollar. But it does speak to some of the growth opportunities elsewhere, like in Europe and China. How much do you buy into that idea, and how much do you reject that as maybe some idea that's gotten ahead of itself?
Yeah, so we came into the year quite bullish on some international opportunities. Asia ex-Japan, in particular China tech, we had been bullish on for quite some time. In particular, our thesis was that the China AI mode, especially the algorithmic AI mode, was underappreciated. But we feel now that that's pretty well understood by the market. We actually just took profit on both of those positions and also took profit on a tactical call on the DAX. Because, again, we came in thinking that if Merz is elected, probably Germany is going to pivot more towards a pro-growth policy. We've seen this happening. Now we're taking a pause. But we do think the policy uncertainty that we talked about for the US has not really been priced in internationally. Tariffs are not a good thing for China. They're not a good thing for Europe. On top of that, the US is going to start export controls. We have the AI diffusion regulation hitting in mid-May. That's going to restrict access to AI chips, in particular for China further, because of now eliminating the possibility of rerouting. So those are all things that the market is not enough focused on in our mind, and that's why we are now much more constructive relatively on the US.
Bank of America signaled something similar a little bit earlier this morning. The DAX is up again today by 2 full percentage points, a rally across Europe once more. Ulrika, good to see you. Appreciate your time. Thank you.
Thank you.
Ulrika Hoffman, Burchadi there for UPS. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. U.S. Senate Democratic leader Chuck Schumer dropped his threat to block a Republican spending bill, meaning the government is likely to avoid a shutdown on Saturday. The two parties have been engaged in a standoff over the Democrats' insistence that a spending package include some restraints on Elon Musk's federal cost-cutting crusade. Meanwhile, Johns Hopkins University is slashing over 2,000 jobs due to the Trump administration's cuts to U.S. aid programs. The $800 million loss in funding will bring a halt to health initiatives, including HIV and tuberculosis research, with experts warning of setbacks to global public health. And the Tampa Bay Rays are backing out of a deal to build a new $1.4 billion stadium in St. Petersburg. The team was expected to partner with the city and county to build the ballpark and was facing an end-of-month deadline to commit to producing the $700 million they had agreed to contribute before now backing out. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Was that you, the baseball?
Yeah, oh yeah, big time. It's like sports roulette.
I thought you were into baseball. I thought that was your sport. No?
Baseball, Mets.
Okay,
I mean, it's
that's
a family
what the
thing.
baseball is like.
Yeah.
That's the kind of music they play.
Well, I know how you feel about it, man.
Yeah.
All right, fine, we'll talk
I'll go to
F1.
Yankee Stadium now and again just to take in the environment and
Just for the food?
the atmosphere and the amazing food that they supply there too.
Have a beer?
More on that another time. Up next on the programme, the morning calls. It's bad, eh? Plus, Bloomberg's Fred Trudell as Tesla warns of tariff impacts, of course. Mets fan, forgive me. We'll talk about Tesla next on the programme. You're watching Bloomberg Surveillance.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States. Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
So the opening bell is about 1 hour and 14 minutes away, and going into that, equity futures are firmer by 0.9% on the S&P and up by 1.2 on the Nasdaq. Let's get you some morning calls. First up, Baird upgrading American Express to neutral, noting more balanced risk-reward. That stock at the moment in the pre-market is firmer by 1.5%. Your second call from Stifel, cutting its price target on Carnival to 30, citing softer consumer trends. And finally, Mizuho lowering its price target on Nvidia to 168, but seeing a major catalyst ahead with the company's developer conference just next week. That stock is bouncing by 2.6%. Let's turn to Tesla, the EV maker expressing concern about retaliatory tariffs from other countries, saying any countermeasures could drive up manufacturing costs and make it less competitive overseas. Joining us now, Bloomberg Craig Trudell out of London. Craig, let's talk about this. When Tesla writes a letter, who signs it? Who's it from?
It's a great question, and in this case, nobody. So I think the Financial Times was first to report on this letter, which we should give them credit for, and they happened to quote someone anonymously saying that the reason that this letter was unsigned was that nobody wanted to get fired for sending this. This may sound a bit alarmist, and of course, Elon Musk talks about his belief in free speech, but that being said, we have seen instances in the past where people internally who have written letters that could be perceived as contradicting him or criticizing him have lost their jobs, and so that is, of course, it seems like a valid concern in this case.
Craig, wouldn't it also be valid to expect an automaker to be lobbying the government on this point anyway? Shouldn't we also expect GM and Ford, Stellantis to be doing exactly the same thing?
Yeah, absolutely, and we've heard Ford CEO Jim Farley do so quite publicly. I thought, just a few weeks back, there was a analyst research conference where, Farley talked about the idea that what we've been hearing from the administration is a lot of desire to want to help U.S. manufacturing and help the U.S. car sector in particular, and he both welcomed that and yet said, but what we're actually seeing is a lot of cost. And, this is a case where, industries don't get much more globalized than the car industry. And, in the U.S., when we sort of evaluate how much parts content is locally sourced, by law, we loop in Canada in how we calculate those figures. And, that goes back to the Clinton administration. So, going back to when that was enacted, I think it would have safely been assumed that, the U.S. and its neighbor to the north would always be on good terms trade-wise. And, that has very much been challenged in the first couple of months of the Trump administration.
Craig, this unsigned letter had a lot of different components to it. One of them was potential retaliation from other countries. Some was a potential drop-off in demand, which we have seen for Tesla vehicles anecdotally in places like Europe. There was also this: even with aggressive localization of the supply chain, certain parts and components are difficult or impossible to source within the United States. That's really interesting, Craig. Can you speak to that at a time when we've heard this increasing trope from the Trump administration, bring manufacturing back and then you can avoid tariffs?
Yeah, I mean, I guess the simple answer to that is it's not so easy, right? I mean, I think the Inflation Reduction Act, was an attempt on the part of the Biden administration to address the fact that there are parts of the EV supply chain that just don't exist in the U.S. And, Tesla itself, in the course of the IRA being implemented, sort of took advantage of something of a loophole that, when it was being sort of ironed out how exactly some of these content requirements were going to be met, they took advantage of the fact that there was some leeway granted that allowed for Tesla to import batteries from China for a short while before the Treasury implemented rules to really sort of solidify those requirements. And so, it's not very clear from this letter what specifically they're citing in terms of particular materials or components that they say is impossible to source from the U.S., but it absolutely is the case that China dominates the EV and battery supply chain, and Tesla, very much taps into that, not only in their Shanghai production, but even for U.S. vehicles as well.
John started the conversation in the right place, talking about who signed this letter and ultimately who's running Tesla, who is ultimately calling the shots at a time when what's good for the business might be kind of at odds with current policy and rhetoric coming out of the White House. We were talking with Dan Ives a perennial bull, and he was saying this is kind of the moment of truth for Tesla, and Elon Musk has to leave the government or his Doge office and pay more attention to Tesla, or else this is going to become a real problem. How much is that what you're hearing more broadly among Tesla investors?
I mean, it just reminds me very much of the Twitter takeover, right? And you saw in the course of that year when Musk initially bought a stake and then pursued the company on and off, tried to get out of the deal. You saw that really tank Tesla shares, right? And early the year after he closed that deal, that acquisition, Tesla staged an event where they had something like 15 executives on stage, and it was a not so subtle indication of, look, we're more than just Elon Musk. We have this really strong bench behind him, but this is a company where it hasn't necessarily leaned into that. That was a sort of rare instance of them having others within the company sort of share the spotlight with Musk. It has both worked to their benefit over the years for Musk to be so synonymous with this company. I think what we're seeing lately is perhaps an over-reliance on his star power, because to the extent that his star fades, it is really problematic that when you think of Tesla, you think of Elon Musk.
Craig, let's just wrap it up by talking about the whole sector at the moment, the three big players. Could you help us understand, just give us some insight into how they're operating at the moment? I imagine they didn't just wait and do nothing, see the tariffs and then start to react. How did they prepare for this? We've got tariffs on steel and aluminum. We've got tariffs on China. Clearly, it's going to disrupt them in some way, shape or form. How did they prepare for it, and how are they responding now?
I think the sort of short answer there is it's really difficult to prepare for it when policies are changing sort of day to day and even within a day, right? And so there are some actions that manufacturers can take to try and in the short term maybe stockpile parts. I'm sure they are also looking at what options they may have to perhaps add a shift here or there in terms of the plants that they do have in the U.S. to sort of make up for any tariffs on products coming in from Mexico or Canada. But these are incremental moves, right? And if they were to go so far as say add another plant in the U.S. or multiple plants, this is a process that plays out over 2, 3, 4 years. Do you make that investment not knowing whether or not this policy will last beyond this Trump term? It's a really tricky proposition for any CEO leading a car company right now.
Craig, appreciate the update and the clarity. Thank you, sir. Craig Trudell there of Bloomberg, out of London on some of the big automakers worldwide. This is the issue you've got at the moment. I think the push is pretty clear. Secretary Besson's been very transparent about it. Rebalance the economy, do all of those things. Got it. The disruption in between, the detox you've got to go through. You can't just take one plant from one country to another and do that overnight. It takes a while to trigger that supply side response, and we've talked about that now for a number of weeks.
And you need a consistency in terms of some policy, and that is part of the issue that a lot of these companies are dealing with. In the Financial Times article that first reported on this letter, they said, citing a person familiar with the process of sending the letter, it's a polite way to say that the bipolar tariff regime is screwing over Tesla. It's not just a matter of tariffs or not tariffs. It's a matter of consistency and clarity, which is a theme that we keep hearing from, the idea of the uncertainty tax.
It's not the policy, it's the policy volatility. It's the change from one day to the next, 1 hour to the next at the moment, and that's what's complicating things. Tesla, so far year to date, is down about 40%. That's something like $500 billion of market cap. Up next on the program, Torsten Slock of Apollo on what he calls a wait-and-see economy. What that means for the bond market with Ed Al-Husseini of Columbia Threadneedle. That conversation just around the corner from New York. You're watching Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equity futures on the S&P about 60 minutes out from the opening bell. Session highs now up by 1 full percentage point as we get set to avoid a government shutdown this weekend and open the door for a real conversation about the policy that is friendly for this financial market, and that is tax cuts. Maybe that conversation ramps up in the nation's capital over the next several weeks and months. Equities up on the Nasdaq by 1.4%. With some movers going into the opening bell, here's Yahara Hecker. Say, Yahara.
Hi, John. We start with Peloton shares. Those are up nearly 8% here after the team over at Canaccord upgraded the stock from hold to a buy. They're saying Peloton is the clear leader in the connected fitness industry because of its early investments, as well as a member base that's both established and loyal. Next up, we have shares of DocuSign. Those are up 11% now. The e-signature company delivered strong results. Bloomberg Intelligence saying the growth in billings, including 11% in the fourth quarter, stands out given the economy, because as we know, we have seen signs of business optimism falling, specifically among small businesses. And last up, we have another riser for you, and that is Ulta Beauty. It's up 8.4%. And while it was a mixed picture when it came to results and the outlook, investors seem to be increasingly confident in the new CEO's ability to navigate the competitive beauty market, as well as what they're calling consumer uncertainty. We've heard that one before, of course, but the retailer's saying 2025 is a transition year for them, and investors look to be along for the ride. John?
Stock is up by about 8%. Yahara, thank you. Thanks for this morning. That's the update on the US side of things. Better news. Let's talk about the better news taking place over in Europe as well. Euro-dollar session highs back through 109. We've reported earlier on this morning that the German government getting set to push forward some of the Chancellor-in-Waiting's plans to spend money on defense and on infrastructure as well, coming to an agreement, reportedly, with the Greens. So that's important. Let's hope that happens for the benefit of those of you that have been long European equities and short German debt for the last few weeks. We've also got this news as well from the G7 foreign ministers meeting over in Quebec, coming from the Canadian foreign minister, that ministers are finding common ground on Ukraine. This really echoes what we heard from the NATO Secretary General Mark Rutte about an hour ago, sitting down with Anne-Marie in Washington, D.C., cautiously optimistic on finding an agreement around Ukraine over the next several months.
Yeah, the discussion now heads over to Russia, and a question of how much Vladimir Putin wants to agree with things or not. The initial reporting is that there is a huge asterisk around some of his asks, and there's a question of how far the U.S. will be willing to push the Kremlin to try to come to the table. If this does come through, what does it look like, and how much of a boost does it give to the euro region? And that, I think, is what a lot of people are looking at.
It's given a boost to German yields again, up 8 basis points now on a 10-year maturity, 2.93. Another line from the Canadian foreign minister. We'll keep the pressure on the United States. We're seeking off-ramps on tariffs. So let's talk about trade. Investors assessing the market impacts. Consumers and businesses already readjusting. Torsten Slock of Apollo writing, this is a wait-and-see economy. Consumers are more reluctant. The bottom line is that this eventually leads to a slowdown in the hard data, and markets should prepare for that scenario. Torsten joins us now for more. Torsten, good morning.
Good morning.
We've seen the shift in the soft data. The last time we spoke, you raised the issue. I believe Lisa asked you the question. Would that soft data bleed into the hard data? Do you sense a inevitability now towards that?
We are beginning to see that if you look at the high-frequency data. So over the last several weeks, we have seen, and I know some of these indicators are a little bit special, but we've seen the number of people who are going to movie theaters, number of people going to Broadway shows. If you look at the TSA data for how many people fly in airplanes, even if you look at how many people are visiting the Statue of Liberty here in New York City, all that has actually started to weaken. And now we get another soft data print here at 10 with the Michigan sentiment for consumers. So overall, it is still a little bit too early, but given that we have this wait-and-see situation, both for consumers and for corporates, it does make sense that the soft data should eventually begin to spill over to at least some weakening in the hard data.
One feature of this cycle that I think a lot of people underestimated, you not included, is the resilience of this economy. What is our capacity to absorb shocks now? Has that been reduced?
Well, that's a very important question because that depends on the nature of the shocks. And we're facing two shocks at the moment, namely DOGE, which is laying off government workers. Estimates suggest that there will be around 300,000 workers that might be losing their jobs. Remember that for every federal worker, there are 2 contractors, according to Brookings. So Brookings studies show that in total, true employment in the federal government is roughly around 9-10 million people. So if you now think about total number of households is 130 million, and someone in a federal worker or contractor lives together with someone in the private sector, you get that as much as 10-15% of all households in some way or another is being impacted from a sentiment perspective by DOGE alone. And tariffs, of course, also in particular impacts anyone who is associated with trade with Canada and Mexico. And you have that is also a particular, of course, across the border to the north and to the south, playing a significant role in a number of states. So the bottom line is, it's not only tariffs and trade war, it's also the combination of the risk that government workers and contractors potentially losing their jobs that are the main reasons why the soft data is weakening the way it is. And it's not only consumer soft data, it's also corporate. If you look at the CapEx planning from the regional feds, Dallas Fed, Philadelphia Fed, New York Fed, that's showing that businesses in those districts are saying we're beginning to cut back CapEx plans. Likewise, NFIB, also roundtable surveys, CapEx planning is also moving lower. So both consumer confidence moving lower, corporate confidence moving lower. It is a precursor for a slowdown coming in the hard data.
There's an argument being made that if what was propping up the United States economy was government spending, it wasn't that strong to begin with. And this is actually somewhat of a withdrawal from a sugar high from an incredible amount of fiscal spend in the direct aftermath of the pandemic. Do you buy that?
There is some truth to the detox argument in the sense that if you look at hiring in non-farm payrolls over the last 2 years, 25% of jobs created in 2023 and 24 were government jobs. The previous years, it was like 5-10%, much less. So a very significant part of jobs in the last 2 years have been coming from the government sector. So it is true that job growth has been slowing in the private sector, even going into these shocks that we're looking at the moment.
Heading into 2025, you were pretty clear that you think that the inflationary shock was going to be maintained and that it was going to create a real problem for the Fed to actually offer a response to that kind of weakness in the economy. Do you continue to see that, even though the shocks that we're seeing right now to policy might have a bigger ramification on growth than you had previously expected?
Well, the real challenge is that going into tariffs, we had that inflation, unfortunately, was still too high at around 3%. And most calculations suggest that you will add roughly 0.5 percentage point to core PCE as a result of tariffs. So it makes a huge difference where you start. If you start with inflation at 3 and you add 0.5%, of course the risk is that you will have too much upside and we're way above the Fed's target. Whereas if inflation had started at 1.5, which is where we were in 2016, and you add 0.5%, then inflation will move up towards the Fed's target. So the problem was really that the starting point for inflation when these policies came along was that it was unfortunately well above the Fed's target. So the risk is in this situation that you have inflation moving higher and growth slowing down, which of course is the definition of a stagflationary shock.
We were talking to Mohamed Al-Arian earlier this week, and he made the point that given these dual shocks, the Fed should probably allow inflation to run a little bit hotter for a longer period of time and address the growth issues and cut rates at least once this year. Do you agree that that's more prudent at a time where there are these stagflationary forces starting to loom?
Absolutely, because the Fed has the dual mandate. On the one side, if growth is slowing, is saying the Fed should be cutting. If inflation is going up, is saying the Fed should be hiking. I think the Fed will look at if growth starts to slow and if we over the next several weeks begin to see that unemployment begins to go up. Let's not forget that non-farm payroll is always done in the week of the 12th, means this week. So this is the week when they do the survey for the employment report. And if we do believe that this week was somewhat intense on the policy front, then there is, of course, a chance that non-farm payrolls for March could be on the weaker side. And if that's the case, then in the next several weeks, and particularly going into April, and with the April 2nd deadline also from Trump with the reciprocal tariffs, we come to the conclusion that the risk is that we might begin to see growth slow down. And the Fed will say, well, as long as inflation expectations are anchored, yes, actual inflation may be higher, but if inflation expectations are anchored, they will be focusing on growth slowing down. And therefore, the risks are that markets will be pricing in more cuts at the time. And by the way, it looks like from stock markets that they are almost saying, well, the Fed should be cutting many more times, whereas rates markets are saying, no, we only need 2 more cuts. So there's almost an inconsistency between the messaging from stocks that are now in correction territory and rates markets saying, no, we only need 2 more cuts.
In the news conference on March 19th, next Wednesday, how does Chairman Powell address those issues? What are you looking for?
So I'm looking very much for how much he's focusing on the soft data slowing down. He did do that at the US NPF last Friday here in New York City, where he was in his prepared remarks saying, everything is generally okay. But when he was sitting down with Anil Kashyap and asked questions, he was more saying, hey, something is going on that has some downside risks that we maybe should be putting more weight on. So I do think that he will begin to talk about, well, there's softness in the soft data, but maybe we also worry about softness in the hard data.
We have seen this incremental shift from the November meeting into December. We don't assume, we don't guess, we don't speculate. Then in December, there was some assumptions, some guessing, some speculation. And then I agree with you. The recent address we had from Chairman Powell, there was another subtle shift. Just started to tackle policy issues head on in a way he hadn't done in the previous few months.
And on some level, he kind of has to, because there is a sort of scenario analysis that has to come from the Fed for them to even be relevant about how they're measuring some of these aspects. And that's probably why the Statement of Economic Projections, which could be a dartboard, but is sort of a messaging tool about how they're going to potentially respond to what is transpiring in policy and how it's transpiring in data, even if it doesn't necessarily come to full pass.
The difference now, I guess, is we're actually getting the policy. They don't have to speculate about it anymore. But that policy comes with a lot of volatility. And Torsten, they've got to manage interest rates through the cycle. Maybe Chairman Powell steps down in the next couple of years. I imagine he will. I don't know for sure, but I think we all think he will. I want to understand from that perspective, you sit there and you acknowledge the risks right now, but also you've got to think about tax cuts, the potential for looser regulation further down the road. How do you manage through the cycle with that in mind?
Well, that's why this debate about is it policy dependent, is it data dependent, becomes really, really important, because, of course, the policy that's in place suggests that, well, so far the 2 things that we have seen from the beginning is DOGE, which is putting the unemployment rate up, and also tariffs, which is putting inflation up. So if that's the case, they need to deal with that shock as the first thing, even, as you say, if there are other policies coming on deregulation, on lower taxes, and potentially also more energy production.
Torsten, Clinic, as always, good to see you, sir. Looking ahead to next week, March 19th for the Federal Reserve, next Wednesday for that meeting, including a news conference and forecasts from the chairman, Jay Powell. Torsten Slok of Apollo. Another read on the U.S. economy coming up a little bit later. UMich consumer sentiment crossing at 10 a.m. Eastern time. Got some data through next week as well. Bloomberg's Mike McKee joins us now to break it down. Morning, Mike.
Good morning, John. Well, Torsten was talking about consumer confidence as a sign that maybe we'll see some reaction in the hard data going forward. And we do have an expectation for a decline again in the Michigan consumer sentiment numbers and a rise in inflation forecasts from Americans. But is that really going to translate? We'll find out Monday because we get retail sales. Although these are February numbers, and so the question is, are they reflecting what's been going on in Washington and the new policies of the administration? That's the Fed's dilemma, and we'll be talking with Jay Powell about that, obviously, on Wednesday. Do they have enough information at this point to give you a valid summary of economic projections and a valid dot plot? The Fed officials I've talked to say not really. It is more like Lisa said, a dartboard at this point, because they're still waiting to see how big the tariffs will be, who they'll be on, and how that feeds back into the U.S. economy. So we're still kind of up in the air. And while we will get some hard data next week, it doesn't necessarily reflect what's been going on so far.
Mike McKee on the latest. Thank you, sir. Looking ahead to the data later this morning at the Federal Reserve next week. Need to talk about this right now, developments over in Germany. So the so-called Chancellor in waiting, Friedrich Merz, holding a news conference right now and indicating the CDU, the SPD, the Greens have reached a deal on a fiscal package and giving some details. on what that deal actually includes. A special fund for infrastructure of $500 billion. The infrastructure fund is only for additional measures. Getting some details from them in that news conference taking place right now.
Which is the reason why a lot of people are hoping this actually does boost growth, and the reason why you're seeing that type of move in equity markets, but also in bond markets. This is clearly a new German regime where they appear willing and able to get some sort of spending package through. We are seeing German 10-year yields at the highest levels going back to 2023 and rising further.
Yields are up by 7 basis points. It's quite a move we've seen. Ed Al-Husseini of Columbia Threadneedle writing on the global fiscal outlook shifting. Tariffs and Doge shock have had no meaningful impact on the real data so far, but policy uncertainty is likely to continue as long as administration struggles to define wins. Ed joins us now for more. Ed, good morning. Good to see you.
Good morning.
All these details coming out from the US side of things, the European side of things, and stuck in between is the Treasury market. What drives what? What doesn't drive what?
Look, I think we can only focus on one thing at a time in the Treasury market. And the focus so far this year has been a reassessment of growth. And it's been a clear reassessment to the downside. We started the year with growth expectations really nailed to the ceiling. And now I think there's just a broader range of outcomes that's in front of us, and that's what's in the price in Treasuries.
We were just talking to Torsten Slok, who said that right now Treasuries are pricing in maybe 2 rate cuts, saying that's all that's necessary, while stock markets are suggesting a lot more is needed. Who's right?
I think the answer is always they're both pricing in the same thing. It's very rare that markets diverge in such a way. We just started from different points. We started from a point where Treasuries were relatively cheap, stocks were quite expensive, and we've re-rated down, right, about 10% down in terms of stocks, 70 basis points in Treasuries. We're roughly in the right zip code at the moment. And I think, to Thorsten's point, right now the market is waiting to validate some of these expectations, and the expectations are frankly a little bit on the negative side.
In terms of growth, in terms of just what we could see going forward. I guess what struck me, and I've been thinking about this the whole week, that a lot of the people who are bullish on risk assets have confidence that there will be some put. Either it will come from Trump or it'll come from Powell. Either someone will come to the table and rescue sentiment with either some sense of certainty or a rate cut. Do you believe that? Do you think that one is sort of more likely before the other?
I have good news and bad news. The bad news is there's no put. The good news is that from an investment perspective, high-quality bonds have done a really good job of buffering the drawdown in equities. There's always this outstanding question, in an environment where there's more inflation uncertainty, higher inflation risk, will bonds play that role? And we've just had a 10% drawdown in equities. Bonds did a fantastic job of buffering against that drawdown.
Not this week, though. Totally unchanged on a 10-year yield, and the equity market's down 4%. What's that about?
We front-loaded a big chunk of the move. We had 70 basis points in terms of 10-year yield that's come down. We're now, again, kind of trying to figure out, does it make sense for Treasury yields to move lower? That would be validating a quite negative outlook, and it's not in the data at the moment.
Do you think developments elsewhere are complicating what could happen with Treasuries? And by developments elsewhere, I mean Germany. And this headline crossing just moments ago on the Bloomberg terminal, that the Greens party is backing the fiscal reform plan in Germany that the Chancellor in waiting, Friedrich Merz, is driving forward. Now, he also says the fiscal discipline remains important. I understand in Germany you've got to say that when you do things like this. But this is a massive change in Germany, and bond yields have been flying there. What does that mean? This is a global bond market. What does that mean for Treasuries?
It's been striking that the spillovers from Europe back into the U.S. have really been quite de minimis so far. There is this beginning of a fiscal conversation in Germany that's quite aggressive. I don't want to run away with it. The market is making the assumption that, one, it's really going to constrain the European Central Bank in terms of further easing. Two, it's going to be growth positive in the short term. And we've learned that spending on defense and spending on infrastructure takes a really long time to percolate into the economy. Those multipliers tend to be quite low. So it is a massive shift. It's a generational shift in the way Germany deals with debt. But I also don't want to run away with it.
Would you buy this 10-year here at 292? Does that make sense in Germany yet?
I would say not yet. I think I want the market to get a little bit more excited about growth. We're in the early stages. I like for things to overshoot a little bit more. We had that in the U.S. at the end of last year. I don't think we're quite there in Germany yet.
Do you think it becomes problematic for the periphery, where yields are also moving higher? I guess we could point to foreign exchange and say the euro and the stronger euro is validating the fiscal expansion. We're not worried about that right now. But how do you think about the rest of Europe, the south of Europe?
I actually think it's a little bit more problematic for the core. Europe has been in this unusual environment where peripheral growth has exceeded growth in the core significantly in the course of the last couple of years. Spain, Italy, Greece, they've seen fantastic levels of growth driven by services. In the core, we've struggled particularly with manufacturing, which is highly interest rate sensitive. So we are not yet at a stage, but we need to have this discussion around higher rates are going to put a dampener on growth in the manufacturing sector. A stronger euro is going to put a dampener on growth in the manufacturing sector. So there are going to be significant offsets to this fiscal stimulus up front.
Yields are up this morning, that's for sure, up by 7 basis points over in Germany at 2.92. The brilliant Ed Al-Husseini there of Columbia Threadneedle breaking down the global bond market today. German bonds lower, yields are higher. German politicians coming to an agreement. They'll have to vote on this on Tuesday, I believe. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. The Trump administration is tightening sanctions on Russia by restricting payments for energy, even as it pursues a peace agreement between Russia and Ukraine. The White House did not publicly announce or acknowledge the change, which was put in place by the outgoing Biden administration. And we mentioned this story earlier, but worth repeating, an American Airlines plane caught fire at the Denver International Airport. The Boeing 737 made an emergency landing due to engine vibrations, then caught fire while taxiing to the gate. 172 passengers and 6 crew members were safely evacuated. 10 people suffered minor injuries. And Comcast is expanding its partnership with the Olympics. The two have agreed on a deal that extends NBC's media rights for the games through 2036. The $3 billion agreement also elevates Comcast from a media rights holder to a strategic partner. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Thanks for this morning. Appreciate it. Up next on the program, we'll set you up for the week ahead. We'll give you a sneak peek of next week. The headline, though, Chairman Powell, Fed decision March 19th on the Wednesday. And we'll speak to Anne-Marie in just a moment. From New York City, this is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never.
Go.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The opening about 37 minutes away. Equity futures positive by 1 full percentage point on the S&P. On the Nasdaq, bouncing back by 1.3. Here's the trading diary through today, through the weekend, and into next week. 10 a.m. UMich consumer sentiment numbers. 12 p.m. President Trump signing another round of executive orders. Later on today, the Senate voting on the spending package. Sneak peek of next week. Retail sales on Monday, Wednesday. The main event, a Fed rate decision and Chairman Powell news conference. Let's touch base down in Washington, D.C. with Bloomberg's Anne-Marie. Anne-Marie, can we go quietly into the weekend?
I think we can now that at least the government's not going to be shut down. But I wouldn't say anything is quiet, especially with Donald Trump back in the Oval Office. Maybe you can expect a few trade headlines. Remember, Jonathan, it was just yesterday that he talked about 200% tariffs on European wine, cheese, and champagne. And I spoke to Mark Rutte, the NATO Secretary General, about this, all this angst in Europe because of the trade story. But there's also debate on whether or not Trump is actually doing more for Europe when it comes to defense. And we're seeing that play out today, with Germany seemingly having an agreement when it comes to spending. And Mark Rutte made it clear to me that his conversation with Trump yesterday, Trump is committed to the alliance and that he's actually helpful and an asset to pushing the Europeans to be able to defend themselves and spend more.
Anne-Marie, appreciate the update. Anne-Marie, thank you. We've said this a few times on this program, Bramo, that ultimately the president might push the likes of the Europeans to do things that are good for them.
Which is what we just saw in terms of this proposal that was agreed upon in Europe, in Germany. This includes earmarks for certain projects, I assume, for the Green Party, like 100 billion euros for already attributed green funds and other things as well.
I think we'd all like to go quietly into the weekend. Let's try and make that happen. Coming up on Monday, Jonathan Stubbs of Berenberg, Henrietta Trays of Vader Partners, the OECD Secretary General Matthias Gorman, Neil Dutter of Renmac, and a whole lot more. From New York City, have a brilliant weekend. This was Bloomberg Surveillance.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and Radio from Tennis Channel. Defending champion Iga Swiatek continues to rewrite the history books. The five-time major champion clinched her 10th straight win at the event with a comfortable victory over Qinwen Zhang. The former world number one becomes the first woman to ever reach 4 consecutive semi-finals and just the third to win 3 back-to-back quarters.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
To drive productivity and improve efficiency, Prudential has made significant investments in data analytics and artificial intelligence. Janella Frias plays a key role in integrating these tools into the company's processes.
We always need people. We're in the people business. But more and more, if we really want to provide the right customer experience, fast access to products, it's about technology. Technology has always been an enabler. Now it's a strategic differentiator.
Give me a sense of
AI in Prudential. What are you experimenting with?
A few areas. One is around customer experience. In our individual life business, our underwriting process has gone from about 20 days to minutes. In our group business, we have partnered with a number of different fintechs to really improve customer experience, to bring on board capabilities, things like claims management, where we can process a disability claim faster and help people get to work faster.
How much productivity uplift are you getting and will you get?
We're probably getting 10% at this point, but I think over time that is where the value is, and it will then allow us to take our capacity in the form of people and redirect it to more value-add activities.
In a nutshell, it means turning the menial into meaningful. It can be both a huge saver of time, but it can also provide real insight.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
All right, we're looking at futures up after an official correction yesterday, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak off on assignment, and Bloomberg Open Interest starts right now.
Coming up, bouncing back stocks looking to recover some ground after sliding into correction territory yesterday, with the S&P 500 capping a 10% plunge from its peak in mid-February. However, Bank of America strategist Michael Hartnett says this is a technical correction and not the beginning of a bear market. On Open Interest today, Greg Boodle of BNP Paribas and Rob Arnott of Research Affiliates will weigh in. Plus, Senate Democratic leader Chuck Schumer backs down from his threat to block a Republican spending bill on concern a government shutdown would hurt the U.S. economy and reflect poorly on the Democratic Party. Katie?
All right, all that and more coming up. Let's take a look at these markets just all over the place. As Matt said, finally entering correction territory yesterday. You're seeing the dead cat bounce today, up about 1% on the S&P 500 pre-market, even more when you take a look at the NASDAQ 100. Even still, even if we hold these gains, this is shaping up to be perhaps the worst week of the year, depending on how we finish up. Heading into the close yesterday, the S&P 500 was down 4.3% for the week, so we'll keep a close eye. And then you take a look at the bond market right now. Yields actually rising. Not so much of a haven bid. There wasn't a haven bid yesterday either. We are camped out at 4.30 on your 10-year Treasury yield. But let's take a look under the hood. We know that big tech has been leading the way down, and as such, Tesla, one of the stocks right now that's leading the rebound for the Magnificent Seven after that S&P 500 fall into correction territory yesterday. Pre-market up 2.4%, but let's take a look at the year-to-date. For 2025, it is just incredible. Tesla shares down 40% so far this year. So even with a 2% rise, that's not going to do much to dig out of this hole.
Yeah, still up 500% over the last 5 years.
Zoom out.
If you zoom out, it looks much better. NVIDIA also helping to propel the rebound today. You can see in the pre-market up 2.8%. And of course, this is the second biggest company in the world. It's worth $2.8 trillion. Take a look year to date. NVIDIA had lost over $1 trillion in market cap this year. It's recovered a little bit of that, so it's now down $840 billion in market cap from its peak in January. If you look at this stock over the last 5 years, it's still up more than 1,800%. In fact, 2,253%. So more than quadrupling the gains that we've seen in Tesla. Now, former Treasury Secretary Steve Mnuchin is dismissing concerns of a U.S. recession. Speaking to Bloomberg today, he downplayed the recent sell-off in equities and advised investors against overreacting to President Trump's trade tactics.
I know there's some talk about, are we going to go into a recession? I don't see us at all going into a recession. I think we could have a little bit of a slowdown in the economy as we pull back on government spending, but I don't think investors should be concerned about a recession. A 5 to 10% correction on the S&P or the NASDAQ actually makes sense. The market's been really fueled by massive amounts of tech spending, particularly around AI. So some of this is a natural correction.
All right, that was Steve Mnuchin, former Treasury Secretary. I know you're going to bring up Michael Hartnett's
I am chomping at the bit
from
here.
Bank of America.
Yeah.
To me, the most interesting thing that he said was in regards to policy, that fresh declines in stocks would flip Trump's trade policy and the Fed's monetary policy.
So two things. One, I think your chair is too low. Once again, we are at eye height, which is not reflective of reality. We'll work on it in the commercial break.
There we go.
The other thing is you're exactly right, and that's why this Hartnett note was so interesting, saying that this isn't the start of a bear market, it's just a technical correction, and that basically, since equity bear markets threaten a recession, before we get there, we're going to see the flip in trade and monetary policy.
Hey, so you're reading a quote.
I am reading a quote.
I bet we have a tear.
Amazing, there it is. So he's basically saying that like, even though we have learned that Trump wasn't bluffing when it comes to tariffs, that truly he meant what he said on the campaign trail, Hartnett's still kind of taking the other side and saying at a certain point that Trump put will kick in.
Right. He says buy stocks at 5,300, which to me also indicates he thinks we have further room to fall. Gina Martin-Adams joining us now, Bloomberg Intelligence Chief Equity Strategist. Gina, great to have you on the program this morning. Thanks for joining us on Open Interest. What do you think about, you know, it's not just Michael Hartnett who says we're going to go down to 5,300. Then you can buy, Mike Wilson says 5,500. Then we're going to go back to 6,500. JP Morgan says 5,200. Then we're going to go back to 64.65. So everybody seems to be saying we have further to fall, but then it's good for the rest of the year.
Yeah, I think it's very interesting because that's a whole lot of certainty in a world of incredible uncertainty. I would say that the charts have definitely deteriorated significantly, and that's probably the biggest reason why many strategists are capitulating to a more bearish near-term condition. The degree of decline that we saw in momentum this week alone is much greater than you would normally see for an equity correction limited to 10%. And I think that as a red flag is creating a bit of a sentiment washout in the strategist community. But then you hear things like the president will step in if the bear market gets to be too big, and you start to wonder how much we're still holding on to these old notions that there is some form of a Trump put or some form of a Fed put that is going to save the equity market. So I would say sentiment broadly is a little bit more mixed, even though we're deferring to the sell-side strategist community that has started to really dismantle their bullish case for stocks that they had at the beginning of the year. The broader sentiment is still a bit hopeful, still a bit buy the dip in mentality. We certainly see that in ETF flows, as our ETF team produced a report this year suggesting there is no evidence of capitulation from the retail investor just yet. So I think it's a bit more mixed in terms of sentiment.
You make a number of interesting points there. You talk about the deterioration in the charts. I don't think we have it, but if you look at the S&P 500's 200-day moving average, there was some talk that maybe that would act as support. Instead, we sliced right through it. Didn't even really pause. You also mentioned the ETF flows, and there's all this talk about retail being sort of the panicky, flighty sort of money, but then you take a look at the ETF flows, and it's just this constant bid into the Vanguard-type funds of the world, which is also really telling. But talk to us a bit more about sentiment, because then you take a look at the AAII survey registering extreme pessimism. You could read that as maybe that everyone who wanted to sell already has.
Yeah, so there's a lot of different ways that you can you can cover sentiment, right? AAII is one. That's what people say, not necessarily what they're doing. We tend to focus much more closely on the market dynamics themselves as a proxy for sentiment. We have our own market pulse model. This model is composed of several indicators of market internals, like pairwise correlations, which have definitely started to rise, but are not even back to long-term median. Or breadth, which has really just started to break down, with now just under 50% of stocks trading above their 200-day moving average. Or small cap signals, or high yield signals. So when we look at the composite of the 6 components that go into our market pulse index, we actually find the market, at least as of the end of February, was still somewhat manic. There's a long way to go to get from manic to true panic on our sentiment survey, and most of the indicators would suggest we're still nowhere near panic levels in the equity market. Even with the incredible drawdown in momentum, the fact that we're still so high above our long-term uptrend line is telling us something. We got to somewhat irrational exuberance at the start of this year. We see this play out in earnings as well, and if I could take another minute, I'd just like to dig into earnings sentiment, because this, I think, is one of the more fascinating things affecting markets this year. Coming into 2025, the market itself was priced for, we believe, close to 24% earnings growth to emerge this year. That is an enormous hurdle for companies to overcome. 20% earnings growth just doesn't happen very often. It only happens following recession experiences, in fact. So to get 20% earnings growth was next to impossible. The market itself has only modestly downshifted on earnings expectations. The market is now expecting just under 20% earnings growth by our calculations. That's still too high considering the degree of economic momentum loss that we've already had and the potential for greater economic momentum loss that we might have if tariffs are continuously imposed over the course of the spring.
All right, Gina, great to get some time with you, especially on today of all days. That is Gina Martin-Adams of Bloomberg Intelligence. You take a check on futures right now after we finally hit correction territory on the S&P 500, bouncing back today. The S&P 500 up about 1% pre-market. The NASDAQ 100, your big loser as of late, up a little bit more, up about 1.3%. And the small caps hanging in there as well. The Russell 2000 up about 1.1%. Something that I keep thinking of, Matt, we keep calling it a technical correction. Why don't we just say correction?
We could, actually. I think that's just to put a little bit of more clarity around it. We define a correction as a 10% drop from the peak. Other people could think of it differently. The NASDAQ you mentioned is down more, right? 13% from the peak. By the way, $5 trillion have been wiped off of global stocks, but Michael Hartnett, or sorry, of U.S. stocks, but Michael Hartnett in his B of A note that you sent me this morning points out that 186 billion have come into global stocks. It's seen inflows still globally, and he likes international stocks better.
He is part of an increasingly loud chorus when it comes to looking outside of just the U.S. We'll continue to follow that trade. We're also keeping an eye on Tesla, as we mentioned. Really one of the stocks leading the rebound this morning among the Magnificent Seven, up about 2.4% right now. But we know it's been a very fickle trade, Matt Miller.
Yeah, you know, I just pulled up on NVIDIA, when you put equity, you can type WGT and see how much any equity is worth in an index. So NVIDIA is worth more than 6% of the S&P. It's worth more than almost 8% of the NASDAQ 100. And so that $2.8 trillion mover has a lot of weight behind it.
Takes the bite out of it.
Yeah, and well, or add some to it, right? If we see NVIDIA shares continue on the path that they are now, and the pre-market you can see up almost 3%, that's going to do a lot of good for the broader indexes. Still ahead, more insight on this painful week for markets with Greg Boodle, top strategist at BNP Paribas. And then Rob Arnott joins us, founder and I guess a pioneer of smart beta.
The godfather of smart beta.
Yeah, joins us from Research Affiliates. Plus, Democrats in discord as the government shutdown risk fades away as they roll over, they back away. Trump wins, at least on this one. More next. This is Open Interest.
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
To the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Getting out of high interest, look at what's making headlines around the world. Democrats are backing off their threat to shut down the government. U.S. Senate Minority Leader Chuck Schumer said a shutdown, quote, would give Donald Trump and Elon Musk carte blanche to destroy vital government services at a significantly faster rate than they can right now. A vote on the bill will take place this afternoon. Germany's Friedrich Merz says his party has won the backing of the Greens for his fiscal reform plan. The announcement follows earlier reporting by Bloomberg that an agreement had been reached. The deal is pending approval by party lawmakers, but German bund yields, which have surged by more than 50 basis points, slid to extend a recent drop on the report. And NATO Secretary General Mark Rutte told Bloomberg this morning that relations with Russia should eventually normalize after the fighting ends in Ukraine. Rutte spoke with Bloomberg after meeting with President Trump. He said that nations in the alliance should aim to boost defense spending to at least 3% of GDP, and that President Trump was not going to back away from NATO.
It was a very positive meeting, and also an absolute clear commitment to the alliance, to NATO, to what the alliance stands for. So it was very optimistic and very positive. I tell some of my European colleagues when they say, well, is the US still connected and committed to NATO? I tell them you might want to turn on your television and listen to the president when he says this. I have no doubt, and there is no reason to doubt that.
All right, let's bring it back to the U.S. equity market right now. A quick check on futures ahead of the opening bell. You can see we're seeing a bit of a turnaround Friday. Whether or not that's sustainable, we'll find out. But the S&P 500 up about 0.9% pre-market. The NASDAQ 100 leading your gains right now, leading the bounce back, up about 1.2%. And small caps also in fighting mode right now, up about 1.1%. Of course, we finally hit that technical correction yesterday on the S&P 500. It took 16 days to fall 10% from the February high. That is the 7th fastest correction in records going back to 1929, according to Bloomberg data. So we'll continue to monitor that situation and discuss it up next with Greg Bowdle of BNP Paribas. He'll offer his thoughts on whether stocks have hit their low after finally hitting that correction. That's next on Open Interest.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
All right, welcome back to Open Interest. It's shaping up to be a big Friday, a big rebound in these markets after we hit correction territory yesterday. The S&P 500 up about 0.8%. Those gains lessening a little bit as we are just minutes away from the opening bell. Let's discuss all of this action with Greg Bowdle. He is BNP Paribas U.S. Head of Equity and Derivatives Strategy. Great to have you in person, Greg.
Thank you for having me.
So we finally hit correction territory. It feels like a lot of folks had been waiting for it, saying that once we finally get to that 10% threshold, maybe we're all flushed out and we can start buying again. What's your read on positioning and sentiment?
Yeah, it doesn't feel like we've seen a capitulation from the data that we've seen. I mean, if you just look at simple measures like ETF inflows over the last month, there's been $40 billion put to work in the US equity market. So that is really the reverse of a capitulation from that pocket of flows.
So Gina Martin-Adams was on Open Interest at the top of the show, and she was saying at the beginning of the year, this market was looking like 24% earnings growth. At least that's how it was priced, right? That's obviously come down, but what do you think about valuations now, and what do you expect for earnings growth?
Yeah, I think one of the issues with this correction is that you like to look for valuations to provide some support, but we came in this year at such elevated valuations that a 10% drawdown doesn't do an awful lot for that. The S&P is still on a 20 times forward multiple. So I don't think it's valuations that we'll be looking to call the trough it. It is more thinking about things like capitulation in terms of positioning or changes in terms of the growth outlook or the data points to drive that.
Interesting. I mean, I was going to ask what will ultimately put a floor into this sell-off, what's ultimately going to provide that support. It hasn't been valuations. It certainly hasn't been technicals. It sounds like you're saying we just need to get everyone washed out, basically.
Yeah, I think there's kind of maybe 3 or 4 things we'd look for. One of them is evidence of a policy put, whether that's a Fed put or a fiscal put. I think if we see those things, they're likely to be lower than where we are now. One could be an inflection in the data. People have been increasingly more worried about what's going on in the growth picture. So we have some survey data in about 40 minutes. We have retail sales next week. An inflection in the data that gives people comfort. That could help. And then the final thing is capitulation, I think, in terms of positioning.
Well, what's interesting when it comes to the data, we got some pretty good inflation readings this week. We had CPI coming in cooler than expected.
Yeah.
Cooler than expected.
True. No, I agree that the data points this week looked good. I'm not sure if they're going to keep looking that good.
That's true. That's the worry. But I don't know. When you put together CPI and PPI, which was basically unchanged, there's the idea out there that gives the Fed some room to cut rates, actually, should we see growth really deteriorate, as some people expect.
When do those guys meet? When do those guys have that decision?
I think that's on Wednesday.
Yeah.
I'll be in Colorado. But what do you make of that you know, we do have maybe some runway for the Fed to ease here, but that's not helping sentiment at all.
Yeah, I think the issue, enemy number one, if you like, for the market is growth rather than inflation at this point. So I think if we were to see the Fed cut quicker than people expect, it's because growth has got worse. So I think maybe we have to take a little bit of pain more, but first before we get to that. So softer inflation, all else equal, I think is helpful, but really I think it's growth that people care more about. And if we get softer inflation but much softer growth, I'm not sure in the short term that helps.
So we're not going to know about growth for a while, right? We have to see what Trump does, how everyone responds, then how he retaliates, et cetera. But we have seen kind of a rebalancing of this market, right? Because the Mag 7 is off 20% from their highs. The NASDAQ, as we were talking about, is off 13%. The S&P is only off 10%. So does that make you feel more comfortable about the concentration risk that we had worried about so much last year?
I mean, it helps a little bit in terms of the concentration risk, but ultimately what we really worry about in the case that we get a deeper bear market is that you get a correlated sell-off. And I don't think what we've seen there really mitigates that risk. So I think the scenario that would make us much more bearish is if the news flow or the cracks that maybe have emerged around the edge of the AI story, CapEx, DeepSeek, continue, and at the same time you get softer data, and that can drive a sell-off both in the more cyclical parts of the market and that kind of secular growth story, and that could create a more correlated sell-off that could drive more of that capitulation and a much more volatile de-risking than what we've seen to date.
So, but I'm watching NVIDIA very closely today. That stock, that sector has been on fire, obviously, if you back off, because of AI, right? Is that still going to be one of the dominant threads this year if the market does recover to 6,500, as so many people seem to think it's going to?
I mean, tech is simply the biggest sector in the US, and despite that small decrease in the concentration that you mentioned, they are the dominant weights in the major US indices. So NVIDIA has an event next week, and people are going to be looking very closely to that to provide some comfort for that story for the Mag 7. So I do think it's possible to have decoupling. You can have other regions pick up some of the slack. You can have the industrial cyclical parts of the economy pick up some of the slack. But ultimately, for the major US benchmarks, where tech goes is going to remain the most important driver this year.
I will say that I'm looking at S&P, ANR, and BNP Paribas has 6,300.
6,300 year-end price target. Well, I don't know. We'll see if we get there. But I do want to talk about the rest of the world, because something we've seen emerge in the past couple of weeks is folks saying that what we're seeing in European outperformance, that has legs. What we're seeing in the Chinese equity market, maybe we're going to get more stimulus next week, that trade also has legs. What's your feeling?
Yeah, so coming into this year, I think that my colleagues in Europe had a great call in terms of European outperformance, and it's worked incredibly well, but perhaps in the short term it's worked too well. There has been this very large divergence into performance. I think some of that is flow-driven. The US equity market is so much larger and more liquid than other regions that if you slice a small piece of your allocation off the most liquid names in the US and put it to work elsewhere in the market, that has a big flow effect there. But we have seen a very big discrepancy between that performance, and ultimately I think what happens in the US matters for the rest of the world. If you do have a more bearish scenario play out in the US, then economies such as Europe are quite export heavy, they are quite cyclical. It's hard for them to entirely decouple.
If they spend $2 trillion on defense, that's going to be pretty good for at least that sector, right?
Yeah, it can certainly drive the story, and that to a degree is what's been reflected in the price action year to date. So you can have these idiosyncratic drivers continue to create outperformance of our regions, but I just don't think they can entirely decouple from the US.
Greg, thanks very much for joining us. Greg Battle there from BNP Paribas. Coming up less than 4 minutes until the opening bell, we'll speak with Rob Arnott, Research Affiliates founder and chairman. Next, this is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
We are moments away from the start of trading after a correction in the U.S. stock market yesterday. I'm Matt Miller. This is Bloomberg Open Interest. You're looking at futures that are higher. Katie referenced earlier a dead cat bounce, and that may be why we see green arrows here after a 10% drop for the S&P yesterday. The NASDAQ 100 was down 13%, and we'll see if we can recover some of that ground. You hear the opening bell down on the New York Stock Exchange. To my left, over here to my right, you have the NASDAQ. That doesn't matter. What matters is what kind of bounce do we get? How far do these big stocks that we're watching closely today, like Tesla, like NVIDIA, does the Mag 7 comeback help to propel a gain in ground on these big equity indexes? Katie Greifeld is right over here to tell us what we're looking at the open.
Well, in the first 30 seconds of this Friday trading session, the answer is yes. You take a look at these indexes behind me, really making up ground, not enough to change the weekly performance, but still the S&P 500 up about 0.9%. It's those big names that Matt mentioned that are really leading this market higher. The NASDAQ 100, where all of your big tech really lives, up about 1.3% at the moment. The Russell 2000, even the small caps, this is a sort of buy everything market, at least, again, in the first minute of trading. The Russell 2000 up about 1.1%. Whether or not people want to hold risk into the weekend remains to be seen. There's a lot of daylight before 4 p.m., but at least for right now, green across the board. Let's take a look under the hood where the action is. Tesla, as we've been mentioning, really helping to propel the Magnificent Seven stocks higher this morning, leading that rebound after the S&P 500 fell into correction territory, Matt, yesterday. A technical correction, if you will.
Yeah, absolutely. A 10% drop from the peak is how we describe a correction. You could have your own definition. It doesn't really matter. The point is, it's a drawdown bigger than the likes that we've seen over the past couple of years. Yes, last summer we saw a drop of a little bit more than 8% on the S&P, but it doesn't quite reach the big round number of 10. NVIDIA is a stock I'm watching closely. You can see the shares right now up 2.7%. It's a $2.8 trillion company, the second largest market cap in the world. So this gain helps to drive the broader index. As I said earlier, it's worth 6% of the S&P and 8% of the NASDAQ.
Yeah, it's hard to get much bigger than that. There's only a few more names in that rarefied air. One.
Apple.
Apple. There you go. Well, it bounces around a lot. Microsoft gets in the mix.
That's true. Microsoft.
Yeah.
I think this morning I looked. Microsoft was 2.815 trillion. And NVIDIA was 2.820 trillion.
There you go.
So very close.
I know, it could change today. In any case, joining us now for this conversation, the day after correction territory, we have Rob Arnott. He is the Research Affiliates founder and chairman, joining us in studio. It's great to see you in person, Rob.
Great to see you. I got to express some shock and horror. You use the expression dead cat bounce, but you love cats. What's with that?
I was thinking about other hideous phrases to use, bulls beating a dead horse. I don't know, I like to mix it up a little bit. But thank you for remembering that. I hope my cat isn't watching. Let's talk about this correction. We were speaking about this Bank of America note that came out this morning. Michael Hartnett saying that it's just a correction. It's not the start of a bear market. What's your view, Rob Arnott?
Well, Dave Nottig last night made the comment to me that this is the Tesla chainsaw massacre.
That sounds like Dave Nottig.
Yeah, I love the expression. Think back to the bursting of the dot-com bubble. The first 2 years after the bubble burst, the NASDAQ was down 50% on its way to being down 80% at the lows. And the Russell 2000 Value Index was up 53% in the first 2 years of that bear market. Shocking. If you have an opportunity-rich environment with some stocks remarkably cheap and other stocks remarkably expensive, you can have divergences like that. The take no prisoners bear market of the global financial crisis started with not much of a spread between growth and value. And we're back to territory similar to the year 2000 with growth stocks being approximately 8 times the valuation multiples of value. Historic norms are about 4 times. So value would have to beat growth by 100 percentage points just to get back to historic norms.
We have a producer in London, Dan Curtis, who is not only a genius, but an Olympic-level rower. He put together this interactive chart on the Bloomberg terminal that is so cool. And basically what it shows you is the distribution of losses on, what's this, your x-axis, and then the number of stocks on the y-axis, right? You can see that at the beginning there, you see a drop of only 339 stocks, but a 3% move, right? That's from the dot-com bubble. The next one is Monday. And then each of the next 5 bubbles is during the dot-com era. So this kind of proves your point that we had these big 2.5%, 3% declines, but they weren't all the stocks like they were during the Great Financial Crisis or during COVID. Where do you find opportunity in that case if you know that some are going to be survivors?
Well, firstly, as I said, spread between growth and value is 8 to 1. That means that if growth falls in half, value would have to go from, in order to stay 1/8 the price of growth, would have to go to PE ratios of 4.
Wait, do we still have a clear delineation between growth and value? I thought those two things had kind of merged.
I don't think there's ever been a more stark delineation between the two. The gap in valuation between large cap and small cap is also near record highs.
Right.
So I look at this as an opportunity-rich environment. We have capital markets expectations that we update every month on our Asset Allocation Interactive website. You've probably seen it. And on that website, we're forecasting Russell growth to deliver 0 return per annum for the next 10 years, and small cap value to produce 8%, non-U.S. value 10%. 10% returns per annum for 10 years is a wonderful return.
I hear small cap value, and I just think you have to have a really strong stomach to go into that space. A lot of folks have been burned there before. And talk to us a bit about value traps in this environment. You see a lot of opportunity out there, but how do you avoid stepping in a value trap?
Well, we sub-advise the PIMCO RAE equity strategies, which are deep value strategies that seek to filter out value traps. Almost all value traps fail quality filters. You take out the low quality companies and you eliminate most of the value traps. Every value trap at some point goes into free fall, and so you use a momentum filter and you get rid of most of the remaining value traps. So we've owned well over 1,000 stocks in those strategies over the last 20 years, and 0 have gone bust.
Are those filters having to work harder in this environment, though? Are there more value traps than normal?
I don't think so. The narrative is AI is going to put all of these small businesses out of business. And AI is the real deal. AI is AI is not new. I was doing neural nets back in the 1980s, but user-friendly AI.
You got an early start.
I did. I'm old, but user-friendly AI is brand new. The CEO of our company had a conversation with AI over this last weekend about AI in the context of human evolution. How does it fit? And the reply came back, and I'll send it to you.
Yeah,
the reply came back, and you wouldn't know the difference between it being a computer talking to you or a PhD anthropologist with a double PhD in philosophy as well.
I don't often speak to those folks.
Yeah.
I have a friend like that. Actually, he's even older than you.
Oh, my God.
Gary Schilling always talks to me about, you know, how much we spent, for example, laying fiber at the beginning of the 2000s.
Yeah.
And the return on that didn't come until much later. But, of course, the internet is still a very useful tool. We talked about EVs, right?
Yeah.
A lot of these EV companies are going to fail. Chances are, though, we're still going to all be buying electric cars in 20 years, right?
Oh, yeah.
What do you think about these AI companies that are now the darlings of the market? Are they still going to be, you know, is NVIDIA going to be the dominant AI chip maker in a decade?
There's a lot of lessons from the dot-com bubble in 2000. If you take the 10 most valuable tech stocks in the world at the start of 2000, how many of those 10 beat the S&P 500 over the next 15 years? Zero.
Wow. I would have said at least Amazon.
Amazon wasn't in the top 10. It was ranked about 27th.
Wow.
And Apple was ranked about 36th. It was on the brink of bankruptcy. So the top 10 tech stocks included the dominant player, subsequently was Microsoft. You had to wait 18 years for Microsoft to edge ahead of the S&P. That's a long time to wait.
Yeah.
So were these tech darlings in the dot-com bubble massively successful? Were they reshaping our future? Absolutely. Were they priced for perfection? Absolutely. I see parallels with AI. NVIDIA is a brilliant company with brilliant product and deeply insightful leadership, but it came into the year priced at 30 times sales. 30 times sales requires stupendous long-term growth in order to justify that kind of price. It suggests that there's going to be no serious competition for years and years and years to come. Competition will lower their market share, will lower their profit margins, and will eat into their pricing power. There's no question about that. Competition will come, just like DeepSeek came out of nowhere to challenge OpenAI's dominance. So the technological revolutions are wonderful for humanity,
Right.
but not necessarily wonderful for their investors in the late stages.
Right. Yeah, and it feels like some of those existential questions really working its way through NVIDIA's stock, at least in the opening months of 2025. Before we let you go, Rob, I want to go to a recent paper because you've called NVIDIA a big market delusion in the past. And recently you write that big market delusions develop when investors anticipate that most early entrants in an exciting new market/technology will generate outsized returns. The recent EV craze demonstrated BMD's three-stage cycle of frenetic expansion, eye-popping valuations, and painful consolidation, especially when it comes to Tesla, down 40% year to date. I assume we're in the painful consolidation phase.
That's the painful consolidation phase. It is the Tesla chainsaw massacre. The EV bubble, and I'll use the word bubble, in early 2021, we called it as what's called a big market delusion. Big market delusion is a special kind of bubble where a new industry is changing the world, and everyone in that industry is going to be stupendously successful. Well, wait a minute, they're competing against one another. There's going to be winners and losers. And if the valuation multiples are high enough, you can be a winner in the business and a loser to your shareholders. And when we wrote that paper, there were 9 electric vehicle specialists. 3 years later, there were 30. Now there's about 25. And
Ex-China.
Including China.
Also, okay.
And the consolidation is happening. 0 of the 9 beat the S&P since that paper was written. Only 2, Tesla and BYD, have positive returns at all. So you can get a wonderful industry that's going to change our future and have the pricing of that industry such that the investors lose out. EVs are going to be central to our future. With autonomous cars, I can't imagine them going to a gas station and filling up.
Yeah.
I can very easily imagine them going to a docking station and charging up.
Yep. That's fascinating stuff and prescient paper there. Rob Arnott, thank you so much for coming in to 731 Lex and joining us. Rob Arnott there of Research Affiliates. Coming up, General Mills reports earnings next week. How's that for old economy? And Citi is anticipating a guidance cut for the cereal company. Top Calls is next. This is Open Interest.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
This is Bloomberg Open Interest. Gains accelerating right now on the major averages. The S&P 500 up 1.3%. Big tech after its big bad day yesterday up bigly right now, up 1.8%. And even the small caps really extending their gains as well, with the Russell 2000 up 1.4%. Let's go now to top calls. Some of the analyst action in focus this morning. And first up, American Express getting upgraded at Baird, where it's no longer a sell. The analyst cites the company's more balanced risk/reward. Shares up 2.3%. Next up, Peloton getting upgraded to a buy over at Canaccord, with the firm writing that it's a clear leader in the connected fitness market and is on track for growth. That would certainly be good news, and shares up 10%. Finally, we have Citi opening a 90-day negative catalyst watch on General Mills. That company, of course, reports earnings next week. Citi anticipating a guidance cut. Now, coming up, the playbook for the 2020s may be the reverse of the 2010s. We'll speak with Joe Weisenthal next in our strategy session. This is Bloomberg's Open Interest.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Welcome back to Open Interest. Taking a look at this rally underway. The S&P 500 up 1.4%. Big tech in the lead, and the small caps also getting in on the action as well. You could call it a dead cat bounce, Matt Miller. You could call it a face ripper as well. That's what you just said.
This market is ripping face.
Ouch.
It's actually not. I think you have to be up more than 2% on the index level before you're officially...
The NASDAQ 100 isn't far away.
Ripping face. All right, I want to get into strategy session.
Let's do it.
That's a new segment that we've got for you here on Open Interest. And we're kicking it off with one of our favorites. Bloomberg's Joe Weisenthal joins us. In his latest Odd Lots newsletter, Joe is arguing that the playbook for the 2020s is a mirror image of the 2010s. He joins us now to walk us through his thinking. I love this.
Thank you. Thanks for having me back. I love being on TV, sitting on the chair, talking about ripping faces.
I
miss this. No, I miss this. This is fun. I forgot. This is fun sitting.
We used to be on a show together called What'd You Miss?
Yeah, a long time ago.
I didn't know that you were on it.
It was great. Only marginally.
I went on that show sometimes.
Dude, I love the note.
Thank you.
Talk us through the parallels, or is it a parallel? The mirror image of the 2010s.
It's been something I've noticed. I've been thinking about actually for years now. I don't know. I started in 2021, 2022, that there are a lot of things about this decade that are like the last decade, except literally the opposite, all right? So the easiest one is just that, okay, last decade we were talking about underemployment is the sort of persistent economic malaise or whatever. This time it's obviously inflation, the exact opposite, et cetera. That's kind of straightforward. But there are other interesting things too that are sort of opposites. So like we had a little financial crisis in March 2023. That was regional bank centered as opposed to the money center banks. You think last time all of the anxiety was around the big banks. Even in Europe recently, last decade, the periphery, right? Spain, Italy, Greece, that's where the weakness was. The pigs, right. No one ever talks about them anymore. And then Germany was strong.
Right.
Now, those economies have actually done fine, or relatively fine, and it's really Germany that's the source of anxiety. So you can like go down the list and like find all these like sort of like macro phenomenon. You know, even like think about the Trump when he was the chaos candidate perceived to be going into 2016. You know, Hillary was seen as the safe one. When he won that night, famously, like, futures plunged, and then it took a while for stocks to get comfortable with him. Exact opposite this time, where stocks shot up when he won, and now, obviously,
Yeah.
today we have the face ripper, but you know, otherwise.
Yeah, well, I mean, going down the list, reading
Yeah.
it this morning, you could kind of get chills because it really is a mirror image. And even when it comes to global monetary policy, talk to us about China because China went big on stimulus.
That's
the
other
first
thing.
time around.
I love this one. This is my favorite. Not just China, but the U.S. too, right?
But this one is really interesting. You could say that in like, you know, China did the world a favor kind of in 2009. There was no growth anywhere. They're like, okay, we're going to be this like one engine of growth, going really big on the fiscal. And it was the one thing that started driving commodity production, et cetera, because they're building all those trains and bridges, et cetera. You could say China sort of did the world a favor again in this cycle because we had all this commodity scarcity, tight supply chains, and China eased back. I mean, they sort of famously, they didn't go big on fiscal. Their lockdowns extended a long time, really sort of let that slump persist for a while. So at a time when there was a lot of like sort of capacity tightness across the world, China once again sort of did the opposite of what everyone else did and kind of what the world needed, which was like give the world a break. Because imagine if China had also done fiscal, the strain we would have seen on all sorts of commodity supplies.
Right. You mentioned also the U.S. Like I remember in TARP when they did $800 billion, right? And maybe it wasn't enough. It still took us until March of 2009 to finally hit a bottom in the market. And this time during COVID, we spent way too much money, like during and after.
We spent a lot. And you know, the stimulus that Obama did, it was, you know, shovel-ready. That doesn't get out the door very fast, that kind of stimulus, that sort of classical infrastructure stimulus. So we really did have a slow employment recovery. This time, it was a lot of money, and it was pocketbook money. I mean, it's de facto, you know, helicopter money, sending people checks directly. So the policy responses to the two crises, we should have done a lot of the stuff that we did this time. Right. Like, oh, should have done that in 2009, but
and the opposite, right? We should have been Sweden.
Yeah, right,
but we ended up more like China.
Well, I mean, like, you know, there's obviously investment we need to make, but like, you know, the real economy, you know, you think back to summer 2020, it rebounded a lot faster than a lot of people had anticipated on its own.
So, Joe, I know you haven't done TV in a while. We're out at 56:30, so you have about a minute for this answer. When you think about and you draw
Thank you for that.
This out, what does this say about the back half of the 2020s? We have about 5 years left. What does the 2010s say about how the rest of this decade will go?
Well, the thing I concluded my note on, which I think is very interesting, is that diversification has been for losers. Like if you're like for losers, for like only nerds diversified the last 15 or so years. And you know, you're always saying like, oh, you should be internationally diversified. You should have some bonds in your portfolio and all this stuff and small cap. If you listen to those guys for the last 15 years, like maybe you sleep at night a little bit better, but you're missing out like big time. But in the last several weeks, and the last couple months, started this year, for the first time in a while, like you're getting paid for international diversification, and German stocks have done well. I mean, even Canadian stocks have significantly outperformed their U.S. peers this year, which is pretty remarkable. EM, take a look at EM currencies. EM has been like dead money for years and years. And EM is like picking up. So I think this is something to watch if you're like looking for these like great reversals. It's like only nerds diversify and didn't get paid for it for years and years
on this show.
Yeah, right. You guys, you're too cool for them.
We're way too cool.
But maybe the nerds, maybe the people who like listen to all the things in the textbook about diversification,
they'll be okay in the end.
We threw those out.
Joe, great having you on the show. Thanks for joining us.
me.
Joe Weisenthal. Be sure to check out Joe and Tracy on their Odd Lots podcast. If you don't already, it's the most popular on Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now.
Once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Cisco have charged the owner of 2 towing companies with conspiracy to commit arson. They say Vicente Badillo plotted to set fire to the tow trucks of his competitors. He allegedly directed other people to burn 6 trucks in all. Badillo's already been indicted for trying to defraud insurance companies, and his tow truck companies are facing city sanctions over illegal tows and predatory practices. Michael Wallace, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live. That's where you'll find us. Alex Steele and Paul Sweeney here. We got some University of Michigan data came out just at the top of the hour. Looking pretty weak in terms of investor sentiment. Inflation expectations, you guessed it, they're going higher. We'll break it down coming up. We're also going to check in with David Gurr. He's up in Canada, the G7 Foreign Ministers meeting. We'll get the latest reporting from there and how welcome David is and the rest of the Americans are up there. Kathy Entwistle, Managing Director at Morgan Stanley Private Wealth Management, will give us her thoughts on the markets. Michael Dean, he's at Bloomberg Intelligence, Global Autos Research. He wants to talk about BMW, which is fine by me because I've been a BMW person for 25 years. So we'll talk about the global auto biz there. But right now, let's kick it all off with Mr. Charlie Pellin, Bloomberg Business Flash.
Hi, thank you very much. And here's what's going on. Stocks higher across the board. Going to be a losing week on the week. The S&P 500 index right now looking at a loss of 3.2% for the week. And this Bloomberg Business Flash is brought to you by IBKR. Financial advisors switch to interactive brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interests at ibkr.com/RIA. What a week, right to the numbers. The Dow, the S&P, NASDAQ, all advancing. This after University of Michigan data. We got more with Joanne Shu of the university coming up in just a moment. But right now, the S&P up 69, 55.90. That is a gain of 1.2%. But to underscore, we're on track for a losing week of 3% plus. The Dow up 351 right now, up by about 0.9%. NASDAQ up 300 points now, up 1.7%. The 10-year 4.31% with the 2-year 3.99%. Spot gold little changed on the day, down $1 the ounce, 29.88. West Texas Intermediate crude at 66.71 now, up 0.2%. And Bitcoin 82,270 now on Bitcoin, up by about 2.7%. As for the market outlook, John Stoltzfus is chief investment strategist at Oppenheimer, and this morning on surveillance, he told us he does remain bullish.
When we look at the way business is navigating these waters, the earnings season that just ended, Q4 earnings season, you've got double-digit gains in 7 out of 9 sectors, only 2 sectors negative. One was double-digit earnings negative. That was energy, which figures because we're awash in oil right now.
And speaking of oil, shares of ExxonMobil up 1.2%, Chevron up 0.9%, ADRs of BP up by 1.8%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thanks a lot. Really appreciate that. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio, and everybody, we made it to Friday. But not to disappoint, the headlines keep coming, that UMich data coming out, as Paul was just talking about, long-term inflation expectations hitting a 32-year high. You're looking at 1-year inflation expectations jumping to 4.9%. Joining us now is Joanne Shu, University of Michigan Surveys of Consumers Director, joining us. Joanne, what is behind the rise in inflation expectations?
It's very clear consumers are really worried about the impact of these policy changes, particularly these tariffs that are changing on a daily basis, kind of policy going in circles. Consumers are really worried this is going to pass through to the prices that they see, and they're concerned this is going to be something that's going to affect not just the short term, but the long run as well.
So, Joanne, give us a sense here. I mean, the University of Michigan sentiment, the headline number came in at 57.9. The consensus was 63. Prior period was 64.7. Give us a sense of how rare is a rate of change like we're seeing here this month? How rare or how common is that?
So what we saw this month was an 11% drop. That in itself may not be notable, but what is critical is that it follows two previous months of pretty strong declines. We're now down 22% from the very beginning of the year. That is a pretty long sustained drop, and it reverses 6 months of increases that we were seeing at the end of 2024. So consumers are really concerned that we are headed for a downturn. We saw deteriorating views about unemployment, about stock markets, about personal finances. Across the board, consumers are seeing a lot of downside risks in the years ahead.
Joanne, before we let you go, how split is it among party lines?
What we saw was a decline in sentiment across Republicans, independents, and Democrats. This is not something that's being driven only by people who are not fans of Trump. Across all three political groups, we saw declines in sentiment.
All right, Joanne, thanks a lot. We really appreciate it. Joanne Shu, University of Michigan Surveys of Consumers Director. Love getting you on this. It is so, so, so important. Obviously, the geopolitics and the political backdrop in relation to tariffs are key as well. David Gura, correspondent for Bloomberg and host of the Big Take podcast, is at Charlevoix, Canada, which I hear is like a 2-hour drive from an airport. I mean, maybe I made that up, but the G7 foreign ministers meeting. Hey, David, what is it like on the ground?
Well, first I'll say it is a 2-hour drive, and it is quite beautiful up here on the shores of the St. Lawrence River, and it is a spectacular spot for this conference. I have heard some grousing among many of these diplomats' staff that it is very out of the way, and there isn't a whole lot to do here other than have these meetings, which have been underway for the last few days. The subject that they're dealing with right now is, can they come to an agreement on this communique, kind of a document that encapsulates what they've talked about and agreed to over the course of these meetings. And there are a number of sticking points where there's been haggling in recent hours. Chief among it is on Russia and Ukraine, sort of what language they should use to characterize Russia going forward. And then with the Middle East, whether there'll be language in there for a two-state solution. So we're waiting to see if there's an agreement and then what that communique might look like if there is one. You know, there is that, the official agenda, talking about the global south and China and North Korea, Ukraine, Russia, all of that. And then there's kind of the unofficial agenda, which has been very prominent here, as you might imagine, and that is the issue of trade, the global economy, and how kind of the landscape, the geopolitical landscape here has changed so much here over the last few months.
David, what type of role do you believe Secretary of State Marco Rubio is playing there in Canada this week? Because it feels like, you know, he could, I guess one of the questions is, does he really speak for the United States? Does he speak for this administration? Because we know President Trump can come out at any time with something perhaps different.
He's aware of that, and all of these top diplomats are aware of that as well. He's playing a very interesting role because, of course, he came here from Saudi Arabia, where he had those meetings with Ukrainian leadership about what a peace deal might look like, what that ceasefire, 30-day ceasefire might look like. So he has a lot of information about sort of the state of play in Europe. There was a moment yesterday when all of these diplomats were gathered in a room and news came out that President Putin had addressed the prospects of that 30-day ceasefire. Everyone, as was described to me, looked at their phones, wanted to take a break and kind of process what President Putin had said in reply, and then kind of turned to the Secretary of State, to Marco Rubio, for an update of what the U.S.'s position is. So they look at him as somebody who has important information about the path going forward here, but you're absolutely right, Paul, to bring up this notion that you know, he does represent the country, he does represent the administration, but we know the peculiarities of a Trump administration from the last time and from these few weeks that we've had of this second term, that his cabinet officials, his diplomat can say one thing and then the president can kind of reverse it immediately, as we saw yesterday with kind of the tariff salvos, and then they have to kind of compensate. So I spoke with the European Union's chief diplomat yesterday. She said she's aware of this. They're keeping all of that in mind. They know that he's communicating to the best that he's able to do. And she said, quite frankly, in the rooms where they're having these meetings, he's saying all the right things. He's communicating with them fairly and as a trustworthy broker as they see it. But they know from past experience that all of that could change on a dime, Paul.
To that point, how relevant then is the G7 and its meeting when, like, it's very clear from this administration that it wants to reindustrialize and take and just sort of pare back any sort of muscle flexing anywhere else in the world?
It is a great question and an existential one. I asked Kaja Kallas, the EU's chief diplomat, about that yesterday. I said, look, this was the G8 just a few years ago. It became the G7, so we've seen it winnow before. And so much of the conversation here, so much of the conversation broadly, certainly in Europe, has been about the role that Europe could play without the United States' support. Everyone is kind of fumbling through here, reckoning with the fact that an incredibly close ally has now, as they see it, kind of turned against them, certainly on economic issues, and going back to that speech that Vice President Vance gave at the Munich Security Conference on kind of fundamental issues of what makes that transatlantic alliance work. Kaja Kallas told me she's confident that the G7 will continue, that the alliance is just too important, and there's been disagreements, but she is by nature an optimist and thinks it's going to carry forward. But we know, Alex, to your point, that President Trump during his first term, certainly during the transition and now, is someone who is not the biggest fan of these multilateral alliances, certainly not like President Biden was. So I think there's an open question of, is this on life support? Is it going to continue? And a big moment to test that will be this summer when the G7 Leaders Summit takes place in Western Canada. The place where I am right now is where the G7 Leaders Summit took place in 2018, and it ended catastrophically when President Trump decided to leave early. There wasn't a joint communique, and so everyone remembers that and it resonates with them as they go forward with their business here.
David, what is the feeling in Canada amongst the ministers about Europe? Is Europe on its own? Is that the feeling that you sense there?
I think that Europe increasingly feels that way. However, there have been moments where you've seen Europe make overtures to Canada to emphasize the fact that they still have a very good relationship, but it's incredibly important. You saw the foreign ministers for both the EU and Germany yesterday wearing red and white dresses. Kaja Kallas had a pin on with a maple leaf to signify her how important that alliance is for Europe. But Europe is... There's a point of huge introspection here about what more Europe can do to be kind of a bulwark, yes, against the tariff war that's taking place here, but going forward with other geopolitical and economic issues as well. And certainly what we've observed over the course of the week in Germany, with Germany having this big debate about fiscal policy and spending and defense policy, that's now percolating across the continent. And I think a really open question now is, what will smaller countries do that don't have the kind of fiscal bandwidth that Germany does to kind of fill the gap and bolster their defenses? So I think that, yes, introspection and then also kind of plotting a path forward here. How can they present a stronger front here against any kind of challenge that they might face?
This is assuming, of course, that all this does go through in Germany, which isn't yet a done deal as well. All right, David, thanks a lot. We really appreciate it. David Gura, correspondent for Bloomberg and host of The Big Take, a podcast, joining us from Charleroi in Canada at the G7 Foreign Ministers meeting. I just wanted to say that again.
So you got French in high school and college?
So look, here's the deal. I worked for 8 years at a French restaurant. I had French in high school and in college, and I still can't speak it at all. But I can tell you that that's Charleroi.
Charleroi.
Yeah,
okay.
That's all I got for you. All right, equity is rebounding here after yesterday's leading the S&P into correction territory, but it's still pretty ugly out there, and a lot of questions as to, can you really buy this dip in a meaningful way? And is this a reflection of the economy, or is this a reflection of funds and positioning? Because that dictates kind of when and where you do want to buy the dip. Coming up, Kathy Entwistle is Managing Director of Morgan Stanley Private Wealth Management. We'll get her take on the market, as far as Brian Platt, Bloomberg Canadian government reporter, on Carney taking power in Canada. Oh, right, I forgot. That's happening. For how long, though? Well, when are the new elections? We don't know yet.
I don't know.
Oh, okay, and that's happening as well. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks holding on to gains with the Dow, the S&P, NASDAQ all advancing. University of Michigan Confidence Survey Friday. S&P up 51 right now. That is a gain of 0.9%. 55.73 where we stand. We've got the Dow up 242 now, up by about 0.6%. NASDAQ meanwhile up 224, up by about 1.3%. A bounce in stocks, calming nerves among equity investors. The S&P, however, is on track for a losing week right now, down by roughly 3%. The 10-year at 4.29% with a 2-year 3.98%. Gold, little change, $29.90 the ounce. West Texas Intermediate crude up 0.2%, 66.72 a barrel. And Bitcoin now surging 3%, 82,721 on Bitcoin. After earnings, DocuSign higher by 13.9%. The e-signature software company reported fourth quarter results that did beat expectations, and sources tell Bloomberg PepsiCo is in advanced talks to buy healthier soda brand Poppi. It may have an announcement perhaps as early as next week. PepsiCo shares little changed, up by about 0.1%. Rival Coca-Cola down by 0.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we are live with you here. Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. The PGA Tour is at Ponte Vedra Beach, Florida for the Players' Championship this week. A lot of folks call it the 5th major. I believe our next guest may also be in Ponte Vedra, and I'm going to put the two together and assume there's a Morgan Stanley event down there. Kathy Entwistle, Managing Director, Morgan Stanley Private Wealth Management, joins us here. Kathy, what are the conversations you're having with your clients over the last couple of months? I mean, 2 months ago, stock market was all-time high. Everybody's feeling good. A little bit different here today.
Absolutely. The conversations have definitely been more challenging. There's a lot of anxiety and fear about the markets, but part of our job is to walk them through it and talk them through it, and also talk about positioning and maybe taking advantage of some of the market volatility to reposition what we have in order to get on board for the next phase of the market.
What is the next phase of the market?
Yeah, well, the next phase of the market is basically trying to think about who the new winners or where the new opportunities will be going forward. Also, what type of, whether it's on the equity side, corporations, companies that we're investing in, different cap sizes, large companies, small companies, mid companies, if they're value or growth. We like the mid-growth area of the market. We like the large value area of the market. We like what we call QGARP, which is quality growth at a reasonable price. And we also like, we're going to start bringing in some of the duration a little bit more based on where we are with the rates.
Kathy, I mean, we just got that University of Michigan data came out today, and obviously the sentiment much lower than forecast. Inflation expectations much higher than consensus forecasts. Do you get that sense when you talk to your Morgan Stanley Private Wealth clients?
Yeah, I think this is not going to be an easy year ahead. I think there'll be a lot of bumps and volatility and a lot of sideways trading. So it's more about understanding where we are, managing expectations, and looking just for the opportunities to make those shifts. Clients are definitely more worried, this year, especially in the last couple of weeks. I've gotten a lot of phone calls. We've had a lot of conversations. And we are just, for my clients personally, we're walking them through the process and the markets and reminding them of all the times we've had these kind of downturns and that they're very normal. It's very normal to have a 10%, drop in the market every 12 months.
But the whippy headlines are not normal. So how do you then filter the noise from the reality?
Yeah, again, it's looking at the metrics and the numbers. There's two different sides to the equation. There's the pure quantitative side, the numbers and statistics and our history and what we can think, sort of look forward to with knowing those numbers. And then there's the qualitative side, the emotions and the challenges. So part of our job is to take the qualitative side out of it, take the emotions out of this, and look at it purely from where are the opportunities and how can we keep our clients invested in the markets. Because if you take your money out, you have the potential to pay cap gain taxes. You also have the potential to not know when the right time is to get back in. So if you're positioned well and you're invested in the right companies, that will turn around eventually, and it's a patience game.
How does fixed income fit into the discussions these days you're having, Kathy, with your clients? Because they could sit at a 2-year treasury and get about 4%. If they want to take credit risk, they can get a little bit more than that. And maybe in a volatile market, that's not the worst thing. So how do you talk about fixed income?
Yeah, absolutely. So what we do is when we're talking about fixed income, I've got an allocation for most of my clients in municipal bonds in their taxable accounts and corporate bonds in their retirement accounts. And they know that it's an asset class that is typically non-correlated to the equity market, and that when we have volatility in the market, this will be what keeps them up. It's like their portfolio up and buffered and a little bit more on the conservative or safer side. And they're getting, at the same time, tax-free income. And if you're getting yields that are tax-free, the taxable equivalent yields are higher than the 4% that you're talking about with the treasuries.
What about in the corporate credit market? So there's a lot been made about how equities are reflecting that recession sentiment, but the high yield market has not been. But we just started to see kind of spreads widening a little bit, but investment grade still seems a little protected. What do you think?
Yeah, I've been keeping my clients in investment grade. I think it's just smarter at this point. You're not really getting paid the difference that you would need to get paid to go for the high yields. Mm-hmm. And I come from a time when we had a lot of corporate defaults back in the 80s. So I am very reminiscent of that, and I want to stay away from any risk in my clients' portfolios. They've won the game. There's no need to take more risk in something that's supposed to be a little bit more safe or conservative.
That said, though, I hear a lot of registered investment advisors, Kathy, that talk about alternative investments as something their clients really want allocation to. And it's not just 5 or 10%. It can be 20, 30%. What kind of discussions do you have with your clients about alternative investments?
Yeah, we've been using alternative investments in our clients' portfolios as long as it's appropriate for them and they qualify for it. But it's very interesting because that, again, is non-correlated. We do expect, for example, on the credit side, you're talking about fixed income. On the credit side in alternatives, you can get higher yields, and some of those can have some tax advantages to them if they are involved in sort of, REIT or something along those lines. So alternatives are a great way to get the diversification. Typically, I am looking to get my clients invested 20% on average in alts, depending on the size of their personal portfolios. And also, we're doing it over time. We're not doing it all usually in like one fell swoop. Mm-hmm. Although now evergreens, I'm sure you guys are familiar with the evergreens where they have more liquidity, they're more aligned with an investor's time frame and goals. And so you can get more invested without capital calls that way, which is really a nice way to get clients invested in this part of the market.
All right, Kathy, thanks a lot. We really appreciate it. Kathy Entwistle, Managing Director at Morgan Stanley Private Wealth Management. Enjoy that weather in Florida. Yeah. Okay, let's go back up to the colder weather. In Canada, Justin Trudeau officially out, Mark Carney officially in. This is a different change now for the Canadian government, creates an opening for that government to reset its relationship with the U.S. and President Donald Trump. But will it? Brian Platt, Bloomberg Canadian government reporter, joins us now. Brian, first, before we get to the inner workings, do we even know what a Carney-Trump relationship is before Carney took the helm?
No, we have not had a chance to put this question to Carney yet. I mean, Mark Carney really has not done very much media. We're expecting a news conference this afternoon, and I suspect he will be asked that very question. So, whether they have any pre-existing relationship at all is one of the biggest questions that I have right now. But I do think in general, Carney is approaching this as a chance to ideally reset a relationship that had become very tense and very even hostile between President Trump and Prime Minister Trudeau.
Is there a sense that, this thing seems to go one of two ways. Either you kind of accept to a very large extent the terms that President Trump is offering as it relates to tariffs, or you fight it, as it appears that Canada had been doing perhaps more aggressively than anybody else out there. Do we have any sense of how Mr. Carney wants to move that forward?
Well, he has said already he's not taking off Canada's retaliatory tariffs until the U.S. fully commits to, a free and fair trade relationship. So that probably means until the U.S. lifts all the tariffs that it has put on Canada, because, you have steel and aluminum just recently, and there were other tariffs in place from earlier March. So at the moment, Carney has promised to keep Canada's retaliation in place. I will also say he's constrained by public opinion here. Canadian public opinion is demanding retaliation, and in fact, probably wants even harsher retaliation. So I will be very surprised if Carney softens too much on this. But, if you can get into a negotiation here, maybe there's room to adjust how Canada is responding.
Yeah, when I was down in Houston, Texas at CERAWeek, which is a global energy conference, when I was speaking off the record, people were like, Canadians are just mad, like full on mad.
Yes.
When we take a look at the ability of the government in and of itself to respond, there are many territories that have they all have free reign. The provinces can do what they want. We saw that with Ontario. So what's the coordination between, say, Carney and the individual regions?
To some extent, provinces have free reign. I mean, this is Canada's a federation, just like the U.S. is, where states have certain powers. In general, on international trade, it's the federal government. And so most of the tools that you retaliate on are federal tools, but provinces have certain things that they can control. In Ontario's case, it was the electricity system. So the province of Ontario had briefly put in an export tax essentially on its electricity trade with the U.S. But when you talk about counter tariffs and things like that, that's all in the federal government jurisdiction. The provinces are just looking at some of the other things they can do. One of the biggest things we've seen is provinces control their own liquor distribution systems. Oh boy. And so quite a few provinces have taken all American-made liquor off the shelves until the U.S. lifts its tariffs. So you do see some smaller, sort of more targeted responses like that from the provincial level.
Brian, can you educate us as to when an election may happen in Canada?
The most likely scenario is very soon. I think the end of next week is what I'm looking at. Oh. And that's sort of the conventional wisdom right now. So Mark Carney will be sworn in today. I believe we've reported he's about to go on a short Europe trip to France and England, which will kind of be a Monday, Tuesday thing, I think. And then I suspect by the end of the week, maybe even on the weekend, he calls a snap election. And so in that case, you're looking at an election date of late April or early May.
And what are the polls showing now?
Well, they're changing. It's fascinating. The Conservatives in Canada under Pierre Poilievre looked like they were cruising to a majority government. They were up by 25 points for most of last year. We're now entering a dead heat. I mean, and it's essentially because of Donald Trump's threats. Trudeau's resignation has led to that as well, and Carney's ascent to the leadership. All right. But it's Trump's tariffs.
Yep. Very good. Brian, thank you so much for your reporting. We really appreciate it. Brian Platt, government reporter, Bloomberg News. He's in Ottawa. Talk about boots on the ground, folks. Get that fantastic reporting. We'll stay on top of that election that may come as soon as a week or two. S&P 500 up 1.1%. The NASDAQ up 1.4%. Strong trading here this morning. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks higher. Gold tops $3,000. This Bloomberg Business Flash is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio. Small firm attentiveness, big advisor impact. Go to Commonwealth.com to learn about their consultative support and technology. The Dow, the S&P, and NASDAQ are all higher, with the S&P up 71 right now. Off-session highs 55.92, up by about 1.3%. The S&P, however, on track for another losing week of roughly 3%. We've got the Dow up 378, up 0.9%, while NASDAQ is up 285 now, up by 1.6%. The 10-year at 4.29%, with the 2-year 3.99%. Gold down $3.50 the ounce, $29.85, down 0.1%. And West Texas Intermediate crude up 0.4%, 66.79 a barrel. Bitcoin, meanwhile, now up by 3.8%, 83,318 on Bitcoin. Consumer sentiment fell to a more than 2-year low. Long-term inflation expectations jumped by the most since 1993, illustrating growing apprehension about the economic impact from tariffs. University of Michigan Director of Consumer Surveys Joanne Shu, interviewed right here on Bloomberg Intelligence, says it is clear consumers are worried about policy changes.
Particularly these tariffs that are changing on a daily basis, kind of policy going in circles. Consumers are really worried this is going to pass through to the prices that they see, and they're concerned this is going to be something that's going to affect not just the short term, but the long run as well.
Joanne Shu of the University of Michigan, interviewed right here on Bloomberg Intelligence. Ulta Beauty shares rose after fourth quarter results topped Wall Street expectations, and the chain's new CEO said the company has almost no exposure to the brewing trade war. Again, recapping the Dow, the S&P, and NASDAQ all higher. S&P up now by 1.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance and politics through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies, 130 industries worldwide, and good thing they do, because companies are starting to come out and quantify what tariffs will mean for their business, whether it's steel and aluminum, whether it's broad-based import tariffs. They're starting to quantify that. And the latest is BMW saying that profits are going to be below its long-term targets this year due to trade tensions and muted sales in China, expecting a margin of just 5 to 7%. Let's go right to Michael Dean, Bloomberg Intelligence, head of Global Autos Research, joining us on that. Hey, Michael, can you walk us through sort of the nitty-gritty of the math on this in terms of the tariff impact?
Yeah, you're correct. So BMW is the first company to actually quantify the impact for tariffs, and they said it's going to be about 100 basis points to their margin, which, as you said, they're guiding for 5 to 7%. So that's broken down into about €500 million euros of impact from Mexico. So they don't comply with USMCA rules, so they're going to have to pay a 25% tariff from this week. Also, there's higher tariffs on their imports of the iX3 from China into Europe. So that's going to cost them about €500 million as well. And then they've got higher tariffs on aluminum, and then also higher tariffs on the sort of X5s and the X7s that they ship from the US into China. So that's about 1.3 billion, and that's 100 basis points of their margin.
Wow. To what extent, Michael, do the European car makers, are they talking about passing along their cost increases to customers?
Well, that's interesting. So BMW basically said that they don't have the ability to pass on these increases.
Really? BMW?
Very limited amounts, because if the competition aren't doing this, then they'll just eat their lunch. So that's not just the issue for BMW, but that's going to be for all US manufacturers that import into the US, and the ability to pass on these higher costs is going to be severely limited.
But wouldn't all car makers be in the same position, or is BMW in a particularly difficult situation?
Yeah, BMW's worse than some of the others because it doesn't adhere to the rule of origin rules for Mexico. And then also, Mercedes and Audi are importing a lot of their cars from Europe at the moment, so they may be hit with tariffs in the future. But there's alternative cars in the US that are locally produced and won't be raising their prices. So BMW has to adhere to that.
China. What are the European automakers telling you about China as a end market and as maybe, just in the whole global trade situation?
Yeah, so China, again, it's another cause of a weakness for BMW, not just BMW. We heard it from Porsche, we heard it from Mercedes as well. And they're losing market share to domestic brands. So BMW lost 80 basis points of market share this past year. They're having to heavily incentivize their cars. Discounts are averaging about 30%, which is just crazy compared to 4% in the US. So China is a big problem for all the German automakers at the moment. And I don't see that getting any better this year as well.
So if we go back to the tariff issue, though, are we going to have to see BMW go to the rule of origin thing and move manufacturing to the US? Is this what we're going to have to see?
Yeah, that's what they talked about this morning. So that they will have to either comply with the rule of origin rules, or, they're a big producer in the US. They've made the US their global hub for SUVs, so they could shift some of their production to the US. But that's going to take time. It will take at least 6 months, and they're going to have to shift supply chains as well.
So, Mike, are these additional costs stemming in part from the tariffs, are they changing the way the European companies talk about investing in electric vehicles? Is it changing their commitment because maybe they don't have the resources?
Yeah, what's interesting, not just for the Germans, but also for the US manufacturers, they had pushed their EV production to Mexico because of the lower costs, and because BEVs at the moment, well, EVs cost more than internal combustion engines. So yeah, they're going to have to, think about that in the future, whether they change where they allocate their investments. But again, this takes time. These are 3 to 5 year investment horizons, so they just can't do this sort of thing overnight.
Well, and then I guess to add on to Paul's question, is the demand side still really there for EVs? I mean, I know that Donald Trump just bought a Tesla, but he's taken away the tax credits and the EV federal infrastructure charging, which is going to make it all the more difficult to get that rolling here.
Yeah, definitely. The outlook for EVs in the US is definitely much worse than it was pre-Trump. So that's going to be an issue. That's not the case in Europe. So okay. Europe, BMW will be looking to sell more EVs, and it's got this newer class of platform coming out later this year. So this is a real attempt to reduce costs on its EVs and match those of China. And it's going to have 30% more range, 30% more power density, and then hopefully up to 50% lower battery costs.
Mike, does anybody want to talk to you? I mean, do any clients want to talk to you?
Wow, that was harsh, man.
I mean, you've got all the uncertainty surrounding the EV transition, and now you've got this tariff talk impacting profits. I mean, and I'm looking at the stocks here on a trailing 12-month basis. They're all down kind of 20, 30%. What are investors saying to you these days?
Yeah, it's tough. Certainly 3 or 4 months ago, no one wanted to look at European autos, the Germans in particular, and they were massive underperformers. But if you look at the DAX this year, it's up 15%. There's a lot of bad news that's priced into the German automakers. So any piece of positive news flow, actually could be a positive catalyst for these stocks. So they've been very much beaten up, low valuations. So yeah, any positive news which may come from maybe some uplift in pricing, or maybe China demand picks up for the German automakers, could be positive for these names.
All right, Michael, we really appreciate it. Michael Dean, Bloomberg Intelligence, head of Global Autos Research, which begs the question, just because you get a correction in the U.S., does it mean that actually now things are fairly valued because we were already, you can make an argument in some areas, overvalued?
Yep.
Or is it really a sign of something more dramatic that you have to be careful of and really exemplifying, say, a recession? Because those are totally two different setups.
Exactly right. And I think just kind of what we're seeing today is just feels like in a bad bounce in the market because we've been down for so long. And in the absence of any external news that could throw more cold water, this is a market that maybe wants to bounce a little bit. But if you're in an industry sector like the autos, just secular challenges there.
Yeah. And when you have to actually deploy capital, and you're in a really cyclical industry like that, and a capital intensive industry like that, I mean, same thing with energy companies. Like, this is a really tough working environment.
Yep.
Speaking of commodities, Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist, will be joining us. Gold, 3,000.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it to the end of the week. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. One of the headlines today is that gold broke $3,000 an ounce. I remember covering gold when it wasn't even $1,000 an ounce. So this is like, for us gold nerds and gold bugs, this is like a moment of balloons and stuff. And the question becomes like, how long can this last? Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist, who was also covering gold before it was even $1,000 an ounce. Hey, Mike, if I had told you 20 years ago gold would be at $3,000, what kind of economy would that have represented?
Yeah, it'd be either significant inflation or severe deflation. I think the key reason gold's rallying now is because it's anticipating the deflation, significant potential deflation if U.S. risk assets, most noted stock market, continues to, can either say go down or mean revert, because it went up so much the last few years. And I think that's what's happening now. The gold market's anticipating stock market going down. Okay, that was been the best place to be, along with cryptos for decades now, along with high bond yields. And now gold's starting to understand that, oh, that rally might be over. And you're seeing that in ETF flows. ETFs had outflows for 4 years in a row, and they're really kicking in this year. They're up about 4%, which would be the most since 2020.
And Alex, when I first met Mike years ago, when we were first talking about him coming to Bloomberg, I said, hey, Mike, what's your commodities call? Buy gold, sell everything else.
I mean,
that's
he's pretty much
that's-
always been right on that one.
That's the call I
Did
remember.
he have hair at that point?
What's that? No.
Oh,
no,
okay.
no.
So that
Please,
call maybe
let's be
eroded the
honest.
hair. Yeah.
So, hey, Mike, how do you get a sense, or how do gold traders, I'm not sure if people trade gold or they invest in gold, but how do they feel about valuation? Like at some point people say, oh, this stock has just gotten too far ahead of itself. Do we ever say that about a commodity like gold?
Well, Paul, I love how you go there because we know you're an equity person and valuations in your brain. In commodities, the main lesson you learn in commodities is they go down because they went up. That's why crude oil is at $65 a barrel. It went up too much. The big difference is gold. The big difference is gold. The key thing is oftentimes you try to find a cost of production is like a valuation we usually goes to. What's happening, what's different with gold, it's the only commodity that really goes up over time continuously, partly because the supply can only increase on average 2% forever, and it's harder and harder to produce, and it's monetary value. So that's what's the significance of gold. Gold is up about 65% since February of 2020. That's when the announcement of the unlimited friendship between President Xi and President Putin, and it's continuing now. The key thing is looking forward is we're seeing deflationary forces in China potentially kicking over in this country, and I'm really worried now. I don't want gold to stay above 3,000, but I think it will, particularly because of the reasons I'm worried about is the U.S. stock market having a bit of a normal correction. Now, 10%'s nothing compared to what usually happens when you have a major shift, which we're having a paradigm shift in what's happening in the U.S. Maybe how about 20 or 30% in the stock market? That means gold continues higher. So I'm worried at these levels, but I think it's going to continue rallying for reasons that are going to hurt most investors, unfortunately.
Is it also to do with this idea that maybe the government could mark to market their gold reserves and then confiscate gold in order to use that and sort of ramp up the Fed's balance sheet? Now, many individuals are going to roll their eyes at this and say, oh my God, Alex, seriously. But no, seriously, could this also be driving some of the last minute buyers?
I think that's part of it, Alex. What we're seeing is a major shift of gold coming to the U.S. because of disparities in U.S. COMEX traded gold versus what trades in London. But it's usually indicative of a bull market. That whole scenario, I think, is part of. It seems kind of odd to me. Whatever you have the price on the books or not, it's still, U.S. still has about 8,000 tons of gold. It's on it in the books at $42 an ounce. Okay, it should be marked to market. Why not market? I'm just not the accountant. So I don't really get why that's going to matter for the price of gold. It's a global commodity. And one thing I've always enjoyed in the space with gold bugs is they say it's manipulated like in the U.S. I'm like, well, it's a global commodity. It's kind of hard to manipulate something you can trade around the world. And people in India and China hoard it for a good reason historically, and particularly Turkey. But I look at that as gold has a good reason to keep going up. And that's particularly because, let's just start one key fact is, at the end of last year, the U.S. stock market cap to GDP was about 2x. Now it's going back downward. It's down about $6 trillion this year. That's 20% of GDP. I mean, that's a 10, and what really matters for deflation. If that continues, that's what pressures bond yields lower, pressures the Fed to ease, pressures inflation, and makes gold go higher. To me, that's the 10 that matters in gold. And then there's all those little nuances in between that you see in a normal bull market.
Outside of gold, what looks good to you in your space, your commodity space?
Well, what's been oddly looking really good is copper, and I'm really not on board that trade fundamentally. U.S. traded copper is bumping up against the highest price ever, which was $484 in February of 2022. I mentioned that month earlier. Well, actually, it was March. And it keeps bumping up, but it's for the wrong reasons. It's because of that disparity between the price that trades on the CME, which is right now about $4.90, and price that trades on the LME in London. It's because U.S. tariffs. But generally it means that will be offset, money will flow, the arbitrage will kick in. It doesn't, so I look at industrial metals as a whole indication. Copper's a bit of a nuance. Industrial metals versus gold are showing severe global deflationary potential forces. Gold going up, industrial metals not going up as much. Copper just doesn't seem like it can stay up this levels too much unless China really kicks in. And yeah, they're bouncing, but I don't really see it with tariffs just starting to accelerate.
Oh, such a good point. Such a good point. If those deflationary forces are going to drag down copper as well. Mike, super great. I didn't do a yeah but for you. I agree with everything you said. All right, Mike, thanks a lot. Mike McGlone, a Bloomberg Intelligence Senior Commodities Strategist, joining us on gold. All right, for our listeners in the U.S., here's a reminder. You can listen to us via satellite radio on SiriusXM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on SiriusXM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now with the S&P up by 1.5%, the NASDAQ up almost 2%. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. Welcome to the longest week ever. Just kidding. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We have a great second hour lined up for you, covering all the news and the market action. Nathan Dean of Bloomberg Intelligence, he's senior policy analyst, will be joining us on the latest on the non-government shutdown and kind of what that means then to pass other stuff like tax cuts in the Trump administration. Plus, it's Friday, so it's Munis in Focus. Shruti Singh will be joining us. She's Bloomberg News municipal finance reporter. It's the latest news, latest issuance, latest demand. And Michael McKee, Bloomberg International Economics and Policy correspondent, will be joining us on the latest University of Michigan Sentiment Index, which is pretty terrible. Long-term inflation expectations hit a 32-year high, and that was all across parties, independents, Democrats, and Republicans, all feeling that weight. And John Tozzi, Bloomberg healthcare reporter, will be joining us on the healthcare chaos industry. It's his big take story of the day. But let's kick it all off for you right now with a Bloomberg Business Flash with Charlie Pellet.
All right, I thank you very much, Alex Steele. Happy Friday. What a week, a dizzying week with the Dow, the S&P, NASDAQ all advancing right now. In fact, we are at just about the best level of the session on this Friday morning. S&P 500 index pushing higher. Right now, we are looking at a gain of 1.6% on the S&P. Yes, on track for a losing week of roughly 3%, but right now the S&P at 5611, up 1.6%. Year to date, however, the S&P is down 4.6%. The Dow up 527, up 1.3%. NASDAQ putting in a 2% advance right now, up 352 points. The 10-year yield 4.30% with a 2-year 4.00%. Gold, a topic we were just talking about with our Mike McGlone, down 0.2%, 29.81, was trading above $3,000 the ounce. And West Texas Intermediate crude up 0.7%, 67 even right now on WTI. Bitcoin now surging 4.3%, 83,751. Kathy Entwistle is Director of Family Wealth at Morgan Stanley. She was a guest right here on Bloomberg Intelligence, and she talked about how her clients are taking the sell-off in stride.
Clients are definitely more worried, this year, especially in the last couple of weeks. I've gotten a lot of phone calls. We've had a lot of conversations. And we are just, for my clients personally, we're walking them through the process and the markets and reminding them of all the times we've had these kind of downturns and that they're very normal. It's very normal to have a 10%, drop in the market every 12 months.
Kathy Entwistle of Morgan Stanley interviewed right here on Bloomberg Intelligence, again on track for a losing week. So the Dow, the S&P, NASDAQ all holding on to gains right now after earnings. We've got DocuSign surging 17.4%. Also after earnings, Ulta Beauty up by 11.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well, youtube.com. And then search Bloomberg Podcast Live, and that's where you'll find us here. Certainly a big bounce in the market today, as Charlie was just reporting. Let's see what the traders are saying out there. Vince Signorella, Bloomberg macro strategist for Bloomberg News, joins us via Zoom here. Hey, Vince, is this just the absence of any disturbing tweets allowing this market to just have a bounce?
I think so far. Mr. Lutnick's been on the quiet, and the president hasn't been saying too much. So we haven't had those negative traded tweets that we've seen all week, which is shaking risk. The debt ceiling looks like it's been put off with some of the Democrats joining Republicans to vote on this. Looks like today that'll push it out to March. What else do we have? We've got China monetary stimulus being promised to us on Sunday, which traders usually get very ginned up about. But the latest attempts for China to stimulate their economy have kind of fallen flat on their face. It's more the lead the horse to water, but can't make it drink kind of thing. They're putting the money out there, but they can't seem to get anybody to really take it and invest. So we'll see how that looks on Sunday. So far, the loan take-up has been pretty tepid for China.
At the same time, I wonder how much of the vibe right now in the market is positioning and sentiment versus actual underlying economic fears.
That's a really good question. There's definitely been, you talk about a 10% move, so you definitely have some positions shaken up, and you have others who are coming in, stepping in, looking at this as a buying opportunity. So it's definitely some positioning. But you have to keep in mind, so far there's been no backing down from the administration on tariffs in a real sense. So that at some point is going to affect earnings. And if the administration stays the course, and wants to bring manufacturing and such back to the United States, we're going to have an economic shock, and we're going to have an economic shock in earnings as well. And I don't think the downside in equities is done just yet. If that comes to fore, I think the sentiment numbers we saw this morning were pretty telling about where the consumer thinks the economy is going. I think retail sales numbers on Monday are going to be very, very interesting. You kind of look at this one two ways. If you get a really big beat, is it the consumer healthy, or is it the consumer just bringing forward purchases, trying to beat tariffs? And of course, if it misses to the downside, all bets are off. That's a consumer telling you they don't care about tariffs. They're just not buying, period.
Yeah, that UMich data that you referenced there, Vince, that's just really big moves and big statements about how people are feeling out there, number one, and number two, how they view inflation. Boy, if I'm the White House, I think I'm paying attention to that kind of data.
You would hope so. I mean, the 5 to 10 year inflation expectations haven't been this high since 1993. I mean, that was pretty ugly back then.
That was a good year for me, but I mean, I get what you're saying.
I think I was still in high school in 1993.
Okay, stop it, you.
I gotta, I'm only 20 now, actually.
Exactly.
So, yeah, I wasn't even born. It was really telling, but we still haven't seen any hard data. So it's sort of like, have we corrected in a normal way because valuation was so high already and there was so much cash waiting to be put to work and everyone got into the positioning right after the election versus we really got to sell because I'm scared?
Again, it's a really good question. It's hard to tell at this point. I'm going to wait till the end of the day and see how the tape plays out.
Yeah.
What we've been seeing all week is buying right into the mid-afternoon session and then a sell-off into the end. And a lot of that's been prompted by comments from Lutnick and Trump. But them notwithstanding, or any comments from Ford in Toronto that we're going to get some electricity tariffs. If everybody goes quiet into the weekend, it'll be interesting to see how the end of day trading is. Will people feel confident carrying these positions into what could be a tumultuous weekend with tweets and tariffs and whatnot, or are they going to is this just day traders making some money and it's going to roll over going into the close?
All right, we'll see. I mean, we'll deliver, as we usually do, a nice market to Carol Massar, Tim Stanovic. We'll see what they do with it in the afternoon. Vince Signorella, thanks so much for joining us. Vince Signorella covers all the markets for Bloomberg News. Big news out of D.C. Senator Schumer signaling that retreats are, one could argue, on the shutdown threat. So that looks like the funding bill is going to get done here. We'll find out later today. Nathan Dean joins us, senior policy analyst for Bloomberg Intelligence. Nathan, what's the feeling amongst the Washington folks inside the Beltway? Was that a win for Schumer, a retreat for Schumer, just pragmatism on part of Schumer? How's it being viewed?
So I think it's being viewed as like the worst of, actually the better of two bad options from the Democratic Party. Obviously you have a lot of progressives who are upset with this, and they wanted Senate Minority Leader Schumer to fight on this. But from Senator Schumer's perspective, he even said this on the floor of the Senate yesterday. Look, if we shut the government down, Elon Musk and Doge may just say to 75% of those workers that are non-essential, then why don't you just don't come back? If you're not essential, then why do we need you? And so I think what the Democrats are going to do now is they're going to have to try and come together and figure out what their strategy is for the forthcoming fights for the rest of this year. Namely, we do have a debt ceiling debate that's going to come sometime June or July, and the Democrats are going to have to decide, are they going to go with the president to try and increase the debt ceiling, or are they going to use that from leverage? And then subsequently, when the government funding comes up again in September 30th, the question then is, are they going to shut the government down at that point? I do think that we are going to see a government shutdown in the next year or so, a lengthy shutdown. But, you know, the Democrats do have to figure out what their strategy is going forward, because right now they're all over the place.
Well, this is a good point, because I wonder if the strategy then that we learned from Democrats, is that the strategy we're going to see when it comes to like tax cuts, or is Schumer going to be in a different place?
So I think there's two things to think about here. One is Senator Schumer said, look, you know, and I'm paraphrasing here, the situation may be different later this year. And they do anticipate that a lot of these DOGE cuts plus tariffs are going to sour the American consumer on the economy and subsequently sour on President Trump's position. So the Democrats feel that they're in a position of strength if they just let President Trump continue to do what it is that he's doing. But then when it comes to the tax cuts, the challenge here for the Democrats is that they're not part of this debate. The Republicans are using reconciliation, which means that they're bypassing the Democrats here. And so the challenge for the Democrats will be to try and push off specific provisions of the tax debate to make it extremely difficult for Republicans to support that. Because right now, the Republicans have a 220 to 215 person majority. They can only afford to lose a handful of votes. And so as we get into this tax debate, the Democrats are going to have to try and make specific provisions very difficult for Republicans to support, but they are not going to be playing a part whatsoever. All of them will be voting no, and the Republicans are also banking on that.
Nathan, can you explain to me, while Democratic leadership even acknowledges that the progressive wing of the party is even in the room, hasn't the country spoken?
Yes and no. I mean, obviously, I think there's still lots of people here in Washington that are trying to figure out why voters went to President Trump in the November elections. And look, there's lots of theories, including that the American voter wanted to be more moderate. But the progressive wing of the party is still a very important part of the party. I mean, we see it on X, we see it in terms of activists, we see it in terms of headline generation. You know, there were calls for Representative Alexandria Ocasio-Cortez to primary Senator Schumer in this next debate or the next election cycle. So the Democrats have to try and figure out unity, because that's one of the ways the Democratic Party is going to be able to combat President Trump is through unity. And so whether it's Representative Hakeem Jeffries in the House or Senator Schumer in the Senate, the Democrats are going to have to use the next few weeks and months to really try and come together and find that unity if they have any chances of trying to win big in the 2026 midterms.
Who is the leader of the Democratic Party? I know who has titles in the Democratic Party, but who is setting agendas?
So there's really two trains of thought here. One is the leader coming from Washington? Is that Senator Schumer? Is that Representative Jeffries? But the other side are the leaders coming from the states. You have a lot of Democratic governors, Governor Newsom, you know, Governor Pritzker of Illinois, you know, that are trying to essentially become the next leader of the Democratic Party. The challenge is that those governors don't have the same stage, if you will, to be seen combating President Trump. That's up to the Washingtonian Democrats. And so, you know, while the news cycle focuses on President Trump and who is combating President Trump, the state governors who probably want to be the next leader of the party essentially have to wait for the next election cycle to really come closer in order to try and generate that public perception and so forth. So for right now, it's a challenge, and they're still just trying to figure it out.
So we had President Trump actually out there supporting Schumer, saying he did a good job. Is that something Senator Schumer wants to see or deal with?
No, I don't think so. And I think President Trump was probably smiling when he sent that out. You know, obviously that's not something that Senator Schumer wants to hear, nor is that, I think, going to change Senator Schumer's position on anything. But I think this was President Trump's just way of saying, look, the Democrats folded and we, the Republican Party, have won again. You know, but from Senator Schumer's perspective, there was this really thought that, you know, by not signing the deal, a lot of negative things were going to happen for federal workers. You know, I go back to Elon Musk just over the last couple of days in terms of what we've seen on X. He's questioning, if you're not an essential government worker, then why do you have to work? There was this thought that maybe 2 million federal workers may not ever come back to the office if you were to have a government shutdown. And if you're trying to, you know, corral DOGE into a public perception to allow voters to come to your side and saying, look, if you want to oppose DOGE, join us, you know, being seen as also trying to put harm on federal workers probably wasn't good policy. So Senator Schumer was stuck between a hard place, and I think he chose to fight tomorrow as opposed to fight today.
Yeah, that's what it also seemed like.
See, I thought that the tomorrow was actually today. I thought this was the time.
Well,
during
that's
the
actually
shutdown too, so.
pretty decent point also. I hate to bring this up, but entitlement spending. What is the reality behind Medicaid, Social Security in terms of what Elon Musk is going to do, and what is going to be the official line on either party on that?
So you have two things that are happening here. You have Elon Musk saying, look, we have to challenge entitlement spending in order to save the deficit. And I don't think the Doge Committee is going to be able to do anything that remotely close to tackling the deficit or in the budget unless they go to entitlement spending. But then you also have entitlement spending, that is the third rail of American politics, whether it's Medicare, Medicaid, or Social Security. Any politician that moves forward and says we're going to cut this usually pays the political price. So the challenge is that as we go forward with this tax reform debate, there is going to be a serious debate on whether or not entitlement spending should be cut to help pay for these tax cuts. Now, I don't think entitlement spending is really going to be touched all that much. Obviously, there's fraud concerns. President Trump said in his joint address to Congress, there's a person living somewhere in the States that's 300 years old getting a paycheck. But, I don't think that the American populace and also those folks on Capitol Hill are in a position yet to challenge entitlement spending, because I would just remind folks that President Trump has said that they're going to go after waste, but they're not going to change the actual benefits, and they're not going to touch it. That's very difficult, whether you're Elon Musk or Capitol Hill, to actually do something with.
All right, Matt from Westchester writes in, what's the latest on the salt tax deduction?
Is this Matt who's really sitting in the newsroom who
Yes.
just got off air?
Yes.
Cool. Just checking.
So there's general consensus that the SALT deduction has to go up. Currently, it's capped at $10,000. Now, if Matt had his way, they'd say get rid of the deduction in its entirety. I don't think that's going to happen. But I think what will happen is that you will see a cap rising potentially 20,000, 50,000. I don't think they'll get 100,000. Representative Lawler from Long Island would certainly love that. But there are enough Republicans in the House that have gone to President Trump and said, you have to give us some sort of SALT relief. And President Trump is on board with that. And I think that direction will make it to the House committees when they write this bill.
All right, Nathan, thanks a lot. We really appreciate that. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, joining us there.
So maybe some good news, but not for this tax year.
No,
I just
we're
sent
done.
my stuff to my guy. Yeah.
We're totally toast.
Yeah, all right.
That's the one thing I make my husband do.
Really?
It's the one thing I check out of, their taxes. Everything else, bill paying I do, budget, finances, all me. But this one's, I'm like, I need you to do this because it makes me so angry.
My daughter
stressed.
told her brothers how to use TurboTax, and so now they all do their tax. She's ahead of the curve.
Okay. We're too complicated for TurboTax now.
Yeah.
As you get older, it's harder.
Yep.
Okay, coming up, we got a lot more to break down for you. We are going to be speaking, because it's Friday, we're going to be speaking with Muni bond reporter Shruti Singh joining us. We'll discuss the issuance, where the opportunities are, and Michael McKee, Bloomberg International Economics and Policy Correspondent, because you know what? We have a Fed meeting on Wednesday.
We do?
Yes. It's going to be a non-meeting, though,
Yes,
right?
totally.
But I think the dots are going to be coming out. So how does the dot then reflect the economic picture when it comes to tariffs and President Trump? And just in a moment, we'll be talking to John Tosi. He is a Bloomberg healthcare reporter, talking about the healthcare chaos that's been caused just in the last few months. This is Bloomberg Intelligence. Happy Friday, everybody.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks ripping higher at the end of a losing week. The Dow, the S&P, NASDAQ solidly in the green on this Friday. And this Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. The Dow, the S&P, NASDAQ solidly in the green at the end of a dizzying Wall Street week. Right now, the S&P 500 index is up by 1.7%, higher by 96 points. The S&P at 5617. The Dow up 561, up by 1.4%. NASDAQ is up 377, now up by 2.2%, with a 10-year currently yielding 4.30%, the 2-year 4.00%. Spot gold was trading above $3,000 the ounce earlier today, right now at $29.79. It is down $9, lower by 0.3%. A gain for West Texas Intermediate crude right around $67 a barrel, up 0.7%. And Bitcoin now surging by 5.6% at 84,875 on Bitcoin. Among the Mag 7 names, NVIDIA's up 4.8%, Tesla up 3.1%, Meta Platforms up 2.5%, Apple up now by 1.2%, and Alphabet, parent of Google, up by 0.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, we got a flash coming here. Charlie Pellet, thank you so much. We appreciate that. Charlie Pellet with the update here. Focus on Munis today is brought to you by BAM Mutual. BAM Mutual insures municipal bonds that finance essential infrastructure and provides guaranteed income to improve any portfolio. Learn more about municipal bond credit quality. Visit bambonds.com. All right, let's talk municipal bonds. Why not? Because it's Friday. Shruti Singh joins us, municipal finance reporter for Bloomberg News. She's based in our Chicago, Illinois bureau. We appreciate getting a few minutes of her time. Shruti, thanks so much for joining us here. How have the municipal bond market, how is it performing year to date?
This week's been volatile. They've had a rough week because for a while, munis weren't reacting to all the volatility that other markets were seeing. But this week, we saw that munis lost a bit. Yields rose, and we saw the indexes post some losses because of the volatility. It finally hit the muni market, which is usually known as kind of a stayed market.
How are valuations in the municipal bond market? I guess you look at it relative to treasuries. How is the valuation call right here?
Yeah, so the relative value of munis to treasuries is a key marker in the muni market. So often munis will follow or track treasuries movement up or down. And this week, what we saw is that relative valuations from munis relative to treasuries actually eroded. So a lot of times investors will look at munis in terms of what their yield is compared to what treasuries are. And so this week, for example, munis actually, the 30-year muni actually became 90+% of treasuries in terms of yields. And that's actually seen as better relative value from an investor perspective.
If the U.S. economy starts to struggle, right, we've seen the vibes really roll over, but in terms of getting that feeding through to the hard data, what's the relationship between that and the overall muni market and returns?
So it's not necessarily an immediate response. So as I mentioned, a lot of times munis are kind of seen as a stayed market in terms of not as much volatility as you might see in equities or commodities or other types of markets. But there is a trickle-down impact. So in the muni team, we cover state and local governments very closely. So the economy softens, then what happens is revenues for state and local governments will soften, and in turn, tax collections and everything that these state and local governments use to run their services could get weaker. And then that in turn is something that bondholders take a look at in terms of, what is the revenue? We had a economic rebound post-pandemic. The credit quality of state and local governments was very strong, but now there's questions. If the economy softens, what now?
So, Shruti, your town of Chicago in the news in the municipal bond market this recently. Chicago denies schools push for debt to pay pension bill. Talk to us about what's going on there.
Yeah, so I've been covering Chicago and the state of Illinois and the Midwest for a while now. And when you talk about the finances of the state of Illinois and the city of Chicago, it's difficult to separate that conversation from any discussion about pensions. And the reason for that is that the city of Chicago, the state of Illinois has a very large unfunded pension liability. Now, what's happening right now is that pension liability and the questions of who is going to pay for it is coming into the fore between the Chicago Public Schools and the city of Chicago. So the Chicago Public Schools has had a mayor-appointed board for more than a decade now, but it's in the process of moving towards a completely elected board. And there's a process of disentanglement that's going on between the city and the school district. Amid this process, there are questions about some of the shared finances that these two entities have. Chicago has been paying for a portion of the employee pension contributions for the Chicago Public Schools for many years, for 100 years, some people have said. The last few years, the school district has been contributing annually for a portion of the employees, non-teacher employees that participate in this municipal fund that the city actually maintains. This year, what's happened is that there are deficits on both sides. Money is tight. And there's a question of who is going to pay a $175 million contribution towards this municipal employee pension fund. The city has already paid for it for 2024, thinking they were going to get a reimbursement from CPS, Chicago Public Schools. Chicago Public Schools says it hasn't gotten enough economic development leftover money called TIF money from the city to actually make that contribution. So there's a lot of complications, but the question is, how is this going to be resolved by the time that the city needs to close its books for 2024 by the end of March?
So if we just back out for a second, and that was an amazing explanation of an incredibly complicated issue when it comes to the muni market in Chicago, but you mentioned schools, et cetera. When we see the federal government pulling funding from some main universities, what can be the trickle down to the muni market on that?
So education is a big question mark right now for the muni market, whether you're taking a look at higher education, which is seeing potential pullbacks of federal funding, or the local level as well. There's questions at all levels in terms of what the federal government is going to send forth. At the higher education level, there are questions about policies. And at the local level, there is just a question about what kind of future the Department of Education has.
All right, Shruti, thank you so much. We appreciate that. Shruti Singh, municipal bond reporter for Bloomberg News. She's based in Chicago, talking about the municipal bond market here. Let's talk economics. The UMich data. Are you kidding me? The consensus for UMich sentiment was 63, came in at 57.9. Whoops. The one-year inflation expectation was 4.3, came in at 4.9. The 5 and 10-year inflation expectation was consensus 3.4, came in at 3.9. So that gets your attention. So we need to chat about that because those are some big numbers, I think, kind of moving the market here. Michael McKee joins us here, international economics and policy correspondent. Wow.
That was my reaction.
Okay, that's about all I got for you. Wow.
We've had the numbers on both the Conference Board and University of Michigan sentiment indicators moving down, but this was a real violent move, particularly in the expectations index, which fell 10 points, 54.2 from 64.0. It's just kind of an amazing turnaround in people's views. I speak every month to Joanne Shu, who's the director of surveys at the University of Michigan, and she said it was a remarkable change, that she was surprised when she saw the numbers come in, because it showed that there were declines in confidence in just about every socioeconomic category, political category. Everybody, everywhere, is not feeling good.
Everyone, everywhere, all at once. And that we asked her the same question, and she was like, it was across party lines, Democrat, Independent, as well as Republican. Is this going to be, though, as simple, you think, Because sentiment can shift really quickly, as we just saw. So there is a world where all of a sudden, like, we get clarity on headlines, and this shifts right back to the trajectory that we'd been on.
Yeah, exactly. And Joanne said she thought that was a possibility as well. This is a quick and deep change, but it isn't necessarily a broad change. It'll depend on how the economy evolves. Right now, all the headlines are negative. We're seeing the markets go down the last couple days or weeks, and we're seeing all this confusion coming out of the White House, especially on tariffs, which is what contributed to the big rise in inflation expectations. And while that's happening, people don't know what to think. So confusion is not the economy's friend. Right. But if we get clarity and if things turn around, and at some point the markets obviously will stop going down and go up for a while, then maybe people start to change their minds a little bit.
Does the Federal Reserve, do they look at survey data, sentiment data like the UMich data?
Oh, they certainly look at it, and they certainly worry about the idea that inflation expectations become unmoored. That's one of their central things that they follow, because they don't want people to start pushing inflation up by asking for compensation for higher inflation. And we had a 32-year high in the 5 to 10 year inflation numbers, which would be, I'm sure, was a real surprise to them, as with everybody else. But they know this is based on a lot of tariff talk rather than people's actual experience yet. It's what people fear is going to happen. So they're going to wait. They'll take note of it, but they're going to wait and see if this actually moves into higher prices, and then people are still worried.
But that's what I was struck by, the fact that it was the long-term expectations that really grabbed the headlines, because usually it's the 1 year that we see a lot of the movement, right? And that would imply more of a trade war effect if it's longer term versus a one-off higher tariff situation, which would be that 1 year, which implies that why not go out and buy a lot of stuff right now, because prices are going to be super high later, and that causes that inflationary spiral.
Well, that's a good idea, Paul. You take over the show. We're going shopping.
Exactly.
That's one of the fears that people have, is that and we saw this in some of the retail sales numbers, and then in the inventory numbers that we saw companies doing, is people pulling forward their purchases because they're afraid of higher prices later on. Jay Powell, when he spoke last Friday, suggested that the Fed was keeping an eye on the long-term inflation numbers, because they don't usually move all that much compared to the short-term numbers, which are really affected by headlines. In this case, it was a huge move for long-term inflation expectations, and it seems to reflect definitely a fear that tariffs would have a long-term negative impact on the economy, because gas prices haven't been shooting up, and food prices haven't been shooting up. So the things that normally influence people are not behind this.
Interesting. And you mentioned retail sales. We're going to get that Monday, St. Patrick's Day, which in my calendar is the first day of spring every year, St. Patrick's Day. So we'll get retail sales on Monday. So that'll be something to see what that data shows us here. Michael McKee, thank you so much. We appreciate it. Michael McKee, international economics and policy correspondent, joining us here in our Bloomberg Interactive Broker Studio. Stocks at session highs here. The S&P up over 100 points. That's 1.8%. The NASDAQ up 2.3%. That's 300 points. The Dow up 575 points. Hello, this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all advancing at the end of a dizzying Wall Street week. Right to the numbers with the S&P 500 index up by 103 points now, up by about 1.9%. The S&P at 56.24. It is on track for another losing week. The Dow up 566, up 1.4%. NASDAQ up 419, up 2.4%. The Russell 2000 index of small cap shares advancing by 2.3%. The 10-year 4.30% with the 2-year 4.01%. Gold is down $7 the ounce, down 0.3%, $29.81. West Texas Intermediate crude up 0.6%, $66.97 a barrel. And Bitcoin now surging by 6.1%. Bitcoin up $4,900 at 85,221. We did get dismal news today on consumer confidence in America's economy. And with that story, here's Bloomberg's Vinny Del Giudice.
Consumer sentiment fell this month to a more than 2-year low, while long-term inflation expectations jumped by the most since 1993. The nationwide data from the University of Michigan illustrate dismay about the impact of White House trade and economic policy on American families. Consumers' expectations for their finances dropped to the lowest on record. Moreover, confidence among both Republicans and Democrats weakened, a case of bipartisan jitters. Vinny Del Giudice, Bloomberg Radio.
Ulta Beauty shares now up 12.5% after fourth quarter results topped Wall Street's projections, and the chain's new CEO said the company has almost no exposure to the brewing trade war. Again, Ulta Beauty up by 12.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We're broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. Also check us out on YouTube as well. We all know the mail we dread. The mail that comes from a hospital or a doctor's office or an insurance company that says your claim's been denied or your bill is totaling thousands of dollars. We all know, we've all experienced it in some way. We all hate it and we all dread it. John Tozzi is Bloomberg healthcare reporter, and he really dug deep into this issue in a recent Bloomberg Big Take story. And you followed one cancer patient's journey where she basically wound up stuck with a $100,000 bill for breast cancer radiation treatment. Walk us through sort of her story and then how that's emblematic of the broader industry.
Yeah, so this is a story of a woman who was being treated for advanced breast cancer in Wisconsin, and she sought prior authorization from her insurance company, United Healthcare, for the treatment. She got a kind of confusing set of responses. She got 2 letters on the same day, one denying the authorization, another approving it. She got the treatment. Months later, the company declined to pay for it. She ended up filing a lawsuit to get the treatment paid for. The company ultimately did pay for it after the lawsuit was filed, after we inquired about it. But you know what this story really exemplifies is kind of what an administrative mess the U.S. healthcare system has become.
So, I mean, you've got a stat in here which is just blows me away. The U.S. healthcare system spends as much on billing and claims processing as it does on treating cancer. That is just extraordinary, because what you have here, as reading your story, you got 2 big entities locking horns all the time. The provider of the medical procedure, and then the insurance company that has to pay for it. Neither of them are wallflowers. They go at it, don't they?
Yeah. So what we have is this adversarial system, right? You have on one side, hospitals, medical providers, labs. We're in a free market economy where there's no restrictions on the prices they can charge. On the other side, we have the private insurers who are, trying to constrain costs for their clients and, make sure that the care given to their members is appropriate care. It's just this conflict, and it's escalating. We see data on insurance denials rising. We see a bunch of basically companies that have gotten into this system to help one side or the other, or in some cases both, maximize their financial advantage in these transactions. So you have this sort of escalating conflict that patients are often caught in the middle of.
So what's our way out of here?
Good question. I mean, I think, some people would argue that there is, opportunities for technology and AI and, more efficient processes.
Like standardized, technically standardized practices or something?
I think that would potentially go a long way. I mean, there's been a lot of research over a long time over kind of how to do this. I think what you fundamentally get, though, is like the system where incentives are misaligned. Like you have one side that has an incentive to do more and to bill more, and you have another side that has incentives to kind of put up more restrictions or guardrails, they might call it, around care. And that's sort of increasing, and I'm not sure that there's sort of a clear pathway out of it right now.
Well, one of my questions is, what does this mean for healthcare providers? It kind of, and you've got a great chart in here. U.S. doctors no longer work for themselves, and it's the percent of physicians employed by hospitals or corporate entities. And that number was about 60% back in 2019. It's over 75% today. So our doctors are saying, I just can't deal with this stuff anymore.
Yeah, I mean, I think if you talk to physicians, you hear, there's a lot of compliance and sort of investment they need to do in over the recent years around electronic medical records and, basically being a practicing physician has gotten a lot more complicated and I think in some ways a lot more expensive. In the days of just kind of hanging your shingle when you get out of med school and being a solo practitioner, those are over. The other thing is that they're, looking for bargaining power when they're contracting with the insurance companies. So they're joining hospital systems, they're joining big groups, they're joining private equity owned, practices.
I guess the logical question also then becomes, if there are tweaks to entitlement programs too, how does that wind up affecting this whole dynamic? Because if there are changes to Medicaid and Medicare, I would assume that some providers will then lose money and then it makes it harder?
Yeah, I mean, I think, we'll still have to see what comes out of Washington on that front. But, in general, I think providers will tell you that they have to charge higher prices in the private market because they are not compensated enough by government programs. I know there's a lot of dispute about that assertion as well from economists and others. But, for patients, particularly in the commercial market where they, if you're on Medicare or Medicaid, the government sets the price more or less. But if you're on a private plan, those prices are set in the private market. And that's why when, if you do have a situation where something isn't properly covered, you can be exposed to a really expensive bill.
Did Julie Simons, the woman in your story, did she ever get any resolution with this lawsuit here?
So the claim was paid, again, after she filed a lawsuit, after we asked the company about it, the claims were paid.
Sticking your nose in there.
So that was resolved. The lawsuit is, is still pending.
Okay. All right, very
As
good.
if getting cancer and getting radiation treatment isn't stressful enough. Now we layer this on at the same time.
Yeah, I mean, you see stories, you read stories like John's story about just the number of bills and the charges, and it's mind-blowing for the average person, and even for people that maybe have some resources that can fight.
I know it. And sometimes people, if you have your basic insurance too, it covers nothing.
Yeah.
It covers if you scrape your knee, you can get a Band-Aid, but that's pretty much it. Anecdotally, I wind up hearing that from many of my friends who are independent employers. All right, John, thanks a lot. Really appreciate John Tozzi. He's Bloomberg healthcare reporter on the Bloomberg Big Take story. You can check that out on the terminal as well as Bloomberg.com/Big Take. Really great read. You can definitely check it out. The biggest question probably in D.C. over the last few weeks is how long does Elon Musk last?
Yeah.
And when does President Trump kind of get tired of him and kick him out the door? We haven't seen it.
No. And I think I think he and Doge have had as bigger impact than I think anybody would have guessed.
Yeah, absolutely. Liam Denning, Bloomberg opinion columnist, very outspoken, always has really fun opinions when it comes to Elon Musk. He wrote a great piece on how long will Musk be welcomed at the White House. We're going to break that down for you. This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it to the weekend. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. Liam Denning is a Bloomberg opinion writer. I've known him for years. He writes on oil, climate, gas, energy transition, and all that fun stuff. He also has written on Tesla for years. They don't love him there because he really digs into the numbers and really puts things into perspective. And his latest piece talks about how long Elon Musk will be welcomed at the White House. Liam, thanks for joining. It was a really good piece. I read it earlier. Are you surprised that he's lasted this long?
Well, not really. I mean, I know that there's this speculation that, you've got these two big egos and they're bound to kind of explode in some kind of supernova at some point. I think we do have to consider that they both still get quite a lot from this relationship. I mean, Elon Musk has the ear of the most powerful person in the world. He has, through the Doge, whatever that is, he has influence over all sorts of agencies that regulate or do business with his companies. And in return, President Trump gets to bask in the aura of this prominent businessman. He gets campaign dollars, and he gets obviously, should we say, algorithmic alignment on a big social media platform. So there is still quite a lot there.
Algorithmic alignment.
But we have seen, I think the reason I wrote the piece is we've seen a confluence of things that point to the risks of a business person like Elon Musk tying himself this closely to, a pretty controversial president.
Yeah, Liam, put me in the camp. I was one of those folks that said, Elon will probably last, his tenure will be measured in weeks, not months or years. And it looks like, at least at this early stage, I may be proven wrong. But money talks here. According to Rich Go on the Bloomberg terminal, Musk's net wealth is down $118.6 billion this year. Do you think he cares?
I think, maybe on a kind of an ego level that matters. I mean, he's still worth, the last time I looked, something
313.
Like so, he's obviously not going to be struggling. But I think for me, the big mover there is Tesla, obviously, because that's the biggest asset. It's the only really liquid one. He has, his own personal indebtedness is tied to that stock, and he used it, to help buy Twitter. And I think it is an issue because I think what's been interesting for me with what's happened with Tesla since the election, obviously there was that huge Trump bump in the stock, worth north of $700 billion, which has collapsed. This week it finally went below where it was on November 5th. And in some ways, I've sort of viewed that not just as a stock price, but as an opinion poll. We saw this really enthusiastic response, based around honestly pretty nebulous ideas that Musk's closeness to Trump would somehow translate into, say, like, favorable autonomous driving legislation or something. But when you unpacked it, there wasn't really a whole lot there, mainly because, the big problem there is it's not government regulation. It's the fact that Tesla still doesn't have a commercial robo-taxi. Like, that is the main problem. And in the meantime, we've seen the corrosive effects of that relationship. Clearly the Tesla brand is suffering in major markets. We've seen bad numbers out of Europe. We've seen bad numbers out of China, although that may have less to do with politics and more just with straight up competition. And we've seen weakness in California, the big US EV market, building through 2024. And I honestly don't expect that the past couple of months have helped with sales there either. And I think as that price comes down, it does tarnish Musk's image. It does affect him financially. And it also points to, I think, lasting damage if this relationship with Trump were to unravel in the same way we've seen with businessmen previously.
So I live in Park Slope, Brooklyn. I think Liam does too. But have you seen the Teslas that are parked?
I do not.
You do not? I thought, but you live in Brooklyn, right?
No, I'm in the suburbs.
Oh, he changed. Okay, he was in Brooklyn at one point.
was
But
hit
my
in-
point of this whole conversation is in yuppie Brooklyn, there are Teslas parked on the street, and I noticed for the first time there were signs, like leaflets being put on the windshield, being like, sell your Tesla, with like a picture of Elon Musk. Because like that's where the protest is, like only in Park Slope would that actually happen. Does Musk also provide a foil for Donald Trump in terms of like Musk gets the heat, Trump doesn't?
Yeah, and I think my read of the way Musk was brought into government in this kind of, slightly arm's length, quasi-independent role was that gave him a lot of freedom of movement to act. It also meant he obviously avoided some of the more onerous kind of Senate hearings and that kind of thing. But I think it also gives Trump some useful distance if at some point we were to see some real blowback against, cuts to entitlements, or if we see, a recession happen. We've seen Trump, very quickly, lose patience with some of these people he's brought in before. I'm thinking of people like the former Exxon CEO Rex Tillerson in the first term, Gary Cohn from Goldman Sachs. Musk is in a different league, but he's also very close. He's not, this is a whole new level of embrace between a prominent business person and the White House. And, when we had that rather bizarre...
All right, Liam, we're going to have to leave it there, friend. We're out of time, but great article. We look forward to more reporting there. That does it for us. Balance of Power. Joe Matthews starts right now.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. It's a key day in Congress after the top Senate Democrat Chuck Schumer said he would reluctantly back a Republican spending bill to stave off a government shutdown. CBS's Caitlin Huey-Burns on Capitol Hill.
The big question heading into today's vote is whether and how many Democrats will follow along with it. Fetterman has already been on board. That means they'll need 6 more to go through with this. And by Schumer making this announcement, he was really offering political cover for other Democrats to follow suit. And so we'll wait and see later on this afternoon if they do, in fact, do exactly that.
The Education Department says more than 50 universities are being investigated for alleged racial discrimination as part of the Trump effort to end diversity and equity programs. An earlier memo said schools could lose federal money over race-based preferences in admissions and scholarships. Overseas, word that Hamas is poised to release an Israeli American. The last living American is believed to hold.
Hamas did not specify when the release of Israeli soldier Idan Alexander, who was 19 when he was taken hostage, and the bodies of 4 other dual citizens who died in captivity would occur. The U.S. Special Envoy to the Middle East, Steve Witkoff, has been working on a plan to extend the ceasefire with Hamas. The deal would also see a limited number of Israeli hostages freed in exchange for Palestinian prisoners.
Reporter Linda Gradstein in Jerusalem. Scary moments at Denver's airport as an American Airlines jet caught fire on the ground with 178 people on board after engine problems caused an emergency landing.
The minute we landed, it was like smoke started filling the cabin and people started kind of screaming and pushing and jumping up and yelling.
12 people suffered minor injuries. SpaceX tries again today for the second time this week to launch a 4-member crew to the space station. Space consultant Bill Harwood says that would bring 2 astronauts who got an extended stay in space a step closer to coming home.
They have to show Crew 10, these freshly arriving crew members, the ins and outs of space station operation. They're going to spend 2 days doing that before they get in their own Crew Dragon and return to Earth.
Well, Gene Hackman's estate is trying to block the public release of his autopsy report, as we hear from CBS's Michael Wallace. The estate is especially worried about photographs of the bodies of the Oscar winner and his wife, Betsy Arakawa. When maintenance workers found the couple dead in their Santa Fe home last month, their bodies were partially mummified. Arakawa died of hantavirus pulmonary syndrome, which is spread by rodents. Hackman died a week later of heart disease with complications from severe Alzheimer's. The Dow is up 600 points. This is CBS News.
An old language is being revived by new technology.
Assistant Professor of Computer Science Jesse Roberts and his students are using AI to help preserve the endangered Cherokee language.
In the Eastern Band, there are roughly 140 first language speakers left.
Roberts is entering recordings of fluent speakers of the Cherokee language into AI tools, but those tools are having a hard time processing the language because its structure is unlike that of any other. Roberts is being helped by Benjamin Fry, an assistant professor of Cherokee language and culture at the University of North Carolina, Asheville.
The pie in the sky dream is that we'll have fully articulate, fluent Cherokee speaker that lives on your computer, can work on your pronunciation with you.
Christopher Cruz, CBS News.
NBA star Steph Curry turns 37 today. Last night, he became the first player in NBA history to make 4,000 three-point shots. Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Chuck Schumer caves, but will the government shut down anyway? Welcome to the fastest show in politics, as the Democratic leader in the Senate calls on his members to vote yes as soon as tonight. With a midnight funding deadline ahead, there is no indication that they all will. And we'll get the latest as we count down to midnight ahead with Bloomberg's Mike Dorning. He's with us here at the desk in Washington. President Trump later today set to outline his vision for the Department of Justice amid reports that mass deportations may start as soon as today, and consumer sentiment dropping as inflation expectations rise. We're going to dig into all of these developments with our signature political panel. Rick Davis and Jeannie Shanzano are with us, and we're going to bring you a special conversation that straddles both sides of the aisle with Democratic strategist Kevin Walling, Republican strategist Alex Stroman. Step back, Carville and Matlin. You will not want to miss this, and it's coming up after we check Wall Street. As always, we start with our markets, the Friday trade, and Charlie Pellet in New York. It's comeback day, Charlie.
Indeed. However, Joe Matthew, we are on track for a losing week. Right now, down 2.5% on the week, but as you correctly point out, a lot of green today ahead of St. Patrick's Day with the Dow, the S&P, NASDAQ all advancing. Yes, St. Patrick's Day next week. S&P right now up 99, gain there of 1.8%. We've got the Dow up 579, up 1.4%. The NASDAQ Composite Index up 385, up by 2.2%. Bottom line here, stocks are climbing at the end of a dizzying Wall Street week. Your 10-year 4.30%, with the 2-year this Friday 4.00%. Gold down $3 the ounce, little change there, down by 1/10%, $29.85. West Texas Intermediate crude up by 0.6%. Bitcoin, what a move there, up 5.4%. Bitcoin 84,610 right now. As for the economic backdrop, Torsten Slok is chief economist at Apollo Management, and he's cautioning that the DOGE job cuts will extend beyond the federal government.
Remember that for every federal worker, there are 2 contractors, according to Brookings. So Brookings studies show that in total, true employment in the federal government is roughly around 9-10 million people. So if you now think about total number of households is 130 million, and someone in a federal worker or contractor lives together with someone in the private sector, you get that as much as 10-15% of all households in some way or another is being impacted from a sentiment perspective by DOGE alone.
Torsten Slok of Apollo interviewed this morning on surveillance. And Cora Holdings is adding to its holdings of U.S. Steel as the activist investor continues to push its case to replace the board and install a new CEO to lead a turnaround of the American steelmaker. Right now, we have got U.S. Steel shares up by 2.7%. If we're talking U.S. Steel, got to mention Nippon Steel, the ADRs up by 2.1%. Again, recapping here, stocks higher. S&P up 102 now, up by 1.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, thank you so much. Boy, that looks a lot better today. A little green on the screen. If you're with us on YouTube, you certainly get a sense of that. And Charlie will be back with another update on the markets a short time from now, holding forth from world headquarters in New York. You made it to Big Friday, the threshold of the weekend, and a lot has yet to happen before we call this a week. And of course, we're looking at the Senate here after Chuck Schumer changed his tune last night. Boy, that was fast, wasn't it? After suggesting that Democratic anger and frustration with the Trump administration not doing what Congress tells it to do would lead to a potential government shutdown tonight. He says Democrats won't be there to help. He took to the New York Times with an op-ed. As bad as passing the continuing resolution would be, a government shutdown far worse. So we're, again, going to be straddling both ends of Pennsylvania Avenue again today. There you go with the New York Times grab on YouTube. You can find us right now on YouTube, by the way. Search Bloomberg Business News Live, always on Bloomberg Radio and on the satellite radio, channel 121. Here is the Senate Minority Leader, Chuck Schumer.
For Donald Trump, a shutdown would be a gift. Right now, Donald Trump owns the chaos in the government. He owns the chaos in the stock market. He owns the damage happening to our economy. It is my job to make the best choice for the country, to minimize the harms to the American people. Therefore, I will vote to keep the government open and not shut it down.
As you hear jeers from the rank and file, they may not all follow Chuck Schumer, and that's why this is a peculiar moment here for Democrats. Just after he told colleagues that he intended to vote yes and wanted them to follow, Senators Alyssa Slotkin, Ruben Gallego, John Ossoff, Mark Kelly all said no. We're still no votes. We're watching others like Andy Kim, Angela Also Brooks. You're going to see this unfold while we're talking today. Between now and the later edition of Balance of Power, there's going to be a cloture vote that sets the table.